with not just malls, but I look at the flux in some of the most storied names in retail and department stores, and I'm trying to figure out what the Saks or Macy's or Bloomingdale's. What does the future look like there, and what's happening? What's changing so much? Is it all just, are they missing the online digital side of things?
Well, I think it's a combination of things. You mentioned mall traffic. I think mall traffic in a lot of places is challenged, so they have some geographic issues to deal with. I think you've seen, some of them start to respond. I think Macy's had a couple of good quarters now. You've got guys like Dillard's who've sort of found a way to navigate through it. And then you've got guys who are just starting to figure it out. Kohl's has a leadership transition. Michael Bender's taken over there. He's a terrific leader, but they've got their challenges ahead of them. If you can't find a reason to be, then you're not going to be.
Do you dabble in, specialty retailers? Do you have opinions about all those things? Do you keep up with foot traffic? Who do you expect? If you were going to give me a list of companies to buy or for our investors, what do you like in 2026? Can you do that? Maybe you got a future in, at Goldman Sachs or something.
If it's not, I don't know. I sort of look at the ones who are really beat down. I think Target's had its struggles. They've got a leadership transition, but I can't imagine in my mind how it could get worse, right? It only has to get better. So if I'm looking, I kind of like Target. And we talked about Walmart. They've done a really good job, but because of their transition, I love them as a company. From an investment standpoint, I might be on the sidelines on that one for a little while. In specialty, I think sporting goods had its heyday. So Dick's and Academy, I think, had a nice run. A little bit leery on those going into next year.
How about Costco or some of the other big names, Home Depot?
Costco is a beast. One of my favorite retailers of all time. I think they've just done a really good job consistently. I think their stock's a little bit beat down. I am a little bit worried about the demographic shift away from the big pack sizes in the club panel. We'll have to see how that plays out. But I think their valuation is pretty low, and they're somebody I'd be interested in. Home Depot is going to continue to go on. I've heard your prior guests talk about real estate. As long as new home sales and home sales have been slow, I think we're going to see a rebound in the home improvement channel. So I kind of like Home Depot as well.
Anything? China's got gets a lot of play, a lot of talk about all their online businesses. Anything plus or minuses coming out of there for you, individuals?
From an investment standpoint, I would stay away from it. For me, I don't really know. Nobody knows what's going to happen with tariffs and the Supreme Court ruling and reciprocal tariffs. It's going to be really interesting. We're in unprecedented territory from a retail and consumer standpoint. We've got upward pressure on prices from tariff and downward pressure on prices from technology and AI.
Yep.
We've got population immigration changes affecting demand. And then we have the whole geopolitical situation and the election coming up, and who knows what's going to happen. So I think the consumers been resilient. Their paychecks have been healthy because wages have gone up pretty substantially the last 3 or 4 years. And the consumer, I think, will remain buoyant. But from an investment standpoint, any number of things could happen.
Wow. I think I'd give you some money if you want to, allocate some.
I'm here to announce the formation of my investment company, right?
You probably could. Did you? You didn't sell all your Walmart stock when you left the company, did you?
No, I sold some, bought some back, and I've been trading it.
What'd you get Doug for?
Right
you better get Doug something nice for Christmas.
He doesn't need anything, trust me.
No, you're right. You're right. All right, Bill Simon, thank you.
Appreciate Thanks, guys.
Okay.
Yeah, Doug carried around that list of the top 10 retailers of every decade. He wanted to make sure that Walmart was at the top of it.
Yeah.
And 11 years later, certainly is. So, did it well.
Mm-hmm.
All right, folks, this is a picture of Sydney, Australia, where we are about to see fireworks. It's about to turn midnight there. Here we go. Better late.
A little bit of a delay, maybe. Uh-oh.
Here it is,
There we go.
okay? 20 seconds that they're coming down. You know, our clocks are right. They're running a little behind on this.
Yeah,
Yeah, our clocks are definitely right.
it's like,
8.
oh, here we
You
go.
get to ring in 2026. And there you have it. It's time to play Joel. Here we are, the first, or actually not the first, Auckland, New Zealand, we watched 2 hours ago. Now you're watching Sydney, Australia. These are the fireworks, Sydney Harbor, ringing in the new year. And those are some beautiful fireworks. Up next, Tokyo is going to be ringing in the new year. That comes at 10 a.m. Eastern time.
Is that just us with all running time?
Probably.
Did they, what did it be, timing kangaroo down sport? You remember that song?
Oh.
It's a huge hit. Huge,
Maybe
number
if you
one.
sang it, I would recognize
Tiny
it.
kangaroo down sport. Tiny kangaroo down. Yeah, you know it.
Yeah, I do. All right, we're going to continue to watch these New Year's celebrations, but those are some great fireworks over the water. Taipei comes at 11 a.m. Hong Kong's fireworks were canceled after November's devastating apartment fire. At noon Eastern time, though, Bangkok, Thailand will ring in the new year. That will be followed by Dubai at 3 p.m. Eastern time. Athens, Greece will take place at 5 p.m. and, of course, much of Western Europe at 6 p.m. London is going to be celebrating at 7 p.m. and then right here behind us, midnight Times Square.
It's almost like you move across, you keep going west around the world, and it's just every
hour,
Yeah.
just like Santa's
weird.
sleigh.
Oh, that's right. That's right. We saw
this
this on the 24th.
only been a week.
Yeah.
And here we are following Chasing the Sun once again. Let's check on the futures in the meantime as we get a little closer to the opening bell. Right now it looks like the Dow futures are off by about 14 points. S&P futures down by 6. The NASDAQ indicated down by close to 40 points, but what a year it has been for the major averages. Frank Holland is here. He's got a look at this morning's free market movers. And Frank, good to see you again.
It's good to see you guys. I really enjoyed that duet. I was going to jump in if you guys kept it going, but you stopped. So I
You
guess I'll just do
remember
the
Frank?
numbers. I'll just
Frank
do the
remembered it.
Yeah.
It's a huge hit.
I'm surprised you didn't do a Crocodile Dundee reference, but I
I thought about that.
Great
Was
song.
there a song? Was there a song in Crocodile Dundee? I thought
No,
about
I mean,
that.
there's a couple famous lines. I don't think there's actually a song.
No, this is a knife. That's the
Right, that's the one.
That's the remember that? Yeah.
I think we better move on to the movies. We're going to start with metals. Silver rebounded yesterday after a drop on Monday. We take a look here. Down again sharply. Silver pulling back more than 8%. Gold also down about 1%. Exchange operator CME Group saying it's going to raise margin requirements on precious metal futures for the second time in a week. Also, we have China about to tighten controls on silver exports, a move similar to the country's stance on rare earths. So take a look. Gold, platinum, and copper, all of them getting hit this morning. Down here you see platinum also pulling back more than 10%. But, and it's a big but, as we've been showing you all week, these names have had some huge runs in 2025. Take a look right now. You see silver up just about 145% this year, gold up over 60%, both tracking for their best yearly performance since all the way back in 1979. A lot of big upside moves, then clearly a pullback in recent days. All right, next let's take a look at some of the biggest pharma stocks. They're trading a bit mixed, seeing some red and some green on the board following a Reuters report. The drug makers plan to raise prices on at least 350 medications in 2026. That's despite pressure from the Trump administration to keep those same prices down. That would be up from the same point last year when the companies unveiled plans to raise prices on more than 250 drugs. Take a look, Eli Lilly in the green, Pfizer in the green, just very fractionally, but Novo Nordisk pulling back fractionally. Similar story for Sanofi, GSK pulling back about a third, 1%. And we're going to finish with the best and the worst performers on the Dow this year. Take a look, you see Caterpillar up just about 58, almost 59%. Goldman up almost 54, 55%. Johnson & Johnson up over 42, almost 43%. NVIDIA up about 40%, rounding out the bunch. And then you look at the worst performers in the Dow this year as well. United Health, the biggest laggard, pulling back more than 34%, followed by Salesforce pulling back more than 20, Nike, P&G, and Home Depot. Rounding out this group, Home Depot down just about 11%. Back over to you.
Where's that big butt?
Yeah, I mean, it's not just a butt, it's a big butt. I mean, how big, Frank? I mean, just like.
It's the last day of the year, guys. Come on, you gotta give me a hard time. It's a big butt. It's a big butt.
It's not just a butt, it's a big butt. Okay. That's fine. Yeah, you like big butt.
I like when we're doing the duet. We might need to go back.
We're doing it. We got 3 people here playing along
Say
here.
the itty-bitty face and a round thing in your face, you get strong.
Whoa! Wow, we
It's
need
my
to
entrance.
more often. How did you happen to know this exact lyrics?
All right. Who doesn't know
I
lyrics?
think it's the lyrics that I can't say though.
Blanket, blanket, blank, don't want none. You got buns, huh?
Wow. For setting us down this path.
Now to a $14 billion NVIDIA chip deal hanging in the balance. There's no buts.
Ifs, ands, or buts.
Ifs, ands, or buts. Christina Partsinevelos.
There could be a but, and I'll get to that in a second. So
Okay.
NVIDIA's China business just got a major green light, and the numbers are enormous. Reuters reports Chinese tech companies have ordered more than 2 million of NVIDIA's H200 chips for next year, roughly $27,000 per chip. That's according to them. So that would equate to roughly $54 billion in potential demand. NVIDIA currently has about 700,000 chips available, meaning the company will need TSMC, Taiwan Semi, to ramp up production starting very, very soon. ByteDance alone, which is the parent of TikTok, is reportedly planning to spend $14 billion on NVIDIA chips in 2026. So that could equate to roughly 10% of NVIDIA's annual revenue, and is estimated from just one single customer. ByteDance has already built a 1,000-person chip team and developed a chip comparable to NVIDIA's H20 chip, which is a lower-tier chip geared toward China at a lower cost. But the scale of these orders today shows China still doesn't have domestically produced chips capable of handling large-scale AI training at NVIDIA's level, which is good news for NVIDIA. There's also a U.S. revenue angle. NVIDIA pays, or is supposed to pay, a 25% fee to the U.S. government on China's sales. That means roughly $3.5 billion from ByteDance alone, if we take those numbers at face value. Potentially more than $13 billion if all 2 million chips ship. For investors, this matters because China revenue has been stripped out of street models. These approvals could drive upward revisions, but the stock isn't celebrating today. Investors have lived through repeated starts and stops and big buts on China chip sales. Until orders turn into shipments and revenue, the market is just taking a wait-and-see approach. There's the upward.
You have we've been wasting you.
I have said it many times. I
No,
would
but
love
you-
to join.
Yeah, but you let your, usually, not quite, but you let your hair down today. I know.
I was gonna wear silver hot pants, but I figured it wasn't appropriate for your set, so I'm gonna change and wear it the rest of the day.
Christina.
But yeah, great. Now you wanna talk about NVIDIA?
No, yeah, we can definitely talk about NVIDIA. In fact, we definitely can talk about NVIDIA.
No, okay.
Now we're running,
Talked about big butts.
yeah, we're heavy, so to speak, yeah.
Not even your feet for yourself. Oh.
Yeah, exactly. No, I have none. I never have. I
Don't
know.
have a butt.
I know.
Close and a good attest.
Depressing. Yeah.
I'm impressed with your lyrics ability. That was good.
Thank you.
And Christina, we will talk more about NVIDIA.
I mean, with this big short guy, I mean, not big, but the big short guy, I mean, NVIDIA is a kind of a controversial name at this point. And
Oh,
it's
my
sort of,
glory.
yeah, it's the kind of the consensus is you made a lot of money in NVIDIA. It's not going to 8 trillion. Sell that and buy something further out the chain of AI valuation.
So that's why the stock isn't outperforming as much this year, is because the upside is maybe not where it was in the past,
Right.
but the demand is still there. There's no doubt about it. But if you're an investor, it's run up so much. Why would you get in now? There are two catalysts, potentially China and then GTC, which is their big tech conference in March, where they announce big news, and usually the stock moves about 6% within
Yeah.
the following 4 to 5 days. Post
That's how commercial competing network that usually has like Mike Lindell, one commercial after another, the Mike Cool guy, and it was about someone's big pick is a data center builder, honestly, that you should sell NVIDIA to get into this, and he's saying you hit this, and it was like a 2-minute long investor guide. It's Eric, I've never heard of it.
NVIDIA's in over 600 ETFs. There's so many alternative products. And when you said big, I was smiling because I thought you were going to go back.
No,
So
not
it's got
that,
arrows.
no, but I mean, this was like, this guy's bought 2 minutes worth of advertising on this network. They're talking about this one individual. Interesting that he's talking about NVIDIA to sell it and then,
Christina, thank you. We'll see you later.
thank you.
When we come back, we're going to talk about the impact of AI on the labor market and a proposal to help offset the impact of lost jobs. We've got that next, and Squawk Box will be right back. welcome back, everybody. Our next guest warns that an AI-fueled job apocalypse is on the horizon. Let's bring in Saul Khan. He's the CEO of the Khan Academy. In his latest piece for the New York Times, Saul makes the pitch that every company benefiting from automation should dedicate 1% of profits to help retrain workers who will be displaced by AI. Sal, first of all, thanks for being here. Second of all, this is a pretty radical proposal, but let's lay out what you think is happening. Why you think this job apocalypse is coming?
Yeah, as soon as generative AI became a big thing, obviously this has been a big debate. Will we have net loss jobs, net gain jobs? Living out here in Silicon Valley, most people have been on, hey, this is going to be like the Industrial Revolution. We'll just, there'll be jobs, we can't name them, but they'll happen. But what we're seeing now, in that op-ed I talk about seeing the Waymos in my neighborhood, and that's cool, but then I go and meet with a friend who is thinking about contributing 1% of his firm's profits for reskilling, and his motivation was he's taken over a call center in the Philippines, and he's going to be laying off 80% of the workforce and replacing them with an AI. That's 7 to 10% of the Filipino GDP directly. Driving some form of a vehicle is 4 to 5 million workers just in the United States. It's one of the biggest sources of employment for men globally, including in the United States. And even if you look at white-collar jobs, a lot of people are talking about and seeing what's happening in software engineering right now. It seems kind of frozen. Things like product management, design, we're seeing that those jobs are at least changing. You're not seeing a lot of net hiring. If anything, there's a lot of things going the other way. And the only way to think about how to navigate this, I think if folks wait too long, the political winds are going to switch. We've already seen that populism can get a lot of momentum off of things like globalization and immigration. I think automation is going to hit a lot harder. And 1% isn't without precedent. As I mentioned, one of my friends, he hasn't announced it yet, that's why I'm not naming their firm, but it's a major firm. There's Ares Capital, another major asset manager. They have a class of funds, several $1 billion under management, where they're giving 5% of their promote to philanthropy they're doing healthcare and education, but that's related to reskilling. So the pitch here is it's in companies' best interest. This isn't going to be just, hope isn't a strategy here. We have to get ahead of the curve. The benefits of doing something significantly weigh out the alternative. And I think if we don't do something, politics are going to take over, and that's going to be worse for everyone.
I hear what you're saying, and I thought the same thing myself. We watched it with Occupy Wall Street and other movements in the past where people feel like they have no hope, where they feel like they've lost things. You definitely do lose the political winds. I think it's probably difficult to convince lots of companies to say, yeah, we're just going to take 1% of profits and give them to this, when many of them probably can't say, look, we're going to lay off a lot of workers as a result of this. I think what you're talking about specifically, a company that is going to give back 1% of profits after deploying an AI agent that's capable of wiping out 80% of call center jobs in the Philippines, that seems like a token you drop in the offering box on your way out of mass because you feel really bad because you've been so guilty. I don't know how we balance this out, but I think you're going to have a hard time convincing some of the biggest companies out there that they are really losing jobs. Even if you talk to somebody like an Amazon, they'll say, that's a situation where Andy Jassy said if they're successful, they'll have more workers than they have in years past. I think that's what Jamie Dimon said specifically at JP Morgan. If we're successful, we're going to have more workers. They'll just be in different jobs. So I don't think you're ever going to convince a company like JP Morgan that they should be taking 1% of the profits and then giving it away like this. How do you see this playing out on a grander scale?
Yeah, I hope, and I do think that there could be a form of peer pressure here. And what you're saying is real. When I wrote the op-ed, most of the people who read the op-ed is, why only give 1%? 1% is nothing.
And for that guy, if you actually feel like you're guilty for releasing an AI agent that's going to lay off thousands and thousands of workers, maybe you should cough up more. But other companies, I don't think will feel the same way about it.
No, I think that's the interesting thing. I think the public is already feeling that it should be a lot more. If you look at some of the comments in the New York Times article, the pitchforks already seem to be coming out. And this
Yeah.
is before things have really gotten bad. We're still in a relatively good economy. On the other side, 1% isn't a trivial amount. I point out that, if you take the top 10 or 12 companies out there, that's over $1 trillion a year in profit. That would be a significant fund, $10 billion that you could deploy for reskilling, but you can do it for millions and millions of people. And I'm just saying, if they don't do it voluntarily, and it probably won't be enough, but at least it's a start, and there'll probably be more that you want to do. It will become mandatory in some way. There's other governments, India requires 2% of profits for corporate social responsibility. The UK already has a 0.5% mandatory for reskilling. I'd argue most companies already do spend something like that, but they do it in their own silo. They do it for very.
That's what I was going to say. Some of these companies might do it if they feel like they have control over it and they think it's going to a good use for actual reskilling, but not necessarily throwing it into a government bureaucracy that they're not convinced will necessarily use it appropriately.
That's right. If this is something that still stays in the private sector, something that they can drive, something that can be nimble, because we know what the alternatives are going to be. In 4 or 5 years, you could see the pendulum swing. People become very anti-automation. They start taxing automation. They start taxing AI. There's already serious politicians talking about bans on automation and AI. That's going to be way, way more harmful. And even if they do increase corporate taxes and the government wants to do reskilling and spends tens of billions or even hundreds of billions, we know it's going to be slower and less efficient than doing it in coordination with private industry.
Sal, thank you. It's a lot to think about. We appreciate it, and I wish you a happy new year.
You too. Thanks.
And coming up, we're going to take a closer look at the race to offer prediction markets on retail exchanges and what it means for the stocks. That's next. Then our final data point of the year, jobless claims, due at 8:30 a.m. Eastern. We'll bring you the numbers, the impact on the market. Squawk Box coming right back. Exchanges that cater to retail traders have been racing to adopt prediction markets. Mackenzie Sagalos joins us now on Who's in the Lead. Good morning.
Hey, good morning, Joe. Coinbase and Robinhood are racing to own prediction markets, and the stock chart shows who got there first. Robinhood is up more than 200% this year, while Coinbase is in the red, and part of that comes down to timing. Robinhood moved early on one of the stickiest new features in brokerage apps, event contracts, while Coinbase arrived later. Prediction markets let you trade on real-world outcomes like elections, economic data, and sports, and Robinhood says that the product is now its fastest-growing line by revenue in company history. The company says that they've got 11 billion contracts that they've traded since it launched last year. Now, both firms are using M&A to get ahead. Robinhood teamed up with Susquehanna to take a majority stake in Ledger X, giving it a CFTC-regulated exchange and clearinghouse. Coinbase just announced its 10th deal of the year, buying the clearing company, a prediction market startup staffed by veterans from Polymarket and Kalshi, as part of its everything exchange push. So this race is really on to see who can deliver deeper liquidity, cleaner settlement, and scale faster. And with the CFTC signaling a more innovation-friendly stance under the new administration, regulation could end up acting like a tailwind rather than a roadblock. Guys?
Just the whole notion and the whole basis for how these things work is just fascinating. And I hear people call you, and I've been watching CNBC later, and everybody calls you Mac. I like that. Is it Big Mac? Mac the Knife?
Mac the Knife.
Mac, what do you like? Have you been called Mac your whole life?
It's, well, actually, my first boss in the news business at CNN, Charlie Moore over at Anderson Cooper, he started calling me Mac, and then it stuck.
All right, I'm gonna. It doesn't take much for me to want to start doing it. So, is money always going to be able to predict things? I mean, in betting sites, I see it all the time. Mac, I see anybody who's on the side. Doesn't matter who's playing the game. If everybody's on one side, that team's going to lose. It's so weird the way that it works. So I don't see how smart money knows the right answer half the time.
It's been interesting to see this surge in prediction markets. And Robinhood got into it last year around the presidential election. Polymarket was super sticky before that. Kalshi, of course, another first mover there. But at this point, we're actually still just talking about a few $1 billion a week in volume. But to your point, the economics really favor scale here. Prediction markets, they're a liquidity game, so the platform that has the deepest order books and the tightest spreads are going to win because traders really want the best execution.
All right, for an election, Mac, do you just assume that there are people that are doing this that have more granular knowledge of what's happening on the ground and swings? I mean, how does it actually work? There's people that are in the know. Is that how prediction markets predict correctly what's going to happen?
Well, it's fascinating because you're seeing this bifurcation of who's trading event contracts. So some people who are have certain bets in equity markets will actually use it a hedge against
The
that.
hedge, yeah.
And then on the other side, you've got retail traders who are just using it as they would FanDuel or DraftKings. I mean, you've got Robinhood upping their prediction market offerings so that you can do the equivalent of parlay bets and combo bets on NFL games.
Okay, all right, Big Mac, thank you.
I was thinking Mac the Knife.
Mac tonight.
I don't know how I feel about Big Mac, if I'm being honest.
I don't like Big Mac, and I don't like Mac the Knife now because Mac the Knife was the story of McKeith, a slick knife-wielding London gangster who
Let me tell you about Chad.
crimes. Originally
my
from
parents
the
called me?
three-penny opera, a Marxist satire.
We got him.
Oh, wait, the Mook.
Capitalism.
That's another one. The
What is
Mookie. Mook. M-O-O-K.
Oh, the Mook. Okay.
We got to go, but after the break, thanks. I'm going to tell you about what I asked ChatGPT last week.
We'll come back and there's a tease for you. We also have our last data point of the year, weekly jobless claims. That is also
Box. Rick Santelli here live at CME HQ for the last data set of 2025. Initial jobless claims for the week ending December 27th, under 200,000, 199,000. Sorry, got a little excited there. We don't have many of these numbers under 200,000, and we know many are going to point to seasonalities due to holiday issues and work week number of days. But if you just look at it on the surface, 199,000 will be the lowest since it was 192, which was supposedly a distortion for Thanksgiving on the week of 11/28, and that was the lowest going back to the fall of 22 when it was 189. See how bunched up they are? And then that goes back to 1969. Now, continuing claims back under 1.9 million. 1,866,000. We had a couple under 1.9. Then last week we popped above it. Now we're back below it a bit. Once again, now this is the week ending December 20th. There really shouldn't have any distortions due to the closure for Christmas, but nonetheless, I'm sure seasonal issues probably are coming into play here real quickly. Let's just look at the fact that we're at what, 346 on a 2-year. That would be down what, 78 basis points for 2025. And here we are at 413 on a 10-year. That would be down 45, 46 basis points. So these are the way the numbers stand. I think the best way to look at year end here is the 210 spread. That spread right now, hovering at 68 basis points, is the widest in 4 years, basically January of 22. And the reason I find that so fascinating is, well, just look at the minutes to the last Fed meeting. Everybody's going in different directions. Many are worried about inflation. Many are talking about they do still see eases in 2026. If you put that together, what does it spell? Steepening yield curve. Joe, back to you.
All right, Rick, fantastic. Happy New Year. Let's bring in Steve Leisman, and I was just thinking about, I think it was the second Back to the Future. Steve, what was the one thing Marty McFly wanted if he could have from the past, or if he could bring it back to the past from the future, and it was like a race betting form where he knew the winners of every horse race. And think if we could get the Wall Street Journal headline on December 31st, and we could have that. Wouldn't that have been nice to know? Tariff jitters.
Yeah.
Stocks defy tariff jitters in 2025. There's no way you could have. That is the most non-consensus thought on what was going to happen. And they're saying it's partly AI, partly that the tariffs were, I don't know, taco or taken off or whatever. But for some reason, the market just shrugged it off, and the economy seemed to as well.
I think ultimately we'll see, Joe, in terms of the fourth quarter. I do think that the economy fared better, maybe not because of tariffs, but maybe in spite of the tariffs. I want to talk quickly about the jobless claims numbers, which Rick put a pox on my analysis here. But I will point out that the seasonals expect a lot of layoffs this week, and it may be, and we can't really answer this question until next month when we get the December jobs report, which is it could be that hiring was below what it was expected to be, and so layoffs would be lower. All that said, it's going to be hard to say we have a huge layoff problem, because if the numbers are wrong by 20, 25,000 or even 30,000, it would not suggest a huge number of layoffs. But this is a tricky time for seasonal layoffs. Rick also talked about those minutes yesterday, and what we learned in those minutes, Joe, was that it was a closer call than we thought, and suggested that maybe it was the Fed chair who brought it over the finish line, and that led our friend Stephen Stanley to conclude that, hey, Powell, despite everything that the chair would say about him, has been pretty dovish. Let me read you his analysis. He says, the fact that the FOMC eased is clear evidence that Chair Powell pushed for a cut. For all of President Trump's complaints about Powell, the objective reality is that Powell has been one of the more dovish policymakers. Now, okay, why does this even matter? It matters because of the question, is the next Fed chair going to be more dovish than the current Fed chair? And when you look at the market pricing, one of the fascinating things out there is that the market does not expect a new Fed chair to come in with, to mix a couple metaphors here, both rate cut guns blazing. Take a look at the trajectory of Fed fund futures down the road. We're going to go down the road here, feeling okay here. So take a look, and what you see is that we don't have much built in the way of cuts. Take a look. Maybe the April cut, maybe the April number shows that Powell does one more cut on his way out. The new person comes in, so we're looking at July, and there's one more cut. I didn't show it here, Joe, because it's very thin trading, but we can look out to December 2027, and the rate in the futures market right now is 3.11. So it is fascinating to me to look and see all this talk, and we do it. You know, this new guy could be too dovish. That is not the expectation built into market. So maybe when you're talking about the December 31st headline of the Wall Street Journal of 2026, it may be that new Fed chair defies odds or defies political pressure and keeps rates largely unchanged. Maybe 50 basis points of cut between now and then. And I am guessing that the next guy coming up has some thoughts on this, the very, very smart John Writing.
Yes, we're going to talk to him in a second. So I was just going to ask you if you can explain why a 0.5 point rise in the unemployment rate isn't necessarily caused by a slowing economy. We need to keep that in mind in the AI world and the immigration world and the participation rate world. And I mean, normally that would be very worrisome. And isn't there some, what's that stupid, there's like a rule or a law or something about a 0.5 point rise causes something, isn't there, Steve?
Yeah, there's the Psalm rule, Joe, you're talking about, which says we're in a recession. The trouble is, Joe, this is one of those classic the change versus the level arguments. And the change is worrisome. It's something to keep an eye on. Remember, the administration has policies that have led directly to unemployment for federal workers. That's an issue. You have these tariffs, and I think the tariffs have been an issue. If you look, for example, at small business hiring, in the ADP data, it's been an issue there.
We're at full employment, aren't we, Steve?
And,
basically, in the
well,
AI world, we're at full employment.
That's where I was going, Joe, is that despite all of those things, you get to a 4.6%, 4.5% unemployment rate, and over the long history trajectory of thinking about what the right number is here, you know, 4.6 has been considered to be below full employment or hotter than full employment.
That's
so
what I mean, yeah.
it's a worrisome change to a not very worrisome or concerning level.
Is Rick gone? Is that what you think, Rick, or is he gone already? Because we go to John.
You know what? I think the notion of anything kind of pre-COVID, pre-AI, pre-shaking up foreign policy, I think all of these issues make things like the Psalm rule a little bit obsolete. In the reasons, Joe, you really listed all of them. There's a lot of change going on. And, you know, bringing down the ranks of the employed by Washington, D.C., such a big employer, is that really a negative? Is productivity going to go hand in hand with less hire and less fire? All these are important issues. But I think the most important issue I'm looking at for 2026 is the conventional wisdom of the political class versus the reality of the markets, okay? And I guess part one of that would be that no matter what the Fed does with interest rates, no matter what the new chairman does with interest rates, it doesn't mean the long and hence mortgage rates are going to be affected. That's A. But B, the big story in the Journal today is what's going to happen with the dollar for 2026. And the argument is that the current administration wants a weaker dollar because it's great for business. It makes a much bigger difference on the deficit with China. But they're forgetting something. The biggest dynamic in the midterms, guys, is affordability. And a weaker dollar means that Joe Sixpack on Main Street his dollar doesn't go nearly as far on the imports coming into the country, and I think that is a big negative for a weaker dollar. So do you go the business side, the S&P 500, multinationals that are going to be happy about it, or do you think about Main Street that's going to be unhappy about it? Those are some of the big dynamics I think we're going to have to reckon with in 2026.
Great. All right, thank you, Rick and Steve Leisman. Let's bring in John Riding, Green Capital Chief Economic Advisor. You've been listening, John. How would you summarize what we're trying to figure out and everything else?
Well, I think both Rick and Steve made some very good points there. I've been flagging this issue, and I think we talked about it the last time I was on CNBC, that the rise in the unemployment rate has not been really due to a weakening economy. I mean, the GDP data over the last 4 quarters through the third quarter of last year's 2.3%. I don't think the economy is as strong as the third quarter 4.3% print suggested. If we look at the jobless claims data, they've been low throughout the year. So we're really not seeing a pickup in layoffs, which I think is where the first blow of economic weakening hits. What we have seen is very, very limited gross hires, new hires. And that has fallen to a large degree on a younger segment of the population. And I'm quite convinced by the thesis that what's happening here is that AI is proving to be a cheaper way of hiring new labor, as it were, than actually hiring people. A lot of entry-level jobs are being taken over by AI. We can debate how effective that is if we want. I've had my own negative experiences with some of the calling platforms at various companies, but nevertheless, I think that's what's happening. And so if you cut interest rates in an attempt to stimulate hiring, it's a little misguided because cutting interest rates lowers the wrong price. What you need to do is to effectively lower the price of labor to get new entrants into the labor force, which is what we need. But lowering interest rates lowers the cost of capital and potentially makes implementing these AI systems even cheaper. So I don't think the rise in the unemployment rate that we've seen is a particular sign of economic weakness, though I do disagree a little bit with Steve's point that the SOM rule, and we've used that rule for many years, has worked regardless of the level of the unemployment rate. We mustn't confuse. Recessions occur because of a downturn in economic activity, which is about a change in activity. But no, I don't think we're in a recession, and I do think that this lack of hiring is not addressable by cheaper money.
So, John, there have been periods in the past, I guess, you think about the age of the internet when it came on and what we had to do with all of our models about just about everything. And then I think about the pandemic and how everything we thought we had to sort of recalibrate old and fast rules. Couldn't AI just throw all the models out the window on how we assume anything? Are you smart enough to figure out how it's going to impact all these numbers that we look at and what effect that it could have?
No, we're not smart enough, and the AI isn't smart enough either. But what we have to do is to at least take a cautionary note from historical regularities. We have a picture of an economy which is relatively strong in terms of economic growth, output growth, somewhat soft in terms of increases in the labor input in both hours worked and in terms of hiring, and fairly robust in terms of profits. Now, to me, all of that speaks to productivity gains, and those productivity gains have been a factor in my mind that has enabled the economy to withstand the negative effect of tariffs on profit margins. Without those productivity gains, we probably would, in my opinion, have had a recession. So there is the plus side to that. But in the end, the question is, what is a recession? And we know the economic definition of a recession, but the common sense definition of recession, I think, looks more at the labor market. And I do think the rule, does point to a problem in the economy, of hiring people, of getting people into jobs. But we do know, on the other hand, from the job openings data, there's still plenty of jobs out there. There's roughly one job vacancy for each unemployed job seeker. And that's still, by historical standards, a relatively high level. So I'm not without hope looking to the outlook for 2026. And I do think that given profitability, the economy is going to grow. And with easy money that we have seen, I think we're going to have more of an inflation problem as well.
There's some tailwinds for economic growth, I would think, in your view, John. What do you think we'll do in terms of GDP for the year?
Well, there's a lot of tailwinds. We have the fiscal tailwind from the One Big Beautiful Bill and the tax refunds. We have monetary policy tailwind, because I do think monetary policy is accommodative. I disagree with the assessment that monetary policy is either restrictive or neutral. We only have to look at the price of gold, which is up 2/3 from when the Fed started cutting interest rates in September of 2024. And to my mind, restrictive monetary policy would not be accompanied by such a big move in precious metals prices. And there are other indicators as well, including the actual inflation rate. So those are two factors. So we're going to have plenty of nominal demand. That in my mind, that's what monetary policy establishes. I'm thinking we could be looking at 6% nominal GDP growth. The question is, how does that split between real growth and inflation? And I'm hopeful that productivity growth will be sufficiently strong, and given some of the slack we have in the labor market, that some people will be able to be drawn in, that we're going to see 3% real growth, but accompanying that also 3% inflation. For my mind, that's the real issue, which is inflation, because then we'll have completed 6 years without inflation being close to the Fed's 2% inflation target.
Right. Yeah. That's why it's called government work. It's close enough for government work, maybe. Too bad for the dollar, but John, we wish you a happy new year. If we could do Back to the Future, we'd have all this information already, but we can't. But we'll need you to try and interpret things throughout the year. We appreciate your time. Thanks, John.
Happy New Year, and see you in 2026.
Yep.
We're talking about big tailwinds.
Big tail, big butts. Yeah, that's the operative term.
Yeah, end of the year.
Mm-hmm.
All right, when we come back, we're going to talk about tech stocks. They outperformed this year with the NASDAQ up more than 21%. We'll take a look at potential opportunities for 2026 right after this.
Trump Media and Technology Group announcing plans to distribute a new digital token to its shareholders as part of its partnership with Crypto.com. Shareholders will receive one token for each share that they own. The company says the token may not be transferable and cannot be exchanged for cash. It doesn't represent an ownership interest in the company or any other entity, but the company says it anticipates token holders will receive various rewards periodically. It may include benefits or discounts tied to Trump media products such as Truth Social, Truth Plus, or Truth Predict. The company says additional details will be available in the new year.
All right, let's take a look at big tech stocks to watch as we head into 2026. Joining us right now is Dom Rizzo. He is T. Rowe Price portfolio manager. And Dom, thanks for coming in today.
Thanks for having me.
All right, before we start on this, you've got a pretty good record, and I'd like to point it out. You're the portfolio manager of the Global Technology Fund, and since you took over just over 3 years ago, the fund's at 34.1% annually. It's outperformed the benchmark by 13.3%. and liver peers by 26.1% cumulatively. You also run the technology ETF, and that is outperforming its closest comp to the triple Qs. It was up 25.2% versus 22% for the triple Qs. You've got 10.9 billion of assets under management. I think that was as of September 30th. So welcome. You've got a good track record. Let's hear what you have to think about this. Where do you think we're heading in 2026?
Look, you know, first off, on the track record, I'm very lucky to have a great team around me, and T. Rowe gives us so many great resources and the platform to be able to outperform for our clients, which is our goal. But some of that's lucky timing too, right? Started December 1st, 2022, the day after ChatGPT. But I think we have a good framework, linchpin technologies, innovating in secular growth markets with improving fundamentals at reasonable valuations, and we can use that to navigate all different markets responsibly for our clients.
The numbers have gotten a lot bigger since you stepped into this. You want to walk us through that?
Yeah, just let's look at the AI chip market, right? It was $45 billion in 2023. We think it's going to $500 billion in 2028 and upwards of $1 trillion in 2030. And if you take a step back and think about those numbers, the entire semiconductor market pre-ChatGPT was only $500 billion. So we've seen a real acceleration in the capital intensity of the hyperscalers as we've unlocked all these new revenue growth drivers for these companies.
What gets in the way of growing to the moon? What could trip things up?
Well, I think there's, the most common question I get on those numbers, right, is how do we pay for all this?
Right.
And I actually think there's plenty of dollars to go around. You look at the core hyperscalers business, they're accelerating. Search, which is under assault by ChatGPT, grew 15% year over year last quarter with Google. Meta's growing mid-20s. All of the hyperscalers cloud businesses are accelerating. And then we have the fastest growing privates in the world, right? We have OpenAI on a path to nearly 20 billion of ARR this year. We have Anthropic in a high single-digit billion ARR this year. But what trips us up is what always trips us up in productivity cycles is the capital markets, right? This is all reflexive. The capital markets remain open. I think we see continued spending. If they close for some external shock, then we can see a slowdown. But this is a fundamental acceleration of the core businesses of the most profitable companies.
Well, I told you about something that happened last week. You said that you could fit, but it's still 50% hallucination. I don't trust anything I get. If I had one word to describe AI, it's ego. And someone's doing stuff that gives me answers that never. So I asked ChatGPT last week, and I can't remember how I phrased the initial question, but it was basically who is favored to win the presidency in 2028. And I thought I mentioned Kalshi. It immediately came back and said Gavin Newsom is the front runner for 2028. And then I did say, I took a screenshot. Why did you cite Newsom first when Vance has higher numbers? And ChatGPT, whoever this is, I see it as a person who's very annoying. Yeah. Good catch. That's my slip. I should have led with a candidate with a higher implied probability, which is indeed J.D. Vance, like Gavin Newsom. The reason Newsom appeared first in my earlier reply is mostly because I was recalling examples from prior searches and older market mentions, rather than immediately checking the latest market leader. And that's just cool. And this looks like Sam Altman is back to the old tricks of Facebook and Twitter, pre-Elon Musk.
Well, look, I think there's a lot of things that go into these models to get these answers. And whenever I'm doing a question like that, I'll check with a couple, right? I'll check ChatGPT, I'll check Gemini.
It
I'll
was
check
32 on Kalshi
Yeah.
for Vance and 18 for Gavin Newsom. How did ChatGPT come up with Gavin Newsom?
Right. You know, the models come up with mysterious things. They're not. They're not.
But they always are mysterious in that way, never in the other way.
Joe, you're talking about the importance of the wisdom of crowds and prediction markets now, right? What is one of the most
Oh, I don't know if they're gonna be right.
Well, one of the most powerful combinations I think that we can have is when we have these models that are not serialistic in nature,
Yeah.
and combine them with the wisdoms of crowds and decentralization. Then it's really
I couldn't
powerful,
repeat
right?
this. I tried to repeat it because I don't want to say it. It did that. And it says, now it says JD.
Well, there we go.
Now it says Vance. Yeah.
Well, so look, I think the answers change from time to time, but if we go forward, I think this market is huge. I'll give you a quick example. Coding, right? There's 30 million coders in the world. Each cost $100,000.
Yeah.
$3 trillion of opportunity. If you get 10% productivity increase for them, that's $300 billion of revenue opportunity for the cloud code and those different uses.
Dom, thank you.
Thanks for the time, guys.
Squawk Box will be right back.
Stop it. Breaking on Squawk Box this morning. Jobless claims come in at 199,000. That was 21,000 below estimates. Metals getting hit again today. Silver down 8%. Platinum down about 9%. Nike is up 3% in the pre-market. CEO Elliott Hill bought more than 16,000 shares according to an SEC filing. We got 15 seconds. Wish everyone happy New Year. Happy safe
New Year, everybody.
New Year.
We're looking at a very strong year for the markets. More importantly, we hope you are looking at a very strong year for your families, for your friends, and for your own health.
It's amateur night.
Doing well.
It's amateur night.
It
We'll
is.
drink and drive.
We'll see you on Friday. Be careful and Happy New Year.
Good Wednesday morning and welcome to Squawk on the Street. I'm David Faber with Sarah Eisen. We're live from Post 9 at the New York Stock Exchange. Jim and Carl. Let's give you a look at futures as we get started with trading a half hour from now. It is the final trading day of 2025. Man, it went by fast, didn't it? We reversed a bit, perhaps after those jobless claims, but we are looking for a slightly higher focus. Let's get to our roadmap this morning. It does begin with those major averages. Of course, they are on track for another big year of gains as we wrap up 2025. Retail investors set to close out what's been a very strong year as well.
And tech leading the charge this year. We'll discuss what's ahead for the AI trade in 2026. Also today is Warren Buffett's last day at Berkshire Hathaway as CEO. Closer look at what's next for him, the company, and investors.
Let's start with the markets. We approached, I said it already, half hour from getting started with the last trading session of the year. Major indices are wrapping up another big year. It's double-digit gains. Of course, the NASDAQ, the largest of the big ones, up 21%. By the way, we have discussed this a number of times this week already. Foreign markets have also had incredibly strong returns. In fact, many stronger than our own, despite that very significant up year for the NASDAQ.
Yeah, looking at South Korea there and Taiwan. But I just focus on the U.S. for a second. You know, in early April, the mantra was sell America. I went back and looked at some of the headlines. You know, Bloomberg was really big on this. The real Trump trade is sell America. Turns out that did not work, at least when you look at U.S. stocks, when you look at U.S. bonds. Remember the 10-year yield started January around 480. We're down to where are we, 411, 412 right now? So buying U.S. bonds, buying U.S. stocks, it worked on the dollar. The dollar is set to cap off its weakest year in almost a decade, about 8 years on the U.S. dollar, and that could be lower interest rates, a number of cross currents and factors, questions about the Fed, for instance, but Sell America did not work. U.S. stocks roared. We have arguably, the best and most innovative companies when it comes to AI at the forefront. And it's interesting to look at who the biggest winners are of the year. It's not just AI. I mean, it is AI, a lot of AI adjacent. Western Digital, for instance, number 1, Micron, Seagate, top 3. But also some of the newcomers to the S&P 500, like a Robinhood, did very well. Warner Brothers, of course, at the center of the deal and the bidding war. Newmont on the gold price. So a number of themes in the market. Wrap it all up.
Yeah.
The U.S. had a good year.
No, it did. Without a doubt, it had a good year. Now, as I said, of course, any number of other markets had also good years. So if you had taken that advice and gone into some of the other markets, you wouldn't necessarily be worse off. But to your point, if you had been smart enough to buy at the lows, of course, following April 2nd and Liberation Day, you're up a lot more than just the 21% in the NASDAQ or the 17+% gain we see so far heading into today on the S&P.
And part of it is, you walk back some of the worst of the reciprocal tariffs, sure, but the other part is the economy defied the doomsayers. Remember all the Goldman Sachs and everybody raised their recession odds from like 20% to 40% or 60%, and we were going to see massive inflation. And guess what? The economy proved very resilient. And I think highlighted by the jobless claims number that we just got. Yes, it's seasonal. Yes, it's not necessarily consistent. But what has been consistent is that there's not a lot of stress in terms of firing in this jobs market. We just got a number showing that last week, less than 200,000 Americans filed for unemployment claims. That's one of the lowest numbers of the year. If you really were talking about a labor market that was under a lot of pressure, then you wouldn't see numbers like that. Companies would be laying off more workers. The big question mark, I think, that's really puzzling economists is we're seeing a rising unemployment rate at the same time where we're not. So it's the low hirings, low firings kind of economic environment, and that's continuing here into the new year.
Well, and that raises the question in terms of the impact that AI is starting to have in business. I think we can all agree we have yet to really see that impact. Yeah. We talk about it so much. Of course, we talk about it in the context of all of the invested capital and so much more yet to come in 26 and 27 in terms of the ability to ramp up all the different uses for AI in terms of agentics in particular and what the impact will be on employment. And it could be seismic. But right now, it's just, maybe I don't need to hire, or maybe I'm going to wait and see whether that additional hire I thought I might need, perhaps the productivity can be made up by the people I have right now using various things that are already available in terms of the AI tools.
That, and I think you also have to talk about the fact that labor supply picture looks very different after some of these moves on immigration, right? And that also creates a smaller pool
and that could explain a lot of the weakness that we've seen, the slowdown in hiring. You know, the Fed actually alluded to this fact that you and I talk about all the time, on AI impacting the labor market in the minutes, which were a good read from last meeting. I mean, it's totally stale because we're going to have a whole new crop of voters next year. But I did think what they said about AI was interesting. They said a number of participants noted that structural factors such as technological progress and higher productivity growth, possibly reflecting increasing use of AI, could boost economic growth without generating price pressures and could also damp job creation. And then that would be difficult in real time to determine the extent to which economic conditions reflect such cyclical factors, structural factors, as opposed to cyclical ones, which is basically just saying it might be hard for us to tell why the unemployment rate is rising if AI is starting to have a bigger impact.
Yeah, I think we're going to be talking about this a great deal in 2026, probably starting on Friday. But you know, we all listen and very closely to any number of the conference calls. I certainly try to listen, as I know you do, to some of the bigger thinkers when it comes to AI and what the impact's going to be on society, broadly speaking, and certainly on jobs. We just don't know, Sarah, whether there will be a significant dislocation that occurs once this technology truly does get into the enterprise in a significant way, and enterprises really understand how to use it, or will it be a long-term change in terms of we just don't need people anymore? And by the way, we haven't even begun to talk about robotics and the impact that conceivably is going to have.
I know, and yet you hear some of these technology experts. I'm thinking, you know, Arvind Krishna, who we talked to, the CEO of IBM, who's been an engineer his whole life, and saying these technological revolutions are job creators.
Right. I was finishing the thought with the dislocation followed by then potentially more jobs. I think few people disagree with the idea that there could be a period where there's going to be that dislocation where we could see fewer jobs, but the bigger question is ultimately the one you raised. And then many of the people who come on our air that we asked, the business leaders say, yeah, I'm optimistic that ultimately more jobs will be created.
Yeah, we're going to
empower
empower our people
with the internet,
to do
the
more.
same way it was with electricity and going back, you know.
Right. They were all net job creators, and they made workers more productive. The question is what happens in between them. Are we going to see the kind of rising pain, I think, in the labor market? And then what's the ultimate end game? Are we going to go to our utopian future that, you know, Elon Musk has talked about, where money doesn't matter and we won't need jobs? AI will just control
do everything, and then, but what are we going to do for no money? I mean, will there be a universal income in some way? And by the way, don't forget that Elon does talk about that world, but he does carve out a 10 to 15% chance still that it all comes to a big end.
Yeah.
And even listening to Eric Schmidt recently, I think he's done a number of these things, talking about it's going to be a great world of agentics and one agent. They're going to talk to each other, and it's going to become even more robust. But at some point, then they're going to talk to each other in a language we don't understand, and that's when you have to push the end button. Yes.
The stop button, if you can.
If you can.
Well, I think no doubt. I mean, just to bring it back to the markets, obviously the AI trade combined with an economy that did better than expected.
Yes.
Overall, and partly because of AI, but also partly because of the strength of the consumer and some of the policies put in place from the Trump administration and the Federal Reserve, which cut interest rates 3 times in the face of an economy that wasn't going into recession. All of that was very supportive for the markets. Third year in a row here of double-digit gains.
No doubt. And of course, something that was very supportive of the markets throughout the year, of course, has been AI, the spending, especially by the hyperscalers. Let's talk about some of that right now. Of course, in particular, 2026, what we can expect in terms of that spending. Rohit Kulkarni is Managing Director and Senior Research Analyst at Roth Capital Partners and joins us now. Rohit, good to have you. 2026 going to be more of the same when it comes to the big picture in terms of spend and return or expected return?
Thanks, David. Happy New Year's Eve to both you and Sarah. Yeah, I think it's more of the same, but I think the market sentiment is going to drive some of the commentary. I think market sentiment is on a razor's edge. If you think, you said NASDAQ was up 20%, but for the first time in several years, many caps are not outperforming NASDAQ. So there's a question to be answered. If you're spending hundreds of billions of dollars, when do the returns show up? How do the returns show up? And in the meanwhile, how does the transition play out? I think the first half is probably, we will need more answers to that. And by that, there's more explanation to do. I don't think we'll see revenue upside, but just cost discipline. Better cost discipline is what we expect, either through CapEx commentary or probably more layoffs at some of these large companies.
Right, but if we were to see, I mean, again, what we have not seen, what the market I think has been concerned about at least, or worried that we might is, all right, we've spent too much, we're gonna pull back. We haven't seen that. Do you expect in 2026 that we might?
That would be a very spooky thing for a large mega company to say. If they come out so early, it's almost a game of chicken. Who's going to be the first person to say that? I would be very surprised if either of the large hyperscalers would go out and say that we are taking a pause. Rather, in my opinion, there would be some extraneous factors like supply chain issues, power not being available at the right time at the right place. Such as that would be, quote-unquote, excuses that would hint that there is going to be a measured capex coming up in the pipeline. But in my opinion, I would just say no. It's going to be very hard for a company to say that.
So how do you know? How should shareholders know, Rohit, if these hyperscalers are spending too much? If Meta and Google and Amazon are spending correctly? I think Amazon's spending the most, and interestingly, its stock has underperformed most of the majors.
Yeah, absolutely. I think so. There are various different specific metrics and variables that investors will look at. With Amazon, we look at cloud computing. If it accelerates, probably they have a longer leash of spending. Google has probably demonstrated the best innovation skill set. Meta is in somewhat of a penalty box, given they have the only single kind of single leg pony, if you will, one-trick pony that they have. So I think each of these companies are measured on a different metric, but accelerating revenues in first half is something that everybody would want to see for them to continue to spend into second half of 26.
And what about this question that we're going to continue to ask, very much unclear whether we're going to get an answer, which is when are we going to start to see returns on all this invested capital? Right now, NVIDIA is the basic beneficiary of AI spend, and obviously the profits show that. But do you think in 2026 we start to see it spread beyond that and get a sense as to whether all this invested capital is going to generate a significant return?
I think I would just bring in OpenAI and Anthropic to this conversation, because I think those two companies would probably showcase that there is greater value and diversified value in enterprise and consumer applications that AI can bring to the table. So in the next 6 months, let's just say we are sitting here on June 30th, 2026, and both those companies have showcased similar acceleration and exponential revenue growth in annual recurring revenue, then AI trade is well on, and the larger companies will be more bullish to spend even more. I think we are almost those two companies are holding up the top 7 in a way from a sentiment standpoint.
Yeah, it's interesting, of course, they're both private companies, so it's harder to know sometimes. You know, I did ask Sam Altman the last time he joined us whether he would start to report things almost as a public company. He said they're considering it, given how important, to your point, it is for the broader market to understand sort of the underlying metrics in some of these companies.
Absolutely, and they have these commitments that are somewhat tied to the revenues of these larger companies, and there's essentially a lot on their two shoulders, almost like Lord of the Rings here. These are Sam and who's the other guy, Frodo, Anthropic and OpenAI.
Yeah, Dario Modi. Yeah.
So, what about like a CoreWeave, which has also been a huge beneficiary? Where does that sit? You know, have the easy gains been made for stocks like that?
I think CoreWeave is at the mercy of some of the larger companies, and the sentiment towards CoreWeave is almost on a razor's edge. From a stock standpoint, we like CoreWeave. At Roth Capital Partners, we put out CoreWeave as one of our top ideas in 26. The reason we think that is in the first half we see a lot of AI catalysts unfold, like NVIDIA GB300 clusters come online, some new data centers come online for CoreWeave, and the AI cloud demand continues to accelerate. So we like CoreWeave here, although longer term, they tend to be at the mercy of pricing, the mercy of supply chain, and how hyperscalers react to their capex. But in 26, we will be buyers of CoreWeave stock.
Rohit, thank you. Happy New Year to you.
Thank you. Thanks, Tim. Thanks, likewise.
When we return, how about Apple and AI? We'll explore what the company needs to do to win over investors in 2026. And then later this hour, former Federal Reserve Vice Chair Alan Blinder with his take on what to expect from the central bank in the new year. More Squawk on the Street coming up. Stay with us. The S&P 500 this year. A lot at stake for the company in 2026. AI at the center of it all. Our Stu Kovac has an interesting piece up right now on CNBC.com about that. He joins us from headquarters with more. And the question, I guess, Steve, is will they announce something on AI in 2026?
They say they are, and here's the thing, they kind of sat out artificial intelligence this year, right, Sarah? So they were supposed to have this big update to Siri. It was supposed to have all this AI stuff and all these kind of features. They were advertising months before the new year even began. They couldn't deliver it. They said it's going to come next year. And so now the way I've been thinking about it is what the investors need to watch. How does this drive sales for Apple? Because they've already said Apple Intelligence, it's a free system that you get if you have an iPhone 15 Pro or better. You get Apple Intelligence for free. So it has to be good enough, not just good, great enough to get people to want to go and upgrade their older iPhones for this new version of Siri and all the AI capabilities that come with it. There's a chance maybe they change their mind and start charging a subscription, $20 a month, like ChatGPT and all the other guys do. But it really seems like they want to make this part of the iPhone experience without charging on top of it and potentially adding to their services business. So that is the real thing. We had this thesis a year ago when I was sitting in this chair We were talking about all-time highs for Apple in anticipation of this new version of Siri coming out, and that it would drive so many sales. That obviously never materialized. So guys, the big thing to watch for is not only is it good, but is it so good it elicits a bunch of FOMO in the iPhone user base that they run out and buy that new phone, guys.
But are they going? Are they developing it in-house, or are they going to have to just license basically what's out there?
It's licensing.
In a way.
Yeah, it's licensing. So the way we think it's going to work, again, they're doing this in a much cheaper fashion than all the other AI companies. So it's likely going to be licensing either Anthropic or Google Gemini, or maybe all of them, and you get to choose your model. And instead of running on the cloud servers from those respective companies, they're going to be running on on Apple's private cloud. They don't use NVIDIA chips, David. They use the same chips that power MacBooks to do this private cloud. And it sounds like they're able to get those Gemini systems and other systems transferred over to that private cloud and enable all this stuff with Siri that they promised. By the time this guy launches, guys, it's going to be nearly 2 years since they first announced it that they're actually going to be able to ship it.
And does Tim Cook stay on board for the year for this transition? There's some rumblings now about succession.
So much talk about that. We were talking about that in Squawk Box earlier today. It's up to him when he wants to leave. There's no one screaming for his head, or no one serious screaming for his job or anything like that. Yes, there has been a huge exodus of top executives, including the head of artificial intelligence, the guy who was supposed to deliver AI this year and failed to do. They have a new leadership, a new team, a new reorg around this AI moment. So we'll see how that one goes, and then potentially talk about succession down the road. But all indications there is he's sticking around, at least for the first half of the year.
Okay, Steve, thank you. Steve Kovac back at HQ. As we count you down to the opening bell and the final trading session of 2025, let's give you a look at this year's biggest gainers on the NASDAQ. As you can see, it's the Western Dig Micron Seagate trade. What a benefit that has been to those who've held it throughout. Warner Brothers Discovery, of course, I think we've talked a bit about that. Never enough.
Yeah, you have more on it?
Not today. Most likely not today. But you can see, of course, the beneficiary of that.
I feel like that's not true.
Continued potential bidding war between Paramount. Of course, Netflix has a deal to acquire the studio and streaming. We're back after this. year's best performing S&P sectors. Communication services topping that list. You can see, of course, technology. Financials coming in at 14%, but when you look at the big cap names, the biggest banks, of course, the number would be far higher than that. This includes, obviously, a broader cross-section. And there are utilities as well. Of course, the AI trade figuring in that trade as well, given the power needs that we talk about so often. Opening bell coming up. Welcome back. Let's bring in senior markets commentator Mike Santoli. We count you down, of course, an opening bell about a minute from now. What are your thoughts here on this final trading day?
Market is, look, it's slowed down. It's kind of flattened out in the last 2 months, but within 1% of an all-time high. And I think one of the takeaways from the year, up 17%, is it's in a way a typical up year in the markets. Up years tend to be up well more than the average long-term return. It's very rare to get between 5 and 10% individual calendar year, but this was largely earnings supported. So you have up 17% in the S&P, earnings up like 13%, forward estimates are higher. So I think the market kind of stayed supported in that fashion even through the shocks. I'll also point out, your max drawdown this year in the S&P was greater than your year-to-date return because of that flash, near 20% drop in April.
All right, Mike, of course, going to stay with us throughout our the big board, the Downtown Alliance, New York City Council member Christopher Marte doing the honors. Over at the NASDAQ, it's the Times Square Alliance, of course, getting ready for the big ball drop tonight.
My children think they're staying up for it.
Have you informed them otherwise? Or? No.
I told them they could, but it's never easy.
Because you can do the fake one for kids. You do it at like 10 o'clock or something.
No, I don't like to lie to my kids. Guys, you mentioned the global stocks, and there's a good stat. MSCI World Index set for its biggest annual return in 6 years. So it really was an all-inclusive rally, not just in the U.S., where we saw really bright spots, like I mentioned, South Korea and Taiwan tied to AI, but even Europe, which is not an AI story, is a defense story.
FTSE was up 21%.
That's non-U.S. stocks versus U.S. stocks year to
That was
date.
the point I was making when we were talking at the open. I'm sorry, at the beginning of the show, Sarah. That yes, good year for the U.S., but Mike, a great year for so many others.
Yeah.
Brazil, Mexico, China,
Sure.
all outperforming the U.S.
And the way I think about it is, obviously, yeah, dollar was down and all that, but you definitely had this kind of unleashing of huge spending flows in various parts of the world economy. So you can talk about the tariff shock, but one thing it did do, along with a lot of the kind of, America First type of measures, is it got fiscal moving in Europe. And you got European defense spending, and you have all these other things, and as well as in Asia. And then, of course, you have the private sector unleashing of the capex boom. So there was this unlocking of a lot of latent spending and borrowing power that I do think is being registered in equities. You also have, look, a lot of central bank easing across the world. That's kind of coming to an end in many places. So maybe that's run its course. And I do think that's why people are wondering if it's going to be a little more of a blocking and tackling type environment this year. If you look, I keep talking about how the S&P, we're trading at these levels we first got to in late October. And if you just look at the kind of sideways move in the S&P 500, but what has outperformed and underperformed since the S&P first got to 6,900, and it has been this cyclical rotation. So it has been financials and transports, just as an example, each up like 5% as the S&P's been flat. And you had tech down a few percent. And you have software down even more than that. And you have Bitcoin down a lot more than that. And so this is exactly the type of rotation in favor of economically sensitive stuff that everyone sort of roots for, and everyone thinks makes sense, and everyone says it should be the market positioning for a quickening of the economy into next year. But this is kind of how it might feel, which is give or take, some mega caps working, some not, and the S&P maybe not being where it's at in terms of max upside.
Yeah, did you say the Russell up 12%?
And the Russell is part of that story as well. It has slightly outperformed over that period. Although interesting, the last couple of days, Russell kind of churning lower. I do think that one of the things that makes sense to anticipate at the beginning of every year, especially if it's been a strong year in markets, is a little bit of pent-up profit taking as people want to sell into a new tax year. And then what you get in late December is people front-running that very idea and selling some of the winners. That's been going on. But that's more just kind of short-term sort of tactical prudence.
Russell's about 3.5% off its highs.
Yeah.
You mentioned China, and I did read some excerpts of President Xi's New Year's speech, which he gives to the more than 1.3 billion people in China, and it struck a relatively optimistic tone, a tone that was reflected in the markets, which is we have a lot of challenges presented at us, but we met our growth target of 5%. Also touted some of the innovation economy and what's been going on with AI there. Didn't mention this, but clearly they thrived despite the tariffs with the U.S. Their trade surplus hit $1 trillion. And then just as far as market risks, he's done this many times in the past, but noted as well, he did use the speech to sort of reiterate the stance on Taiwan, said the historical trend for national reunification is unstoppable. As we look out to potential geopolitical risk there, keep in mind Taiwan Semi manufactures over 90% of the world's advanced chips, and that is an investor risk.
Yeah. It's funny, that takes us to Taiwan Semi, which also can take us to NVIDIA this morning, because to the extent there is news around NVIDIA, the South China Morning Post reporting, and again, it's in the source, but that ByteDance has placed a large order for those H200 chips that are now something that NVIDIA can sell in the Chinese market. As much as $14 billion is what they're talking about. And obviously, the manufacturer of those chips is Taiwan Semi as well. But that would be a big number, Mike, for NVIDIA, which has indicated the market itself, perhaps, for these chips might be as much as, let's call it 20 to 25 billion, or over half the market size. Jensen has talked about a $50 billion market.
Yeah, exactly. I mean, it is relevant even to NVIDIA, which is going to do, so the fiscal year for NVIDIA starts in a month. In that fiscal year, 2026, it's expected to have $320 billion in revenue, thereabouts,
half of it falling to free cash flow. So, you know, we can talk about, you know, whether in fact people are getting a little bit antsy about the pace of the spend. For the next few quarters, it feels locked in, and they're going to catch that much of it. What they do with the money, they only spent $5-6 billion in CapEx. It's remarkable. It's just a design company for the most part. Now, I don't know what, if that $14 billion order, what the split is, right? Taiwan Semi gets paid something
they get
for
paid
it,
something,
obviously.
but obviously the margins at NVIDIA, as we well know, are larger, even with the 25%. Don't forget that payment to the U.S. government.
That's right, exactly.
That has
So
to
it has
come
to be
off the
netted
top
out.
line, too.
What's interesting is that the market has been more subdued in what it's willing to pay for all those earnings. So it has like they call it like a 30 free cash flow multiple, or you know, under 30 earnings multiple, thereabouts. You know, for a company that's that dominant and growing that fast, it shows a little bit more of a sobriety about, you know, how far we're going to extrapolate these numbers. And I think that reflects where the AI trade is. We're not really in panic mode. It's not DeepSeek. It's not, oh no, the OpenAI you know, ecosystem is not going to have the money to spend. But it's also not just overpaying for everything. And it's been almost perfect in how the Mag 7 is just kind of traded off leadership, and some have lagged. Everyone loves to talk about, oh, 5 of the 7 Mag 7 stocks have underperformed the S&P. And that's true, but basically 6 of the 7 have outperformed the median stock, and they're up double digits, just that they haven't quite kept pace because Alphabet's been so strong, and even NVIDIA on a year-to-date basis.
They just haven't been Western Digital.
And then, of course, because Broadcom's not in there, and more or less is the same kind of a stock, and that's up huge.
Maybe you need to redraw Mag 7 for the
I
new year.
feel like, first of all, Mag 7, interestingly, got to be Mag 7 just because it was the 7th biggest at the time. And, you know, Broadcom's now bigger than 1 or 2, depending on the day. So it wasn't like FANG, where kind of Jim came up with the rubric and he was sort of identifying how the market was expressing this theme.
This was just the top 7.
This was
right?
at the
Including
time.
Tesla at that point, but to your point, Broadcom is larger than Tesla. Right?
And Tesla was always an odd fit, just because it wasn't really operating on the same dynamics. It wasn't like, oh, massively profitable and playing on the similar themes. But anyway, we'll see. I love the market sort that out. I don't need to some
Speaking
names
of the
and
market, like I listened to your interview with the mystery broker yesterday.
Yes,
Very
thank
interesting
you.
listening to him as well. Any takeaways?
We can now say his name is David Snyder.
Right,
He has a
Snyder.
firm called Journey One Advisors.
And you know, he was, I would say, cautious,
Absolutely,
certainly,
yes.
giving some warning signs over the longer term, not necessarily the next month,
That's
or
what it
even
was.
next year.
Big picture, he just feels as if, you know, we're in the latter phases of this secular bull market that began in 09. And I found that was a good bookend because I started to highlight his views in 09 when he had massive conviction that the low was in after the financial crisis. And even though the S&P was up 30%, that's actually the time you jump on a bull market, is when it's starting to rev higher. So he does believe that basically there's no escape from the elevated valuations. Like in terms of forward returns, you just can't kind of grow your way out of that. And this is his view. And I threw out all the counterpoints to him, like, oh, look, higher quality companies in the index, they're less cyclical than they used to be.
He's talking about concentration a lot as well.
This is
Even
what,
going
and
back
this
to
is
the
where I
1800s.
kind of agree with him,
Yeah.
which is everyone wishes for a less concentrated market, but it's almost impossible to see a less concentrated market in an up market. If we get to this hyper concentration, usually what happens is, it, just like happened in 2022, when the market goes down, the concentrated heavyweights underperform in a down market. And by the way, Jim Paulson's out with a piece today thinking that maybe tech can underperform next year. He thinks it's time. You have a lot of these conditions. And he points to these phases, even in the last few years, 2018 into 19, late 21 into 22, etc., where you did see tech underperformance, and it was during severe corrections. It wasn't, you know, as the market goes higher, you know, they pass the baton to the non-tech. So I think that was an interesting take. We don't know if it's right. And you're right. He was saying, look, usually you need financial conditions to tighten to have the reckoning. That doesn't seem like it's on the table next year, right? You do have the Fed leaning lower. You know, you do have corporate bond spreads. Maybe they've seen their tights, but they're not blowing out. There is a lot of money kind of flowing still, you know, just from all the accumulated wealth we have.
No doubt. All right, so from the no longer mystery broker, Mr. Snyder, to the greatest investor of all time, one Warren Buffett, whose last day as CEO of Berkshire is today. You followed his career,
Yeah, sure.
obviously, for such a long period of time. By the way, speaking of cash positions, pretty much an all-time high there. He's
Absolutely.
something. Just thoughts on Warren's retirement, so to speak?
His final year was reflective of one of his best lines, which is he feels he's playing a game where he's a hitter in baseball and there's no called strikes. Right? You can just let the pitches go by and there's no penalty, and he's let a lot of things go by. Clearly he does not see a lot of ripe opportunity for the big bold move to put the cash to work. My take on this transition has been for a while that once Greg Abel was named as the likely successor, that the Berkshire Hathaway of the future would be less about stock picking, would be less about the public equity portfolio, and most likely kind of accentuate the operating companies, buying other operating companies, rationalizing them, maybe centralizing them, and some of the restructuring that's gone on in management is sort of tilted in that direction. But in terms of Buffett, I mean, look, the stock Berkshire has underperformed this year to date a bit. It's up double digits, but it's underperformed for the last 3 years. Every other look-back period, it's massively beaten the S&P 500. So by that basis and by the growth of the book value, I do think that, he kind of goes out some degree on top.
I wonder if it becomes more heavily scrutinized as well, because Warren Buffett was always given the benefit of the doubt, even in deals like Kraft Heinz.
100% true, Sarah. And I also think there is a concern among people who own the stock, which is private companies, even public companies, there was a prestige to selling to Warren Buffett.
Right.
So he kind of had first look at a lot of opportunities and maybe got a better price on a lot of these businesses he bought 100% of, because that was an entrepreneur or a CEO's crowning achievement was Warren took me out, and now I'm a partner of Warren Buffett.
And no offense to Mr. Abel,
Absolutely.
but Warren Buffett was able to get deals from Goldman Sachs or GE or Bank of America at obviously very fraught times that nobody else could ever get.
That's right.
And will not be available, I would argue, most likely in the future to
Probably not. And I also wonder if under Abel they want to be that kind of investor of last resort in a crisis, the way, they didn't have to do that. Warren saw it as opportunistic, but also as a duty to do it.
Right.
So
And obviously there was benefits on all sides,
No doubt.
because you had the endorsement.
And he got the great deal all
That's
the way.
all the time.
Yeah.
Yeah, what's with Todd and one of the other deputies going to JP Morgan? That was kind of a joke.
I mean, it's a big job. It's unclear how much of the portfolio those guys, and Ted Wexler were even running, although Ted's staying, he'll be there. So we'll see. By the way, insurance stock's not been good this year, and that's a big part of the business. So that's part of the story too.
All right, Mike, thank you for all of it. Coming up, former Federal Reserve Vice Chair Alan Blinder as Wall Street braces for an eventful 2026 when it comes to Fed policy and Fed leadership. But first, let's check out how treasuries are faring this morning. We've seen them in a pretty tight range in recent days. There's been some buying of yields. That's going the other way today. The 10-year yield, 4.14, so nothing extreme here. The 2-year yield at just 3.46. No major economic data. We had Fed minutes yesterday. I pointed to potentially more cuts. We'll talk about it after the break. shares are up here in the early action of 1.5% after CEO Elliott Hill in a disclosure on about $1 million worth of the stock. It's interesting because Nike's actually had a rough year. Stock down about 18%, and it comes after the Apple CEO and longtime board member of Nike, Tim Cook, also bought nearly $3 million worth of shares. So some insider buying to report, potentially other investors jumping on the bandwagon. We'll be right back on Squawk on the Street. The latest Fed minutes show more disagreement inside the central bank, raising fresh questions about the policy path next year. Joining us now is former Federal Reserve Vice Chair and Princeton Professor Alan Blinder. In a Wall Street Journal op-ed from Monday, he argued that dissent in the Fed isn't a red flag, but a normal part of the decision-making process. It's good to see you, Alan. Actually, my takeaway on the Fed is on the minutes yesterday. I mean, I thought this was the money line. Most participants judged that further downward adjustments to the target range for the Fed funds rate would be appropriate if inflation declined over time as expected. That they're ready to cut more. Maybe they're going to pause for a little bit here, but they're in cutting mode still. What do you think?
Well, remember, most of those remarks were directed at the decision that was in front of them right then. Some of them were thinking ahead, that's for sure. They're all thinking ahead. But in terms of talking, the discussion tends to focus on the meeting at hand. These are the minutes of the meeting at hand, which they did decide by a 9-3 vote to cut 25 basis points. And most participants, as it said, agreed with that decision. But a non-trivial number did not agree with that decision. The vote, it depends who has the vote at each meeting, but the vote was closer to unanimity, I think, than the sentiment on the committee.
Agree. And now we get a new crop of voters next year. The regional Fed presidents, right, they change in terms of who votes. So how do we game out what happens next year on policy?
Well, I think it's very early to game out. I think the likelihood is that we're going to have some modest further cutting, but that likelihood is enshrouded in fog now. We're just coming out of the data fog that the government shutdown put us in. As you noted, I'm sure, a lot of the numbers that just came out recently, for example, on the CPI, had much more than the usual amount of guesswork in them. And we all took notice when Chairman Powell suggested that the jobs numbers would be revised down very significantly. So we're still coming through a data fog. We should be mostly out of it by the next Fed meeting, and I think it'll be an easier decision. I think. It depends, of course, what the new data show.
Yeah, I guess one of the other, obviously the other big question is who's going to be chair. And it sounds like what the White House is gearing up for is to announce that person, before end of January 31st, which is when the Stephen Myron governor comes off. How if you were inside the Fed, how would that go down? If they knew months in advance who the next chair would be, and if that person joined the Fed? I guess they would have to do that for all of them except for Waller, who's already a governor.
Yeah, that's correct. That, of course, depends on whether Myron is going to just vacate the seat or not. I think it'll go down very badly.
Well, it's up to the president, isn't it?
Oh, yes, I think so, yeah. You can say it's up to Myron, but yes, it's up to the president for sure. Absolutely right.
So what were you saying? You don't think that that's a good way to do it?
I think so to speak, the earlier the announcement, the worse. Because as soon as you announce the new Fed chair, the Fed is now a hydra-headed monster with two heads. And depending on how the new designated head behaves himself, they've all been hims that have been mentioned seriously, that could wreak havoc in terms of what the markets believe the Fed is going to do. Powell is still chairman. There's no indication he's going to resign early. That would be a shockaroo. He's still chairman until May, and we should have one chairman at a time, just as we have one president at a time.
They're all going to behave themselves. These are all very cordial economists / market experts. Maybe they'll be pushing harder for cuts, which is one of the job criteria, as we've heard from the president. But do you really expect it to be disruptive?
I half expect it. I'm worried. I don't know. You're right. There is a proper way to behave, and it's not that hard for the new chairman designate to figure out what the proper way to behave. But I'm looking at the history of Trump appointments all over the place, and it doesn't give me great confidence, frankly.
Alan, Sarah was reading earlier from the minutes, first or some references to AI and its impact on the job market. I would assume that this Fed, whatever it's going to look like next year, is going to have to grapple with that. What are your thoughts in terms of trying to figure that out, as difficult as it might be?
I think right now it's completely impossible. As far as anybody knows, and people are more knowledgeable about this than I am, the impact on jobs is almost completely trivial up to now. We're in the very, very early stages of the AI revolution, and there's no reason to think it'll stay trivial as the AI improves and spreads. AI is spreading across the economy much faster than any other innovation that we've seen, including even the internet, which spread quite quickly. And so it's quite possible that there'll be significant job impact in 2026. I think one of the more interesting things about this, and I use the verb I think, because I'm not sure I'm right. I'm definitely not sure I'm right. That the impact of AI on jobs is going to be much higher up the pecking order than the impact of the internet and most other innovations. That is in higher skilled reaches of the job market. I know at Princeton, and this is true all over the country, that the number of computer science majors, which had skyrocketed above economics, by the way, at Princeton and many other places, has fallen off sharply as the students in college now fear that when they finish in 1, 2, 3, 4 years, there aren't going to be the kind of jobs in computer science that they thought when they entered.
It's good color. Yeah, we'll see how that all shakes out. Thank you, Alan. Appreciate you joining us through the year, and
very
hope to see you
welcome.
soon. Happy New Year, Alan Blinder. We'll be right back on Talking the Street. Good Wednesday morning. Happy New Year. It's midnight in Seoul, where they are already ringing in 2026. Happy New Year in Asia. We're welcome to Spoke on the Street. I'm Sarah Eisen here with David Faber. We are live from Post 9 at the New York Stock Exchange. Carl Quintanilla is off this week. Coming up this hour, Mohammed El-Arian will join us with his big takeaway from a largely upbeat year for markets and a list of the key questions facing investors in 2026. Plus, the CEO of Applied Digital is with us. That stock up more than 200% this year and just announcing plans to spin out its cloud business. Nike, the third worst Dow stock this year, but CEO Elliott Hill is putting his money where his mouth is and betting big on a rebound. We will fill you in. But first, David, promise more charts, right?
Yes,
Charts
good.
of the year.
Please.
And charts that really defined, I think, some of the major macro themes of the year. So we talk a lot about affordability and how inflation still feels high and is straining household budgets, even though the top line numbers have been better than expected. One area that's really been a pain point, coffee prices, right? So one of my charts is the price of coffee. It's not just about tariffs. Actually, I would say if you read some of the research on this and talk to the analysts, it's mostly about the weather and supply shortages, in places like Brazil and Vietnam that were really a while ago, but they've hit the market with a lag, and that's why prices have gone up so much. The tariffs didn't help. certainly in places like Brazil, because that's where we import a lot of coffee from. But the president did announce some relief on the tariff front in places like beef and coffee. And then coffee prices did decline about 6% since he announced that, so that should be helpful. The other good news story here
But
is
that does
that,
give you a good sense.
Yeah.
I mean, that's a
It's been painful.
significant, significant expenditure increase, certainly.
Absolutely. I think the good news though is that supply has improved, and so with the lag in a few months, we should be looking at lower prices. But if you're feeling that at the grocery store, that is why. I mean, prices of coffee have shot up a lot. All right, the other big theme has to be the CapEx, the spend from the major hyperscaler tech companies. So we put all of them together in a bar chart of how much they're spending, just the numbers. You know, we always talk about how staggering the amounts are.
Yes.
This is the annual spend from the biggest spenders on building out our AI infrastructure. Amazon at the top, about $125 billion. If you add all these together, you get more than $400 billion.
Yeah, you get an enormous number, and that's the key to the market in so many ways. Now, Amazon, to be fair, remember, they do have an enormous retail business that they are still spending a good amount of CapEx on. You can't drive without seeing an Amazon truck. 5 years ago, that was not the case. I mean, they've spent and continue to spend on distribution centers, on robotics, and all sorts of things going in there that are not related necessarily to where the bulk of the spending is taking place, which of course is Amazon Web Services and obviously the cloud computing.
Sure, but it's spending, and it's boosting the economy,
yeah,
it's boosting CapEx, it's boosting the market, and when you look at some of these numbers, I mean, Meta in itself, which doesn't even have a cloud or enterprise business, spending $71 billion. You put it all together, and I was looking back, the financial crisis bailout, the TARP funds that were actually allocated to bailing out the auto sector and AIG and some of the banks, was in the realm of $450 billion. I mean, more was allocated for it, but just to give you a sense of the size and the scale of what is going on here and that what is driving this market and the economy. And then finally, and we've talked about this a lot, but I think it's going to be one of the key questions going into the new year, which is the unemployment rate is rising and GDP is rising. And this might have to do with AI, but this is unusual what you're seeing, right? Unemployment rate rises, and usually that's recessionary, that growth slows down. What's going on here where you're not seeing a ton of hiring, but growth is really strong? Part of it might be all the investment in AI and you know, what companies are
we
deciding
continue to
to
struggle
do.
with the idea of whether that investment is really generating any sort of significant return at this point. It's such early days when you talk to people who run large organizations. You know, it's not that easy to take an AI tool and share it within and have your employees use it appropriately and effectively to really increase efficiency. That will happen, but it's not clear that that really has happened yet.
Yes, agreed. And I think actually the pace of adoption, the speed of adoption, and the size of the payoffs all going to be key questions, but also this sort of high growth, high employment situation. How's the Fed going to deal with that? How are they going to figure out whether it's structural or cyclical? How are fiscal policymakers going to deal with that if we really have high employment on our hands at a time where the economy is booming? I mean, it's an unusual
It's really
kind of mix.
unusual. How are our politics going to deal with it when people don't have jobs conceivably, and yet the margins at
Correct.
corporations have never been higher?
That already Senator Bernie Sanders has been railing on this all over social media, and he wants to have a moratorium on data center building in this country.
Right. I mean, the idea, well, then it gets to this larger question of what is real progress? Is progress really when nobody has a job? I'm exaggerating. Or, you know, is that not necessarily something we want to see for our society? Regardless, it's coming, Sarah, because there is no stopping the AI race, so to speak, and certainly the idea that we're in a contest against China. So there are no real guardrails at this point, and it is moving as fast as they can. That is the leaders here.
And we want to beat China on this.
Conceivably, yeah.
Let's figure out what all this means for the markets and for the economy in the new year. Mohamed El-Arian joins us, Allianz's chief economic advisor. I mean, do you see a scenario, Mohamed, where we have even higher unemployment and higher growth at the same time? What does that look like?
I worry about that a great deal, and as you both discussed, it has political, social, and economic implications. Look, the decoupling of GDP growth from employment has been happening for a while, but it is accelerating. And it's accelerating because of innovation. And the way to deal with it is to have an AI adoption policy. You know, Sarah, David, we all talk about those working on AI. It's so exciting. What are the latest innovations? But as important is the issue of working with AI. And as yet, we do not have an adoption policy. And that's going to be really important to determine the mindsets of companies as they move forward.
So what does that mean for, I mean, mean, let's just start with the Fed, for instance, because I noted, it was mentioned in the minutes that it would be hard for them to tell whether it's a structural or cyclical change in jobs.
Yeah, and as you point out, this is complicating the Fed's task for two reasons. One, it forces them, which they haven't done yet, to take a strategic view. They're going to have to decide, is this a fundamentally productivity enhancing innovation or not? That's really important. I think it is. And if it is, then the speed limit for the economy goes up. They can bring rates down. The second issue is, what do you do when the two parts of your dual mandate starts decoupling even more? And that's what's going to happen moving forward. So it does complicate the Fed both from a short-term perspective, but critically, they've got to take a strategic view of what this means for the economy going forward.
So, maybe they'll do that, maybe they won't. What do you expect in terms of Fed policy? Since the market's now, at 2 cuts next year, the dot plot's at 1 cut, we don't know exactly who's going to be on the committee, there's a lot of question marks.
So a lot will depend on the new Fed chair, not in the sense of they can completely get what they want, but whether they can unify what is a deeply divided Fed committee. We saw very clearly from the minutes yesterday that the disagreements are deepening. There's more issues they disagree on, and they disagree to a greater extent on them. So it is going to be a very divided Fed. The new chair will have to assert their authority, and the best way to assert this authority is the way Yellen did it, Bernanke did it, Greenspan, is through economic expertise. That's the way you assert your authority on a divided Fed. Otherwise, it will be a very muddled middle sort of monetary policy.
I feel like, Mohammed, I'm curious to know how you think about these bigger issues and if you have any conclusions in terms of the rise of AI. It's such an early time right now, not to mention the rise as well of humanoids, the robots that we start to see being used in the earliest stages. I mean, the implications are enormous. How are you thinking about it? I know you talk to leaders of large organizations frequently, and what's your takeaway?
So first, how I think about it, I think it's very exciting. I think the innovations in AI, in robotics, in life sciences, and later on in quantum data, they're going to come together. And we are going to see some significant potential for massive productivity increases. It's going to change not just how we do things, but also what we do. So I'm excited about it. I'm also a little bit worried. I think it's an 80-20 proposition, 80 good, 20 bad, which means you have to risk manage the bad. Part of the bad is that the mindset of corporates may be too much on labor displacement and not enough on labor enhancement. I get courage from looking at the Accentures, at the Googles, at the Walmarts of the world that are thinking much more about labor enhancing than labor displacement. So my hope is that the mindset of corporation will move towards labor enhancing, that this will not be the social upheaval that a lot of people are worried about, and that we're going to be able to not only secure these productivity gains, but also distribute them widely.
And big picture stuff again for me, Mohammed, on the rise of China, the continued rise. We tried to sort of hurt their trade, didn't matter. $1 trillion, I think, or more in a surplus for that country in terms of their exports. Not to mention our own concerns about a budget deficit, or at least the worries, but not many people seemingly worried right now. What do we think 26 holds on both those fronts?
So you're right, we have a set of secular questions, and we just talked about an example of that, but we also have a whole host of unanswered questions from 2025 that are going to play out in 2026. One is what happened to the bond vigilantes. The stock market, the financial markets have been almost reckless in the way they've been funding AI-related budget deficits, debts. Will that continue? That's question number one. And then question number two is China. China has been able to absorb a 30% reduction in exports to the US by increasing exports to Europe and other parts of Asia. That's why they have this staggering $1 trillion trade surplus, but it's not a sustainable policy. You will see a reaction from Europe in particular. They don't want to be flooded by cheap Chinese products. So China needs to accelerate its restructuring. If it doesn't accelerate its domestic restructuring, then that's an added risk to the global economy.
We'll leave it there, Mohammed. Always really valuable to hear from you. Thank you very much. Happy New Year.
And to you, thank you.
Mohammed Al-Arian. We're just over 30 minutes here into the trading session. Here are some individual movers we're watching right now. Hyatt lowering its full-year outlook, citing cancellations and damage caused by Hurricane Melissa at its properties in Jamaica. The company now expects 7 of its properties in that country to remain closed until Q4 of next year. TikTok parent ByteDance reportedly planning to spend more than $14 billion on NVIDIA AI chips next year if the company is allowed to sell the H200 chips to China. That's according to a report in the South China Morning Post. NVIDIA is on pace to be the second best performer in the Magnificent Seven this year, behind just Alphabet. And then watch CSX shares today, the railroad, after one of the company's trains derailed in Kentucky overnight in a 30-car pileup that's forced officials to issue a shelter-in-place order. Ugly. One freight car caught fire and leaked liquid sulfur, releasing toxic gases. Officials saying the scene was brought under control and the shelter order was lifted after about 4 hours. What a mess. All right, here's our roadmap for the rest of the hour. Still ahead, the bifurcated economy. We'll talk to Mark Zandi from Moody's about the big macro divergences that he says will define the market in 2026.
Plus, a data center company, Applied Digital, has seen big gains, that is, for its stock this year. We're going to talk to its CEO, Wes Cummins, about that run, but also news this week from the company and a broader outlook for its cloud and digital services businesses.
And Robinhood and Coinbase finishing the year with very different returns for shareholders. And the nascent predictions market could be part of the reason why. That story and much more when Squawk on the Street comes right back on this final trading day of the year.
I'm here. Got warm in here, Jimmy. Today we'll be sitting in a new chair. I'm here. I'm here. Okay, we're at, oh, get ready. We don't hold here, we're in for some big drama today. Do you understand? Why you always come in here right at the right time, James? I've been watching traders for many years, and it's kind of like Superman. They show up and woo! Well, it's about being a market maker, baby. And one of my drinking glasses is gone. This could be an issue. Could be an issue. For right now, we won't let it be until I say so. So be thankful. Do you understand? I think they understand, Jim. They want you in a good mood, if I'm correct.
Welcome back. Applied Digital outlining a plan to spin out its cloud business aiming to streamline its strategies and AI infrastructure company.
I'm going to be sitting into a kitchen chair.
Cloud services from the company's rapidly
oh, much better.
Footprint. You can see the shares, of course, been very strong.
Randy!
Joining us now exclusively is the company's chairman and CEO, Wes Cummins. Wes, good to have you back. I want to start off on this deal. It was announced a couple of days ago, and then kind of move more broadly in terms of the overall ecosystem. But you say by separating the accelerated compute platform from
I'm here.
and development business, you're going to allow.
I'm here.
But I thought you're selling to the same customer. Are you not? And if you are, then why bother?
Hey, watch your mouth, punk.
But actually,
We don't need that kind of talk around here. It's bad enough we have to listen to you the way you treat Carl.
And ascertained as winners over the past couple of years. We think some of that can continue to build over the last month and a half.
Yeah.
2026 with some of those companies the industry's benefiting.
Where is that, Keith? I mean, what corners of the market are you looking at?
Oh, God.
Sure, you can find those in every sector. Again, that of course leads to a more selective, questioning and examination of the fundamentals of some of the equities and sectors within the marketplace. We found some of those in industrials. We found some in healthcare.
Liar.
We've seen parts of financial really outperform over the past several months as well. There are pockets of outperformance over the past, particularly over the past month and a half, but even over the course of the year, they haven't been in the Mag 7 or in any way associated with that.
Where?
Those are spaces we feel like have the momentum, perhaps, going into 2026.
Ooh, look at that.
Outperform.
OCG.
What happens with the Mag 7 and the expectation
I'm
of
telling you
the
what.
AI infrastructure build out to continue into next year. So that's where we're looking in order to position our clients out.
If this market wants to be bullish, we'll bullish breakout here at the triple bottom. Do you understand? So as I prepare my belch for this morning, I look at this morning until noon. I'll trade the lotto on the SPY, and we'll be looking at the 685s, the 685 strikes, and they're right now at $1.16. And we're going to gather five. The 685s. I don't know how he does it, but he comes in and he's got this little niche. It's called. It goes a little like this. For my name is Washboardjim. I am the founder and the thinking strategist behind the Sneaky Snake trading strategy, where I talk about chart patterns, moving averages, and not being a homosexual. So these were at 116. They went all the way to 127. We had a 1, 2, 3 fall, counting the wicks. If we do have any homosexuals in here, it's all right. I have nothing against you. I've always wanted to kiss a man. We're sitting here at the Thinking Strategist Corporation conference table, and I pointed out to my Sneaky Snake followers the 1, 2, 3, 4 thinking strategy. where we have a unum, oneum, two bits, and a freebus. Now these are all the day low, pre-market lows on a quad bottom. Now it's not a pure quad bottom, but it is a wiki quad bottom. And almost a pure triple bottom. So we have a resistance to break, which you can see that right there, right? Say yes. Jim, my grandma took the trade with you and she got in at 116. It's at 129 and she's got to go downtown and play some bingo. Do you think she should sell it now? Well, I would suggest this is called my beach trade for the retiree. You get in and out of the trade and you're off to the beach. So yes, I think you made a very attractive trade right there, young lady. Of course. 116, yes. Now they're at 133. Now you're at the orb. Let's go, baby. Lazy grace. Everybody leaving? We're not 127. Nvidia. All I want her to do is when we make love is just talk stocks. Nvidia, Epper. OCG, Randy. I'm going to walk into the kitchen. For some reason, I got something on. Coffee. It'll probably be warm by the time I get in there. I've got my beach trade out of the way. Slash ES looks pretty good also. Kind of setting up. The 685s are now at $1.35 from 116. It's all right. Watch and learn. We're at 140, 139, 140, there it is. Ladies and gentlemen, let's give Washboardjim a standing ovation. Standing ovation, please. $1.37. Nancy's in there on the shitter. I'd ask her to get me a little bit of coffee. But then when I do that, I always have to... Nancy, will you please wash your hands first before you get my coffee? She got to where she doesn't wash her hands anymore. And leaving all these stains around the doors and the light sockets and shit. Don't know what to do about it. Ever since that fall last year, she's just not been the same. Nancy's the only woman I'd ever let walk over me, besides Vegas. Woo! Oh my God. Randy, please. Dial 867-5309 before you do that. I'd be talking to the wife. Honey, please. I'm too nervous to even do dishes anymore. As I walk into the kitchen to get my coffee, I'll be making a few short steps. I'll be looking down at the cracks of the floor and saying, what will be my next trade? Will it be the SPX? Now, it is trying to make a business decision if it wants to break resistance or if it wants to pull back. We'll go get my coffee. Keep losing. Damn, man. What have I got to do? Okay, as we pull back, now this is what I'm going to say. This is step 3. We've had the pullback for Unum, 2 bits, and freebie. So we could end up down here for the third time for the reversal of the rest of the day. Or we can stop right here at this head and shoulders and start to build ground to break out of the snake. Now we do have a falling wedge. This is the SPX. Today is the 31st. U.S. gasoline inventories of 548 million barrels build versus 200 million, or 2 million build estimated. I don't think these guys can go by the numbers. I really don't. Here comes that coffee dude.
Awesome stuff, Alex. We're seeing Google trading just on the line to the upside at the moment. 313 and change. Really appreciate it. I'll talk to you a little bit later on. Let's trade it now with Tammy.
Can we talk to NVIDIA, please? I'll slip you a $5,000 check if you say NVIDIA live on YouTube, on my YouTube channel. All you gotta do is say NVIDIA when we're talking about it. And that'll be the key for the stock to go ahead and break out. And I'll get all the inside traders to go ahead and buy it at that point. Right when you say NVIDIA, and then I'll say NVIDIA, and that'll be the time to sell it.
So we've bounced now. You're risking 107 to make 393.
So the game plan is when we get ready to trade NVIDIA, is that when she gets on during the interview here today, we'll get to talking about it and she'll say NVIDIA, and that'll be the go sign to buy it, no matter wherever you are. We're going to try to get it down here right around to 188.18. 188.17. So we'll get that all arranged, and I'll speak to Nancy here and see if she can get that bill signed. Yes, Nancy Pelosi in. This is her thinking strategist for the sneaky snake trading strategy. I'd like to talk to her about a position that I'm getting ready to buy, and I want to make sure that all the legal paperwork is ready. Yes, we're going to fill that form out right now. Okay. Good, we'll have it bought by noon, and you'll call it out by 3. Okay, very good. Still a little higher than what we want, but
the first to find out what's shaping early market action. Check, Options Corner, Futures Focus, Technical Analysis, Morning Movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
That's right.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
God. Marley.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest
Why is that?
live analysis, breaking news, and sharp trade ideas.
Sounds to me like a scam.
With shows built for action, we break it all down in real time.
Okay, prepare ye.
Accuracy and precision.
I think one of them. I just got to go here. Ladies and gentlemen, we came to the shoulder for the right time, for the second time, right now. And we just down kind of snuck below it. This could be a double bottom, a clean double bottom with a higher low. Yep. We're down to the fallen wedge at 68.74. So loading gate, aisle number 7. Passengers, we'll be accepting passengers in about 45 minutes. Maybe a little sooner here. This could be a 15-minute wait. Position yourself. Randy? Double bottom, higher low. It's happening much faster than I anticipated. God dang, what happened here? Okay, just stop it. Where's that? Look at that big breakout on SPX. Okay. There, man, what's the deal here? Despise.
Being sold to China going into next year, 2 million chips have already been ordered. Think about that. At $27,000 per chip, Sam, that's $54 billion in new revenue. Remember what Jensen Huang said in his last
It's a lot of
earnings
money.
call. That's all gravy. That's all extra. coming into next year. So big news. The news Taiwan 7 was hired early this morning based on they need to up production of these chips. So this China news, very underappreciated by the markets, but significant going into next year, not only for NVIDIA, but for the U.S. government that's going to get 25% of that.
Yeah, exactly. They get a cut in this as well. I mean, I was saying that to KG earlier. I mean, there's something sort of in there for everybody right now, perhaps just not Beijing, because, what it wants is not always what Chinese companies want, as we can see through this story. Kevin, thank you so much for that. I'll check in with you a little bit later, but let's check in on how global markets closed out 2025. Europe was mostly low on the final session. The German DAX wrapping up trading yesterday with a strong finish for the year. Traders in London and Paris shutting up shop early today for New Year's Eve. Both markets were down fractionally, as we can see here. Defense stocks was a bright spot, though, on the day in the region. And over in Asia, trading thin on the ground with the Nikkei and the Kospi already out of action. Both markets wrapping up 2025 with solid gains, particularly in South Korea, thanks to the AI
internet
trading.
issues.
Traders in Hong Kong also got an early mark today. The Hang Seng Index closed down lower. China's blue chip CSI 300 index also declined, and that was despite China ending the year on a more upbeat note. Official PMI data showing factory activity returning to expansion in November for the first time since March. Non-manufacturing, which tracks services and construction, also climbing out of contraction there. The strong
Having a little bit of issues with you today, honey. I can't have that. Sorry. Sometimes a little bit of peace will do you good. I get here listening to that stupid trade ideas. Blah 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 blah. My neck would be so sore by the end of the day. SPY's below my support level here. It doesn't need to be like this. $102. The 685's at 102. and now. And now. Come on, baby. I think you know what to do. If you don't know what to do, don't do it at all. Okay. He's trying his best. $96. You need like a, get back up to the 63 EMA. Hello, Washboardjim. This is part of my trading strategy here at the Sneaky Snake Trading Strategy, where we talk about the 1, 2, 3 setup. I'm going to show you that 1, 2, 3 setup here for free. All you got to do is hit that like button and tell me how wonderful I am. Just say it once. That way they won't think I put you up to it. So we have a first down right here is at the UNIP. Now this is in dog. Ooh, what's going on here? Well, we're not there yet. So maybe I had got an early dip on this sucker. There it is right there. That'd be the 1, 2, 3 setup. Oh, I've seen him talk about this before. Yes. Now we just need a good rebound. I got in a little bit too early. It could have bought the dip there, and I'd been okay with that. As long as we hold that triple bottom. 1, 2 bits, and a free bits. Jim, I used to sit in the back row, and now I'm sitting in the front row, and I wanted to ask you a question today. And thanks for your genius attitude there, but is that not a fallen wedge that you're looking at? It most certainly is, my child. There you go. It's not a very big one. It's not a very open mouth one. It is an open mouth one, but it is a fallen wedge. There is a squeeze. This could go on for hours upon hours upon hours upon hours. But we are now at the beginning of the setup at the 1, 2, 3. So we just have to see if you want to trade with me. And I have the 685s at 98 cents. And right now they're at 91. Could buy another 10. And that would cut my price in half. It would bring me down to a very, if I can get it at 91, Ooh, man. There it is right there. For one of them. We don't know how he does it, but he does do it. He needs to go in there and get his water. Oh, there's 88 cents. I'm still in these suckers. Oh, now I gotta change my whole seating arrangement around. Yesterday, I was sitting around here with the gang and we were talking about our chairs. One thing you can tell about a man is the chair that he sits in. I had this old leather chair that sat next to my underwear. I'm the only one that ever cared. I'm gonna have to add to this trade one more time. I retired my chair last night for the last time. I'm gonna miss my old chair. It's the only thing that I let rub my underwear. That old chair's held a few smiles. Oh God, man. And she drops one more time. Oh no. I think I'm stuck. We're still at 85, 685. We're at 73 cents. And we'll add another 10 here. Maybe even 20. But adding now would be kind of dangerous. But it could be a cycle that could be finished. Cents, the 685s. Come on, Ethel. 71. Give me 71 cents. Please give me 71 more cents. Bring this thing down. There it is. Thank you very much. I need you to hold your ground. Yeah, you're right. You heard that. 71 cents. Prime washboard Jim. Some people say that I sound like Elvis, but I have to keep telling them people that he was a good friend of mine, and he just said thank you very much. '98 and '71. '98 and '71. Oh, fellas, are we having a little bit of fun? Oh, look how close I am to my support level on /ES. I mean, Jim, is it getting better than that? No, it don't. Look at the lotto on the SPX. Let me see. We got the 685s, and we need to look at the SPX here, please. This could be very, very, very tremendous payoff here. How did June 5th of 2026 get pushed? That's a good question. This is not the... Oh, it is. Okay. We are now looking at the 6890s strikes on the... Nope. Yep, on the SPX. The 6890 strikes. $68.90 on the strike. There we go. 68. Okay, got that down. They're at 330. Right now they're at 340. Looking out at 82. Box. Straight down knife. Thinking we're going to break out of this wedge, but I'm not sure. I think this market's very confused. I really do. Their accuracy's not been that good, but they carry on like they're the best, and they're not. Here's 6.8. Here we go. We're back at 320. I keep seeing myself sitting on that beach. And I will be back. I never did go get my coffee, so it's going to have a... I hate doing it twice. Need a little breakout so I can make out. Make out. Woo, Jim! $3.20. 68.90s for the lotto for today. A little risky, I'd say, but the setup there, just kind of, we failed it once, the wedge here. But we can come back up and rub up against the 50 again if we break this 21 where we are right now. Right now I'm up $20 contract. And I have 3 of them. $960 investment with 3 contracts. Around $60. That'll pay for my meal tonight. Less than 2 minutes. Oh, now see, here we are back down to 320. 310. Probably couldn't get it for 310 now. 320. I better walk away for a second. I think it's the best thing to do. Oh no, what did I do this here? Oh gosh, what was that? Excuse you. It was very unprofessional. Do you understand? Someone say yes. Please. Who wants to be the fool that says yes? $3. Yeah, I'm gonna have to sing here. I learned a lot in the year of 1925. I learned that jackrabbits and crows don't kind of get along very well. I also learned that you want to keep Nancy out of the still. She's got a big bottle of Valiums. You gotta leave her alone. I want this market to break out like it's done and done before. Well, I'm Washboardjim with a sneaky snake trading strategy, where I talk about chart patterns, moving averages, and being in the now. I had one of my fans sitting out there in Discord saying, Jim, you ought to break out a song. This SPX, it's been a while and it ain't been broke out. It's been way too long. So I jumped into 68.90s at $3.20. It dropped to $3. I said, what the fuck, I ain't gonna have enough money to pay my rent. How did a rock star like you, Washboardjim, become a day trader when you had it made? Women throwing bras and underwear up on stage. Now you're in a cage. about every song in the book. I just need this little SPX to run up and do a J hook. Break out of the snake, for heaven's sakes. Whoa, Washboardjim with a sneaky snake trading strategy. Just waiting for the breakout. It does look pretty though, I'm telling you. On the TTM chart, it looks very pretty. Well, get yourself tucked ready at the radio station. Some of my calls might be the last trade I ever make. You'll never ever see me and ever hear of me ever again. For I am Washboardjim. I might have 20 more years left in my life. So I'm thinking about maybe a little spot in the Caribbean on a sanded beach where I don't have to worry about ice or snow. That's where the place I'd like to go. Come on, baby. We're starting to break out. Jimmy likes. The Songs of an Angel. I got a few of them. Angel, my birthday's coming up. Would you do me a favor? Shave your legs. Every time I wake up in the morning, I have a rash. Just shave them legs. Whoa. He still has his songwriting techniques. It's winter, no shaving. Oh gosh, I'm sitting here still at 320, 330. I want to see 380. I'll be right back. I'll go get my coffee redone again. Big C likes my music. There's $3.60. Jim, how do you recognize them patterns before they break out? Well, I put this on different time frames and different pattern setups. And when I brought it to the sneaky snake trading strategy, where it's called the TTM squeeze, I noticed something that kind of I didn't see on the other 1 minute time frames. And that looked to me like a horizontal line of a resistance level with higher lows proceeding into an ascending triangle at the bottom. So that is very bullish in my opinion. Now we've just run up and hit the 63, which was my target. Should I sell here at $3.70 for $50 a contract? $60 a contract maybe? Or should I maybe ride this out and see if we can get $200 to $300 a contract? Let's have a vote. Should Jim hold? Make $200 more a contract? Or should he sell? And make just a small amount? The question is asked. Jim, I've been watching back here in the back of the room, and I was overhearing what the teacher said to you the other day, and I thought that was very inappropriate. And if you need someone to sit by you, you can come sit by me in the back of the class. Okay, come on. Yeah, what she said was very inappropriate. I agree. We're at the 63. Time for a position to sell at. Okay.
Cents, and then 70. I don't think I think the bottom's in on this, and I think on top of it, and I'm not a big fundamental trader. I understand that there are people that are paid a lot more than me to let's just say cumulatively, there are rooms of people that are looking at this, but I think that, again, reward to risk, and I like the upside here in Intel. I didn't think maybe in the middle of the year I'd be talking about that, but
I certainly am right now.
Yeah, and looking at this example, looks like it's a call debit
It could be
spread,
the
Mike.
stock next year.
Similar risk where you're risking that $40 like you were in Uber, but a little bit more
Get
max
20%.
reward. That risk reward 6.5 to 1 as structured here. Similar style swing breakout setup. Looking for that
Here it
trigger
comes.
price around 38.26. But we'll take a look at the chart here as well as we pull back in Rick. So very different looking chart, Rick, when you look at the performance in Intel.
Let's not talk about it, Rick. Let's talk about this
in
breakout
second
here.
half of the year. We actually looked at this one just a couple
We're
of
at the
days
63
ago.
EMA.
Talk to us about the
It
setup
just
here.
wants to
Yeah,
break
an
out right now,
interesting,
real bad.
situation here. We've got an upward channel type
And if
shape.
it does
and,
decide to, I
oftentimes
have my
after you
finger
some notable gap up,
right
like
over
here
here. I'm
with
up
when we saw
$30 a
this,
contract.
involvement
I could
from
sell right
various
now.
areas into Intel. We had this low point that came after the gap. Then our subsequent lows lined up here. You can duplicate that line and put
You
it
gotta
across
pay for
the
dinner.
highs. It matched up
two
decently. What
nights.
you're looking for is kind of a line of best fit as best you can do it here.
After taxes.
Sometimes the subjectivity of this kind of analysis kind of irritates people because it's not very exact, but what you're looking for is general ranges and general areas of potential support and resistance, especially when they line up with other areas. For example, 36, our darker green line here, you can see
Might not
this
pay
was
for the
a
tip.
high point and then subsequent low points repeatedly. It was then high points after a breakdown. Now it's become supportive. Now it lines up
No,
with the
it
trend line
could've
here.
just
So
right there.
you kind of see that now 36, as we kind
370.
of put these two things together, stands out even more as a potential area like the make or break point. Just below that,
That'd
we
be
have
one
our
good
double
meal
bottom
with a
here,
real
your
healthy tip.
33, our notable low point during our rally. That's once again where the bulls held the line. So now if we were to look at our moving averages here to get a feel for the trajectory of the price activity, for the most part converging kind of sideways here, we can see our moving averages are clustered together right around that lower trend line between about 36 to 37. RSI moving to the upside. Downward trend line has been broken, much like price, but we have not had the crossover above the 50 midline that would suggest more of a bullish shift. Finally, when we look at volume profile here, you can see that the shaded areas line up with the heavy trading activity zones here. 37, 36 to 38 really would be a better way to describe it.
380.
That's where the heavy area is. If we were to break above, the next notable
Starting to
point
break out of the
here, you can see
63.
that the smaller peak near 40 is the obvious heavy trading area. Then if we were to move lower right here, 30,
Looking
30,
extremely
50 or
good
so,
to
30,
me.
30, 50. That's the last holdout before we would be looking to perhaps even fill that gap or test that gap.
Good stuff, Rick. And we go to the final stock here of the big three, and we bring back in Mike, and we're talking
Yeah, I don't wanna quite get
Oxy,
me a
which is
chair
only
yet.
fitting, I feel like, Mike, on Warren Buffett's last day that we go to one of his recent
This one's gonna
favorites in
have
the
to
last
go,
couple
though.
of years.
Hate to
That's
say
kind
it.
of why I did it.
We're at 390.
You know, I've been bearish on energy for, I don't know, the last 3-4 months. At some point, there's enough going on in the world, and I don't like to look at things, in trying to predict the future.
380.
This is a stock that probably should be higher, and there's a lot of fundamentals behind it. There's a lot of things that can go on in the world, and we're at a value point. If we're wrong, we're wrong. Remember, I'm a trader, not an investor. This is not investment type of advice. But I think that we have a shot to the upside in energy in general, and I was looking at Oxy, and I think that that's probably a good place to start.
And we'll get that trade in just a second. I want to get the chart here on this one. As he mentioned, it's been kind of in the dumps here. Rick, what are you looking at in Oxy's chart?
Yeah, so when we look at this one in particular, we find ourselves near another important low point that we just rallied, 39, our green line here. That's about where we bottomed out. Backtrack over here. That was also where we kind of hit the bottoms after the crazy turbulence from the tariff news event shock happened. That's when we started to solidify here. Now on the verge of breaking out above our channel. Our moving averages that we follow are starting to shift upward. The faster ones are starting to outpace the the slower ones. Meanwhile, RSI has made a bullish crossover above the 50 midline. So look for the 63 EMA, the quarterly, near 42 to be potential resistance. Finally, our volume profile shows the point of control right here, around 42.60 or so, above 43. Things thin out, then they pick up again, notably here near 46.
Good stuff. All right, guys, we got to run. We wish you a happy new year, Mike Shore, and we can't wait to talk to you again soon. Director of Trading Education at Prosper Trading Academy. Happy New Year to you as well, Mr. Ducat, lead market technician here for the Schwab Network. We're going to take a short break. When we get back, it's time for the 360 Spotlight. We're going to be looking at small caps right after this.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
So we got the 685s. We're approaching a resistance line. I think this is the 63. I just don't like that color. Doesn't seem like that red. That's what it says it is. What the fuck's the problem?
What stands out to you as these catalysts for potentially, more potential strong performance for small caps?
Yes, I think it's important to remember that small caps are economically sensitive. So to be positive on the asset class, you have to be positive on the U.S. economy. We at Impacts are. Consensus expects GDP next year to be about 2%. We think GDP will actually surprise to the upside, and a lot of that is based off the fiscal stimulus that's coming. We're going to see a very strong tax refund season that's going to benefit middle and lower income consumers who are inclined to spend those refunds. We're also going to see continued monetary stimulus. We've already had some Fed cuts over the past year. We expect additional cuts, and so both of those are going to buoy the U.S. economy, and by definition, buoy small caps, and we expect very strong earnings growth. So, for example, the Russell 2000 will likely see 50% plus year-over-year earnings growth. A little less for the quality small caps, but definitely a positive year is our expectation.
Nathan, talk to me a little bit about that kind of strategy, and as a small cap investor, the importance of finding the right themes, the right names. We always are citing and quoting the Russell as that benchmark for small caps, but such a big index, so many companies that are, not necessarily cash flow positive or earnings positive. What approach do you take, when trying to outperform within small caps?
Yeah, excellent point. So the Russell 2000 is a lower quality index. Anywhere between 30 and 35% of the companies don't make money. And so investors really need to be selective. The strategy that I manage emphasizes higher quality small caps. So we're looking for profitable companies with good balance sheets, strong management teams, companies that will deliver very strong free cash flow growth in the future.
Okay.
That's not saying that companies that don't make money, there aren't pockets of opportunity. One of those pockets is likely within biotech. We've seen biotech really surge higher over the last 3 to 6 months. We expect that theme to continue. But the areas that have caught the attention of some investors, whether they be quantum computing stocks, Bitcoin mining companies, those are companies we tend to steer away from.
I saw in your notes you got a couple maybe stock picks within that pharmaceutical biotech world, maybe for our viewers to take a look at. You want to go through those?
Sure. So Pacira Biosciences is very much a definition of a value stock where investors are focused on short-term headwinds related to their lead drug, Exparel, which is a non-opioid pain relief product used primarily in knee surgery. This helps physicians and patients avoid using opioids to the extent that may be addictive. That drug is facing some generic patent challenges from a few competitors. As a result, Pacira trades at 7 times earnings, still is delivering very strong free cash flow growth, has a couple other products on the market, and one very exciting gene therapy product in the clinic that we expect over time investors will come to appreciate to a greater extent. Maybe the last point on Pacira, the management team is relatively new in terms of their CEO. He's doing an excellent job with respect to capital allocation. Right now there's $200 million available for share repurchases, which is almost 20% of the market cap of the company. So we think in time, these shares have material upside.
I also noticed you're looking at SI-BONE, and maybe not a company I was familiar with before, but maybe I should be because I got to the age where I've discovered the SI joint pain just recently in 2025. Walk us through this one.
Yeah, so it's a very interesting company. We've known this company and management for a while. As you alluded to, the SI joint is a big driver of lower back pain. That's an issue that affects many folks out there.
Yeah.
They have, over the past few years, expanded their product offering from just addressing the SI joint and fusing that joint to relieve pain to broadening out the product portfolio. This story right now, I think, is very timely. There's incredible fundamental momentum in the business. We're seeing surgeon adoption in the high 20% rates on a year-over-year basis. It's a 20% plus revenue grower, in our opinion, has just broken over to free cash flow positive. We think earnings inflect higher in the out years. And maybe just the last point on SI-BONE, I've been looking at medical device stocks for the better part of the last 25 years.
Are we going to break?
In my view, many of the great
That's the question.
Med tech companies are eventually acquired. I don't
685s.
think would be surprising for a company as high quality as SI-BONE.
Really
Sorry,
good stuff.
I have to break it. We have the 685s here, and this is a fallen wedge that I called out, and we're breaking out. Now we're starting to lean more above the bullish part of it, which I like talking these through, kind of let you know how I feel. Like I'm feeling bullish because we're holding above the 9, but I'm also in between of a thought of saying, okay, we're squeezing Also, too, so we're at a resistance level. It's, if you ever hiked, you know, it's like going up and you'll have a little part of the mountain where it has a higher incline than it will the rest. And once you get up that little higher incline, you go, oh, I'm exhausted. Then you just kind of walk it off, and then you get to another peak. And we're at that peak right now. It's called a double top. So I've got these at 98 and 71. I can make a decision and sell these right now and be green, be happy, and walk away, knowing that we are at a resistance level. I can sit here and watch it drop on me and regret not selling it, going, shit. I could have got out of these things at 92 cents. Earlier I sold some at 97. So I got to say, okay, what am I going to do? So I go ahead and take my profit. Got no wind to hold 'em, no wind to fold 'em, no wind to walk away, no wind to run. You gotta keep your eyes on the table before the dealing's done. Take my profit and run. It's a double top. It's a double top. It's an exit idea from the sneaky, snaky strategy. Minnesota at 92. What to do? What a hell of a wall I have. It's a double top. I mean, that's pretty heavy. A double top at the 63. Then you got the VWAP all by itself. And these are all heavy hitters. Because if that breaks, all those other ones, there ain't nothing up there else to break. Those are heavy hitters. Always clean. Jim's Talent Show, may I help you? If you can sit here and listen to this next song for the next 5 minutes, you'll be the next contestant to be on the National Talent Show of the Washboardjim Knuckle Up, Buckle Up. So let's see what you can do. Call and it started to fall. I don't live too far from the battlefield mall. Hey, listen to it. Where are you? Are you still here? I was going to ask you to give me your phone number. Well, that didn't work out too good. Who the hell's that? Man, I was just calling this guy on a call center, and he was acting real strange like. Okay. Still ain't got that coffee yet. God. Well, that coffee's in the kitchen, in the microwave, getting warmed up, trying to get it saved. This'll be the 5th time I'll try to warm it up. It's just a little bit of coffee in a coffee cup. I remember one time I was sitting, I'm still in this trade. One time I was sitting just like this, making beer with my guitar, and we were in the we're getting ready to go into a different stage of the beer making process where you boil your wort. That's the grain. And then you measure the alcohol or the sugar that's in it. And what was I thinking? Oh yeah, and I had my guitar, and we were in between doing something. It was on a cold winter day. And so I started writing a song about boiling your wort. And it took me like 5 minutes to write that thing down. Boom. Hit record. So you kind of like stocks. You sit here and you trade and trade. And I made 30 here, I made 70 here, I made 200 and made 1,000 here, I made 1,200 here. I lost 500 here, I made... Oh gosh, Jim, these are up $3 a contract and I got 10 of them. I'm up $3,000 in a minute. Sell them. So I think I've only known one or two. All the people I played baseball with that could, man, you could say, okay, you're ready. You're ready to run. He's going to have a base hit. Almost every time you get up there on, you get up on plate, you get ready. That's true with fist fighting. I only knew one guy that was, out of all the guys I knew that could fight, only one of them I wouldn't want to fight. And only out of one bud, I've only smoked one bud in my life that I'll probably never get that potent ever again. I'm still in this sucker. Let this sit for a second. I'll go get my coffee. I've been talking about this for a long time. I think that's what I need. Changed it. Jenny Horny, are you up? No, my name's Jenny Horny. Oh, my name's George. We're at 320 now. We're back to even on it. Should have bought the dip on that baby. But I have the SPY's got to break to 63 or here. I think this is where it's got to do something. Because we're forming another triangle. This is the third tip. It's really where it's got to do something. Better I get out. But I know if I get out, I'll regret it. There, see it go? You see why I say the third time? Okay, you hit your double top, and we pull back. Now these things are, I'm looking real nice in these things because I bought double down there at 71 cents. We're at 95. I mean, and these 68 90s at 320 or 390. So, like $4. I'm gonna make a business decision. Now, where are we going next? Ladies and gentlemen, my name's Marilyn Monroe. We're gonna try to jump the VWAP, baby. That's right. If we can maintain the 63 EMA, we just might get to the VWAP on the SPY. You don't believe me? Say it. Say it. One of them, 2 bits, and a freebie. Higher lows, barely. Boom. He doesn't know what to do. He's at 370. Should he sell? He's up $60 a contract. He could sell right now and be up $60 a contract. I first started trading, $160, $180 extra every day. Plus after paying taxes. End of the week, you're up extra $500 or $600, $700 spending money.
All this is going to contribute in addition to the Azure cloud revenue stream.
As a portfolio manager, you're making the tough decisions on where companies like Microsoft can fit in a portfolio. I imagine it fits in there, but how do you approach it relative maybe to your peers and where
That's
you
a
guys
good
see
question.
Microsoft as a member of any portfolios you guys are structuring?
Yeah, we own it in our AI thematic portfolio, AIFD. I think it is, as Ron mentioned, has a very strong position in the corporate AI adoption. And really, I think that is the key. Corporate adoption has lagged thus far in AI, and I think it's the next leg of growth. And Microsoft, if you looked at their Ignite conference last month, they really have the strategy in place to unlock AI spend. They're not necessarily focused at the model layer. They're focused on what they call the scaffolding, the permissioning, the security, agent
I'll be right back.
And really unlock, company data and make AI useful for more companies. So I think they're really in a place to drive widespread AI adoption.
2026 is going to be a good
Back
year.
to the Copilot discussion. How important is it not only for Microsoft, but really all of these AI software makers that a company like Microsoft is able to use their Copilot system as sort of a pilot, no pun intended, for so many of these big companies that move a little bit slower to kind of dip their toes in AI?
It's going to be a major factor. It's going to impact the entire competitive landscape when it comes to enterprise AI. And it's not just the Copilot capabilities, using generative AI to enhance, say, productivity and streamline workflows and so forth. It's also about transitioning to agentic AI. And this is where I see Microsoft having, again, an edge in terms of being able to use Copilot to transition these enterprise customers to use what is characterized as agent mode. That is,
we're about there.
Copilot
Spy.
more than as a chatbot, but to also use it as an autonomous worker that can execute many intricate business workflows. And so this is going to be a major pivot in 26. And this is where Microsoft can not only strengthen its
This jumps up another 50
use
cents.
Copilot to again expand its influence and revenue streams across the enterprise AI realm.
Ron Westfall, Evan Fagans, I appreciate both you guys taking the time here on New Year's Eve. I wish you guys a happy new year, and we'll catch up soon. That's going to do it for us, though, today here on Trading 360. I'm Alex Coffey. I wish everyone a happy new year. We'll see you in 2026.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
That's right.
get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family.
We're at the orb.
Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I programmed that 20 years ago.
Jim's really been there to answer
I have been there.
I ever have. Makes a huge difference. When
All these years.
Cares.
It's a fact.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are. This is Schwab Network, and we're so glad you're with us. It's noontime right here on the floor of the New York Stock Exchange at the corner of Wall and Broad, and it is the final trading day of 2025. Amid for my friend Diane King Hall, taking a look at markets. Many traders are here to sing their traditional Wait Till the Sun Shines Nelly song that they sing every year. So it's a busy day here on Wall Street, and a fun one at that. In the meantime, it's a full day of trading and down arrows once again. What Santa Claus rally for the third year in a row? The Santa Claus rally is not showing itself. No jingle bells just yet. The S&P 500 down 0.25% at 68.80 right now. The Dow Jones Industrial Average down 0.25% at 48,244. The Nasdaq is down 62 points at 25,400, and the Russell losing about 0.4%. On the roadmap of today's show, we'll have example options trades for Palantir. And our team from Likefolio, well, they're going to take a look at Apple, the latest sentiment data there for Apple. And of course, we'll break down AMD. That's a winner, up about 80% this year. A lot of names to watch, and it's been a winning year on Wall Street. The S&P's up about 17%, the Nasdaq up about 21%. Right? Though we're not hitting highs this moment, I think people will take that anytime. In the meantime, we've got the roadmap for today's show, the trading action. I bring my co-host, Kevin Hanks, joining us live from the CBOE, and Joe Mazzola, head trading derivative strategist at Charles Schwab. Great to see you both. Thank you so much. Of course, we're going to be taking a look throughout this hour on some of the biggest stories of this past year, and think about what you remember or what stands out. Kevin, I'll start with you and your thoughts.
Hello, Joe, and hello, Nicole. You know, I think this is a year that we're going to think about big things, right? The year started off strong. April and that area around early spring was pretty horrific and violent in terms of the sell-off, and then a big, long recovery into the spring and into the end of the year as, you know, the overall AI trade just completely took over this market. But, I mean, you can think of this year in terms of NVIDIA, right? NVIDIA started the year strong. In the April sell-off got down to the mid-80s and then hit $215, $212, $215 near the end of the year, and now a bit softer into the end of the year, though one of the stocks up today. And even though all 11 sectors of the S&P 500 are down right now, I mean, many of them, communication services up 32.9%, information technology up 24.3%, industrials 18.7%, financials 14.1%. It's still going to be an incredible year for overall stocks in general, Nicole and Joe.
Yeah, third year in a row, right? I mean, who would have thunk it? And, you know, what does next year bring? I mean, a lot of folks are scratching their heads, but in the meantime, with all the things that were thrown at this market, the resiliency was unbelievable. Joe Mazzoli, your thoughts?
Yeah, I think it's the year of the retail trader. Kevin mentioned what happened in April with the Liberation Day and how markets kind of fell out of bed. And it did seem at that point, markets can go one of two directions. If you continue to go down, or you might see some buyers step in, and that's what we saw. And what I think was most telling to me was that who led that charge, and that was the retail trader. It took a while for institutions to kind of get involved in that buying game. They probably got in around late May, but it goes back to that time in the market is better than timing the market, right? Because by purchasing in April, they get that nice little leg up before the rally continued to broaden in May. And I think it's been the story all year. The story all year has been retail buys the dip, they sell the rip, and I think that is something that has done well for that cohort. When we look at the stocks that have been the most heavily bought throughout the course of the year, the Palantir being
we're at the wall.
You would put Broadcom up on that list, and we always talk about the Mag 7, but look at the Mag 7 year to date, 26%. Those are great numbers, and I think anybody would consider that a good year. But going back to last year, it was 60%. Going back to the year before that, it was about 105% in the Mag 7 year to date. So you're seeing broadening, and if you think about the stocks that did the best this year, SanDisk is number one. Anything that had to do with storage, whether it was Micron in chips or whether it was Western Digital in terms of storage and SanDisk in terms of storage, those stocks did extremely well, up 200-300%, 500% for SanDisk. So there was a broadening.
If you're not in the trade, give it a few minutes.
Where investors were looking to allocate those funds, and I think that was important. And I think we've looked at other sectors that have performed very well too as of late. Financials being one. Where you've really started to see a breakout. A lot of that I think has to do with the steepening of the yield curve and what we've seen recently. But metals, they've done extremely well. Materials, these are all different sectors that had you asked me at the beginning of the year, would I think that
if it wants to hold, it'll hold here.
Some of those sectors would perform as well as they had. Probably not in April. I wish I could have told you back in April, to go ahead and buy silver and gold and buy gold. But at the same time, it was really interesting.
Look, I mean, every time we've had a dip over the last 3 years, if you were buying, you were a winner.
Yeah, you were.
Think about what happened back in COVID, too. I mean, and Liberation Day, and, the people who are willing to take that risk and buy on those dips really do very well and have done so over decades. Sometimes you have to wait, though, and so that's the risk part that's involved. A name like NVIDIA has had a nice run. It's gone from $86 on the low end in the spring at that April Liberation Day up to $212, right now at $189. And we've had good news even today on NVIDIA. Ship more chips to China and ByteDance's interest and such. When you think about NVIDIA and the AI trade, Kevin, is NVIDIA still the leader? We know Dan Ives said it's NVIDIA's world and everybody else is just paying rent.
There's so many things going on with NVIDIA right now, it's hard to get them in. We could just do the NVIDIA show every day. We
right here.
Actually rename Fast Market, but today, the orders coming in, 2 million chips ordered from China. Remember, Jensen Huang said in his last earnings call, anything from China is gravy. That's all extra. 2 million chips at $27,000 per chip is $54 billion in revenue. That's additional. The calls for Taiwan Semi to up production, that makes it all legit.
It's a lot of money.
NVIDIA's going to make a lot of money off this. So's the United States government. That gets 25% of that. So, yeah, another good day for NVIDIA as these, the deal with China and selling H200 chips is going to be just all extra. So everything that we thought about NVIDIA, add another big 2 million chips they're going to sell to China onto that, Nicole.
All right. I mean, look, NVIDIA has been an incredible performer, and plenty of people still pick it for the long run as the leader. What do you think, Joe Mazzola, when you think about NVIDIA and the AI trade, that it's the revolution, and we also have that trickling out effect, to AI, to software, to energy and data centers and all that. Joe?
I'm really interested to see in 2026 that trickle-out effect, as you mentioned, as we move from just the chip makers and the hyperscalers. What's the next leg, right? We've already talked about the energy needs for these companies and what that's meant for stocks like GE Vernova this year, which is up triple digits. I mean, there have been some real solid winners outside of what you just one would consider the chip makers and even the hyperscalers. So it's broadening out. I know Dan Ives has mentioned some of the things that he's looking for in 2026 would be, how does that affect things like cybersecurity, and what could be some of the winners there? What happens as we move into some of the CRMs as they find a way to really monetize and use AI as a way to expand their revenue base. So I think 2026 could be the year of that expansion as we're looking for other leaders. Now, does that mean that NVIDIA is not going to benefit from that? Of course not. But what it does mean is that there might be other opportunities. NVIDIA is up 35% on the year. That's fantastic. However, when you look at it relative to the Mag 7, it's not number one. That would be Google Alphabet, which is up 65% on the year. So NVIDIA is not even in the top 50 right now in terms of year-to-date performance within the S&P 500. So there are other opportunities out there. I think to a certain extent, they're all going to be derivatives of that NVIDIA chip play, and it's just a matter of kind of determining where those winners are going forward.
And look, people are looking not only to tech. I mean, they come on and they recommend that you've got to be in tech. That's where the growth is and all that, but they're looking to dividend payers and other strategies. I mean, for example, had you been in metals, that would have been a big story, right? I mean, had you been in gold and silver, you would have had an incredible year, the best year since 1979. Let's talk a little bit about that. We had major selling on Monday. It wasn't expected today. David Dietz actually said he's advising clients to get out of silver today, which is up 142% this year. Let's hear some of your thoughts. Joe, I'll start with you.
Yeah, you wonder how much of that silver are people that are kind of doing the momentum trade, right? They haven't really seen much of the volatility in Bitcoin as of late, after it pulled back from its high. So where's that next momentum trade? I think probably some of that matriculated into silver after really gapped up post October. These moves are not traditional moves that you tend to see in the metals.
Well, no, if you don't take these moves,
at play as opposed to just an investment.
You get stuck in them.
That's fine. I mean, it's been a fantastic opportunity for investors these last few months, and for traders specifically. And I think you need to be nimble when you are trading that. Gold's a different story. I mean, gold, you can still talk about the demand from the central banks, and that doesn't seem to be slowing down anytime soon. So it does seem like there's a natural base that's forming there that will provide some support. I think silver will be a volatile play going forward, and if anything, if you are somebody who likes that high volatility trade, it's a decent space to be in.
I mean, there's a lot of things that were driving gold, really. I mean, it's always the safe haven, the debasement trade when people are looking away from the U.S. dollar, which has lost some of its value, the lower rate environment, the central bank buying, all of those things help to push gold up above 4,500 a troy ounce. Not to say it's going to do the same next year, but it could still move higher. I don't know. Kevin, what are your thoughts on some of the metals that really across the board have hit some sort of record this year?
Yeah, I'm an old futures trader. And so I understand the fact that for the second time this week, the CME has raised margin levels. The margin requirement is going up at the end of the day today for going forward. So twice this week, the CME has raised margin levels, and that, if you're trading on leverage or if you're trading on margin, you're going to have to make an adjustment. That's what you're seeing again today, and all they're doing is identifying the amount of risk that's in these contracts. And so they have run, you mentioned silver's run, gold's run. These are historic movements in these futures. And is it lower interest rates? Is it central bank buying? It's probably a little bit of all of them. But is it risk off? But, you know, I've seen this before in my career, and what can really halt a rally are the identification of more riskier markets and simple margins. It'll cost more to hold those positions. Nicole and Joe?
I think you're the only one who has that story in depth. I mean, that's worth a segment by itself, because you're there and you're there with the traders. You just talked about the CME raising those margin levels again. You know, people, there's going to be risk, there's going to be short covering, there are going to be margin calls, those kinds of things, because there's been so much heavy trading in the metals. But what a year it has been, and way better than Bitcoin. If we had Michael Saylor and Peter Schiff here, they could have it out, but what a year. All right, up next, it's our bull bear debate, and we're going to take a look at Palantir, which is one of the winners of 2025 Fast Market. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back, Fast Market, right here on Schwab Network. We're checking out Palantir. Palantir has been one of Wall Street's standout stocks.
It sure has.
Up around 140%, far outpacing the rest of the tech sector. AI
for lunch.
demand and accelerating commercial revenue has helped drive the gains, although its valuation is elevated with a forward PE ratio of 180. Okay. So let's bring our co-hosts back in. Kevin Hanks and Joe Mazzola joining me right now. Just 180. I mean, you know, what's the big deal? You know,
yeah, what's the big deal
around,
here?
what, 17?
What's your problem with it, nigga?
180. Kevin, your thoughts? What an incredible run. It's gone from $63 up to $207.
What are we doing?
It's had this incredible year. It's up 138%. Your thoughts?
No problem.
Identifying patterns deep within data sets gives them a unique niche in government, in intelligence, in getting data and helping governments and military make decisions. This is a unique company. It's got unique price activity because it's a unique company.
Oh, I bet.
What they've been able to do is take that government approach to AI and put it to U.S. commercial use.
Moving back
That's
up.
when this stock went crazy this year. And I don't know how big it can get or how popular it can get. But it seems like their growth numbers, 121% in terms of revenue that year over year, it's pretty spectacular, Nicole and Joe. And to look at this company, now their valuation, concentration of ownership among owners, that's a problem, or it's a worrisome. But boy, this company continues to outperform.
I don't know what I was thinking there.
That is uniquely confident in their abilities, guys.
You know, and just having the government backing and those contracts sort of makes people believe, because there's a lot of questions about different parts of Palantir. There's some that the people understand fully, and then there's sort of this vague section that I have guests come on and say, don't fully understand Palantir sometimes, but I do know that the contracts are good, and that makes me feel better. Joe, your thoughts on Palantir?
Yeah.
I mean, Kevin mentioned the revenue growth. I mean, earnings growth over 120% as well, too. So, you know, the stock has rallied in line with the earnings growth, and
very good. Can't complain about that.
Lowers valuations to a certain extent. Yeah, the forward PE is very high, so you're not buying this stock because you're looking for a value. You're buying it because you recognize that right now 50% of the revenue comes from development, and if they're able to broaden that revenue base in 2026 to become more of a commercial type entity, where there is broader adoption of its products, this company has a chance to do very, very well with very solid margins. I think that's the key. I think the key is finding additional buyers for their products outside the government, and the government does provide a nice little backstop. But you do want to see a little bit more diversity in terms of its revenue base. I think that is something that investors will be keen on going forward.
And you're going to have some example trades here, guys. So let's start it off. Joe, I think you're going to start us off with the trade here. Right now, it's just below $180.
Yeah, and it's basically been vacillating around this 180 area for the last couple of weeks now. We got up to just shy of 200, kind of pulled back, and I think 175 has been a bit of a support level. We're basically just a little bit above that. We're right at that 50-day moving average, which we bounced off a couple times. And so in this type of trade, what I'm looking at is selling the 175 put. I'm doing it out in the weekly options with the January 30th expiration, which are, if you look at that, it keeps you outside of the earnings. So the earnings are expected for February 2nd. I think when I price this up, you can get about $6 for it, maybe a little bit higher now in terms of the premium that you would receive. But here's the idea. The idea is this: in essence, is about a 30-day trade. If I can sell this put, taking about a 3.5% yield on the shares, and it really is a way for investors who've been waiting for a pullback. There's two different ways you can do this, Nicole and Kevin. You can put a limit order out there to buy 100 shares at 175, and you're basically locking up $17,500 to do so while you're waiting for that pullback to occur. Or you can sell a put, in this example, a cash secured put. You take in about $6 of premium, which is $600, which, when you look at that relative to the break-even price, which is 175 minus this $6, takes you down to 169. Like I said, that's about a 3.5% yield that you're collecting while you're waiting for the stock to pull back. And if the stock doesn't pull back, you keep that premium. If it drops below that 175 price, remember your break-even's all the way down at 169. Now, could it get below that? Absolutely it could. But it's one of those things to where you kind of need to think about, this is, like I said, that second level of AI. Now, a lot of that growth has already occurred in 2025, as I mentioned, and as Kevin mentioned, stocks up over 100% on the year. But at the same time, if you believe in the story, if you believe in the fact that they are going to diversify their revenue source, and there will be additional clients and customers for them going forward, then you have an opportunity to buy this quite a bit below its all-time high price, and you have a chance to collect your credit while you're waiting for that to occur.
Joe, when I look at a trade like this, and you mentioned the ability to either buy it at 175 or sell it, or sell at 175, put it $6. This stock could sell off $9 and you would still be profitable on this trade. And so looking at something like this, sure, there's risk on the downside, right? You have to be mentally and financially prepared for risk below $169. That would be your entry to this trade. But anyone who owns a share of Palantir has that kind of risk as well. So this is one that a lot of institutions use this strategy. And oh, by the way, wherever it's trading, as you get closer to that January 30th expiration, you can buy that in and extend duration on another, further out in the option. And when you do that, you can change your strike. So there's, it seems like it's a very one-sided trade, but it really isn't, because this is, I would call it neutral to bullish on this play, because of the fact, what if nothing happens, right? That's always the test on a trade like this. And if nothing happens, this trade is profitable. Now, my trade is similar in nature because it also is profitable if nothing happens. And that is the short call vertical above the market. I looked at the chart, Joe, and we have to be realistic about a stock like Palantir. It has closed now. If it closes today, it'll be about $1.50, maybe $2.50 below its 50-day moving average. Now, the 200-day moving average is around right around $150. So it's playing and trading right around that 50-day moving average. So what I did, I went a little shorter duration on this trade. I looked only out till January 9th, so just out till next Friday, and I sold the 190, the 187.5, 197.5 short call vertical. I collected about $1.30. It's trading probably a dime less than that now, closer to $1.20 as the stock has eased down with the rest of the market. But this is a high probability short call vertical that is collecting theta, that is risk defined. And so this is just one of those trades that you can, because you're selling the call vertical, Joe, as you know, you can take the other side of maybe long deltas you have via stock or whatever in Palantir, but because you're selling no call vertical and not just a short call, you keep your unlimited upside exposure, Joe. Your thoughts?
I mean, I don't want to confuse the viewers here because it looks like we got a long call vertical on the risk analysis there. But, the idea is this, is that if you don't get a lot of movement to the upside, actually you can get a decent amount of movement to the upside in this example, as long as it doesn't get above that 187.5 plus the credit you're collecting that $1.30, that's your break even. So if you don't expect a lot of movement between now and which is basically a 1 week trade, then this is something where you can collect some of that premium. And once again, as Kevin mentioned with my trade, you can do this again and again and again and again. I mean, this is one of those things to where if you continue to see this thing stay within this range, which it's really been in about 3 or 4 weeks now, and you're not expecting a breakout on that, maybe until something like an earnings event in February, then this works. I think that where I'm looking at the charts in the trade right now is that we're basically kind of sitting at an inflection point, right at that 50-day moving average. If you were to throw a Bollinger Band on there, you'd probably see these things compressing as we're getting tighter and tighter and tighter. And when I see that happen, a lot of times I consider Bollinger Band compressions almost like squeezing soap in your hands. Like you don't know what way it's going to break out, one way or the other, but you are making the assumption that at some point it's going to move. With Kevin's trade, you only have to hold on to it for a week. For me, it's about a 30-day, but that's the reason that I had to go. That's the reason I'm collecting more credit in doing so.
All right, I'm going to jump in here. I mean, when you think about what's going on with Palantir, the other thing I'll note is it's continually delivering strong earnings every single quarter. This year has been a beating, exceeding, really placing it on the winners list. And I'll add that the company has raised its guidance for the fourth quarter and that has brought optimism, forecasting fourth quarter revenue to come in 12% above consensus and projecting operating margins to expand roughly 300 basis points. So you're not really seeing any slowdown ahead for a name like Palantir. Thank you both. Great trades and details there, Joe Mazzola and Kevin Hanks. And we continue to follow the big stories here on Wall Street. Up next, it's Cash Tags. The team from Lightfolio will join us and have their very latest sentiment data on Apple. What you need to know. Fast Market. We'll be right back.
Hi, I'm Alex.
I'm Dean.
And I'm his mom.
Sometimes
mother.
you know you could have done better. Same goes for where
Big
you
mistake.
invest. Level up and invest smarter with Schwab.
I'm Sam Varnas, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email,
This is the third part of the flag.
chat. Trade brilliantly with Schwab.
Whether you're an experienced investor
Right here.
or just getting started, Charles Schwab offers a webcast that's right for you.
Sorry. But you got your 1, 2, 3 now. And your 1, 2, 3. And it's getting real tight. Like he was saying before, you don't know which way it's going to go. But it's definitely flagging out. Now, this is for scalping. We're just talking like 90 days out, 100 to 30 days out was where he was spotting these flags. But for scalping, the 68.90 is right now at 250. You can see it getting ready to do its thing. Will you draw it out for us, Jim, so we all could see the picture of it next time when it happens? I can show Aunt Jarvis. She'd love to see this breaking position. At $2.70. You can see it was starting to do it right here. This last breakout was a little bit higher than the first one. And then this last one. One of them, two of them, three ups. One of them, two bits and freebie. Breakout. Pull back. Strength. Boom! So there's 270 to 390, $3. You can see where it's starting to squeeze, right? Say yes. No, we're just here, Jim. Nobody wants to say yes. It's all right. You don't have to. Say yes, Magnificent. Oh, excuse me. Sheba said it. I'll take it back. I need to ask Sheba if she was ever a psychologist. There we go. Uh-oh. It's already been that I'm a genius. Thank you very much. Are you a he? Dude, I had no clue. I've been flirting with you. No, I'm joking. Woo! Woo! We just almost hit the 200 right here on the breakout of the triangle. Now, Washboardjim was sitting here calling us out at 270. He said, watch out, folks. We're getting ready to have a breakout. So this thing's at 320. Now you got in this thing at 260 on the call out. And that's when we were on the 63. And that was before we even pulled back. So I'm going to make it clear. You're at a resistance now too. And if you had to like do you were watching it, you just came in. You got to knock on the door. Hey, did you watch Jim's YouTube there? We're at the triple top. And we got a triple bottom and we have a triangle. And he's talking about the symmetrical flag breakout. So I don't know if you want to jump in this trade real fast while you're on lunch and do make a couple of $300 or $400 in about 4 or 5 minutes, 10 minutes. We'll see if I have time. Oh yeah, I got plenty of time. I've got an hour. Oh, just hit the 200. Ladies and gentlemen. Ladies and gentlemen, what do I say? What do I get? Nothing. It's all right. It's all right. We know. We know, Jimmy. I can feel it out there all of a sudden. It's real sad. I think we ought to start about Washboardjim's 2026 vacation collection basket. It's all right. We can think about it. 200 EMA. Now, As we touch the 200 SMA for EMA for a sell ticket. Oh, I got them backwards. This could be a problem. This is a problem. This can be fixed. Let's just go ahead and fix that. Get that in there. Put an E. No, it's an S. S, 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 S. Whew. Let's go. Let's go right there. I just don't like working this hard. It's 275, 280. If I want to buy it at the ask at 280, I want to buy less. And if I want to buy it at the bid, I always want to buy more. Right now is the time to buy. Like two of them at 265. The 68.90s. If I can get in right here, I mean, no cheaper than this. And we got to hold this support level. Major, ladies and gentlemen, please, we're having a little bit of turbulence. Please make sure that your belts are on. We're at the 63 EMA. We need to hold it right here. Just relax. I think I'm going to jump in while everybody else is stressing out. These are the 68.90s. December 31st at $2. Oh gosh, look at that. Look at that. Oh my God. What the hell? Here it comes. $2.40. We could get one more candle. Seriously, one more red candle. Of the old TTM trend strategy. Here it is, see? Now I'd be ready. Okay, we're watching it real close here. There's the 3. That's the 3 we need. I don't know how he does it, but he does it. They come right to him. How far is that out? Not too far. $2.45. Now, this might be a little risky, so he buys 2 contracts. Come on, man. See, we started doing this about a year ago. There's 255. I'm up a whole $20. Okay. Got in a little bit too late, I think. We got a huge hard wall to break. Might get out of this one if this one don't hold, because I don't think I got a good spot. But we'll see. If we break these little bodies right here, these little candles, the only one in here to give me a hard time, I think, would be the 9. I'd pick it over the 200, maybe even. So I'm going to wait for 68.75. There's 260. So I don't think it's going to be a big money maker. If it runs up, we might get two under $3. Get 100 out of them. Okay. Right now, Jim, you're up $40. Have you ever thought about selling? Well, when the time gets tough and you need to sell, you need to make sure that you have notes for later reasons, in case you ever want to run to be a politician or wanted a position in a job. You want to make sure you have them notes that you sold this entity at this certain price. Come on, give me $3. We're at the 68.90s right now. Everybody's really intense. Washboardjim is in it at what? All of a sudden it just dropped to $2.45. See, I don't appreciate that. Now, Belch was just wasted. How disgusting. Can you believe that? I was waiting for that thing to break out to the triple top. To 68.80. Sucks. Okie dokie. $11.47. Gosh. What is tomorrow? The 1st? Woo! Wonder what to do. There's a triple bottom. And that might be more than a triple bottom there. We get ready right here. This is it. Definitely a little pullback.
Tier 1 customer deployments already in line, and this includes Microsoft, Meta, OpenAI. But I think the OpenAI situation is a little bit tepid still, considering some of the exposure companies like Oracle have in terms of the commitments to be fulfilled by OpenAI. Those are still kind of questionable going into next year. But nonetheless, I think you look at the data center growth for AMD, 94% year over year, and as I mentioned, very complete in terms of their broadening business. Inference technology chips are going to be, I think, in high demand coming up in the next couple of years. And valuation, too, for AMD, trading around 33 times next year's earnings with 62%.
A lot of stuff getting built.
So it's trading at a discount to earnings growth. And that might be, again, something compelling to consider with this name.
All right, and just a quick final thought here, because we think about the competitive landscape. What AMD is not, it's not NVIDIA, but it's still well loved. The expectations for 2026. Final quick thought.
Well, I think you look at NVIDIA; they're still the preeminent chip out there across the board. But maybe there's going to be a place for second-tier chips not as good, but good enough. And I think that's the story behind AMD going forward. The challenge right now, Nicole, just broadly speaking, is catalyst. This market has been absent really a catalyst for the last couple of months. And I think that's why the market is stalled out, and that's why we've seen some of these bigger names like AMD and NVIDIA also stall out as well.
All right, George Sillis, great to see you. Happy New Year. Thank you so much. We bring Kevin Hinks back in to look at an example trade here on AMD, which does have enough arrows today. Kevin, some of your thoughts.
So looking at AMD, it's what really amazes me is if you look at August 5th on the calendar, AMD trading about $174, NVIDIA trading $175. So you can make the case since late summer, AMD's outperformed NVIDIA. And so the fact that it is now sold up back off through its 50-day moving average, going into next year, Nicole and Joe Mazzola, the paper money trade I looked at here was something in the short put vertical. So I went out to January 16th. They don't have earnings until February 3rd. So I went out to January 16th, the monthly expiration in January, sold the 200, 190 put vertical. So what I did here was get myself $15 on the downside, almost $16 on the downside in terms of room for this trade. And then I sold them for about $1.45. It's trading about $1.35 now as the stock has come off its lows here. But selling a high probability short put vertical, the exact opposite of what I did in Palantir. So in this way, Joe, a $10 short put vertical, the risk is the $10 strikes minus the credit I took in. Joe Mazzola, your thoughts?
Stepped away, and we thank him for joining us on Fast Market. But I'll jump in and just talk about the stocks and the SMH. I mean, you look at these indices that really, compile these semis, and what a great year it has been. And the stories come out every single day. I mean, not just about the circular spending, but about the growth and the earnings projections. The earnings projections for 2026 are stellar. Are they too aggressive? Are they, when you look at that, I mean, just constantly. I mean, right now, you look at NVIDIA's China orders go off the charts. You had NVIDIA's $5 billion Intel bet. It's just constant. We had SoftBank and the OpenAI investment. They did the funding for that yesterday. You have NVIDIA buying Grok. You have Meta buying Manus, for AI agents. I mean, there's just so much going on, Kevin. Final thoughts here for 2025.
When you look at AMD, the question is always, can they compete with NVIDIA? Because when they brought out really good chips in the past, NVIDIA's come out with a better one and extended its lead. And then the question is number two, are they number two, or is it like a Broadcom? Are they number two? And is number two enough? If NVIDIA is the clear number one, is AMD good enough? Is it profitable enough to be number two? I think the question is probably yes, and lately, their stock has been outperforming, so this is a chance to.
Or maybe it's too good. Where good enough is just as good.
Theta, and of course, as always, Nicole, risk defined.
Yeah, it looks so
very good point, Washboard Jim.
This market, because they're so heavily concentrated in the indices, and I'll have my AI agent call your
maybe too
AI
good will be good
agent,
enough
Kevin
in 10 years.
And we're going to be in a whole new world, and we'll have Optimus robots walking around, from Elon Musk. Thank you, Kevin Hanks and Joe Mazzola, and everybody. Thank you for joining us here on Fast Market in 2025. We'll be back.
Ooh, big knife right here.
Network. Next Gen Investing is coming up.
Well, this looks very nice. What time is it? Oh yes. I'm dialed in. Washboardjim's dialed in.
Schwab Bank Invest.
I'm dialed in here. I've been watching it go to this blue line, and we just now had a big, huge, fat knife. These are options, of course, that we're looking at the SPX, and 6890s or the 6890 80 or the 6880s, if you can afford to go in one contract or two at 6890. It's up to you, man. You might get even 3 or 4 of them. Yeah. At 68.90 you can get 4. See, you see what I'm saying? George. You can do it.
Good afternoon, welcome to Next Gen Investing. I'm Alex Coffey. Jenny Horn has the day off, but I am pleased to welcome in Sam Bottas, who's going to join me here at the top of the show, live from the New York Stock Exchange, to discuss the market action here on this final trading day of 2025. Sam, not a ton of volatility back and forth, not a lot of flashing on the screen, but there is the color red as I look across the board here. Basically, all four major indices down between 0.3 and 0.4%, give or take, maybe a basis point or two. What do you make of it?
Hey there, Alex. Yeah, as you say, we are seeing risk off, and if you take a look at the sectors, all 11 are in the red as well. Look, it's not the Santa Claus rally that everybody had anticipated. We're looking at a fourth day of declines here, but the vibe you get down here is that this is a low volume market. It is a holiday market. We've had a lot of information to chew on, and of course, we are still capping off this year in double-digit gains for the S&P 500, up 17%, also for the NASDAQ as well as the Dow. So, I mean, it has been a good year. Unless you've been living under a rock, the conversation very much today has been around the fact that you have still made money in this market. If you look at the commodities, if you look at international markets, if you look at the bond market as well. So, all in all, it's been a pretty good year. We just feel like we're in a bit of a holding pattern right now, Alex, as we wait for a little bit more of a cleaner picture when it comes to the data. Obviously, that's going to be very important as to what the Fed does next. We got that sort of complicated type of Fed minutes yesterday with respect to just the deep divisions and perhaps a closer call with regards to that December rate cut than we had anticipated. So we're getting a little bit more evidence of how they're thinking about things, but that's creating an even more murky picture as to, you know, not just the size of these cuts, not just when, but why and how fast. And so I think this is what the market is going to be grappling with as we move into the new year. Obviously, we got some initial jobless claims out this morning. That was a little bit of that economic information, but I mean, this does look good. It was an encouraging number, 199,000 on the headline, but still there's some seasonal factors to consider with that, a few distortions around Christmas, so we just have to wait. With the whole AI story, obviously we continue to see this rotation out of mega cap tech. That's obviously been a big story that we've been tracking. There is expectations that we continue to see that moving into the new year as well as we focus more on the 493. This is going to be a year, obviously, as you and I have been discussing on a number of shows as well, where, you know, it's starting to talk a little bit more about the sort of winners and losers in this whole trade. So that's sort of what everyone is thinking about as we close out 2025 here.
Thinking about me being a winner.
All 11 sectors are in the red today, but if my numbers are correct, all 11, if we were to close here, would finish green at least slightly.
Including Nvidia.
Year, with real estate up less than 1% on the year. So that one, if something were to change here in the next couple hours, could flip the other way. That said, though, Sam, there's a lot I have on the show here today. I'm going to talk some winners and losers.
Ask her about Nvidia.
S&P 500 with Rick Ducat. We're going to chart and trade SanDisk, the #1 performer in the S&P 500, and the third worst performer in Deckers, parent company of popular brands such as Uggs, for example. Kevin Green's going to stop by for our FOMO segment. We're going to cover Alphabet, the best performer of the Magnificent Seven in 2025 as of yesterday's close. We'll do a outlook for streaming in 2026. Obviously, a lot going on with everything with WBD and whether or not Netflix will buy them, etc. And then SMCI, a stock that's certainly not been immune to stories and volatility over the last few years with George Tillis. But Sam, that said, there's actually quite a bit of news and some stock-specific news at that in just the last 24 hours or so. So I want to go through some of those big stories and some of the big names, too. A pretty big news story here in NVIDIA regarding demand out of China. You want to go through this story with us?
Yeah, so there's this report out now that, no surprises here, there is strong demand for the H200 chips coming out of China. It's a bit of a case of it's not always what Beijing wants. Chinese companies sometimes want other things as well, and I think that really is what's being spelled out here. It looks like there is a strong appetite here coming from the Chinese tech giants for these chips, which have been given the green light by the Trump administration. NVIDIA now reportedly scrambling to meet some of that demand, actually asking Taiwan Semi, which makes the chips, to ramp up production. So they're basically saying, hey, look, the Chinese want our stuff. let's put pedal to the metal right now, TSMC. But what's interesting about that, of course, is that they are facing their own capacity constraints. So it's going to be a really interesting story moving into the new year as to how they're sort of balancing that Chinese demand, Alex. But what we're seeing is that Chinese companies reportedly placing more than 2 million orders in 2026. So we have seen reports previously that this is coming from the likes of Alibaba, Tencent, and also ByteDance. So they still want to get their hands on these chips, apparently. Now, there has been an SCMP report out that is a local Chinese Hong Kong media saying that ByteDance plans to spend $14 billion on NVIDIA chips next year. So there is still strong appetite here. These are important chips for China to get their hands on. We can't dispute that. I mean, this is not the Blackwell, but the H200, while it is an older version, it is more powerful than the H20, which is the specific made chip for China. So it is 6 times better, more powerful than anything that the Chinese have. This is why there's appetite for that. And the reason why it's so critical for the Chinese is because this is for inferencing and also training. Now, when it comes to what the Chinese have for inferencing, their stuff is okay, but it is critical for their training as they really push ahead with what they're rolling out here over in China. NVIDIA currently has 700,000 of these things in stock. What's not clear is exactly how many NVIDIA is ordering from TSMC. The production is expected to start in Q2. This is all according to the Reuters report. And apparently NVIDIA plans to fill the initial orders from the existing stock. Remember I said they have a number of these in stock already before the Chinese New Year. That falls in mid-February. So what's interesting, as I mentioned, is the capacity constraints that TSMC already faces. It is focused very much NVIDIA right now on Blackwell and Rubin. So how they're going to manage to balance that is going to be a key question moving forward. What's also new about this story, and this is key as well, this perhaps is why this is so attractive, and maybe there's something in there for everybody. These chips are reportedly going for $27,000 a pop. Okay, so we do need to keep that in consideration as well. What we're still waiting for, and this might speak to maybe the reaction in the market. KG was pointing this out this morning, which is quite interesting. I mean, look, NVIDIA is still up 0.7%, but there might be some skepticism here that the market is not buying this yet. And that, Alex, is because Beijing needs to give the green light here. And so that is something that we are waiting for, this official confirmation. But as I said, it feels like this story has a little bit of something in there for everyone right now, because NVIDIA, obviously reporting some good earnings, that is ex-China, so anything on top of that is an added bonus. We've talked about that before. I suppose good for TSMC, good for the Chinese companies looking to get their hands on this more powerful stuff, but also the US government, don't forget, it's also going to be taking a cut from this as well, Alex.
Yeah, TSMC shares up over 2%, and on a day where only about 10% of the NASDAQ 100 and the S&P 500 components are trading higher on the session, NVIDIA is able to muster about a 2/3% rally. So certainly notable, and one has to think driven by this news item that you just went through. Let's talk Tesla. Tesla I would call unchanged, especially given its typical day-to-day volatility. It's at about 50 cents here in real time. That can change in a flash, as we know. But we got a cyber
daydreaming, brother.
I also saw Michael Burry stirring the pot a little bit on social media as well.
Yes, that's right. So we've got this post on X coming from Musk, who's saying that they're testing the production systems for the Cybercab with real production ramp up to start in April. Now, interestingly, this is not new information.
No, it's not.
It seems like more of a clarification or a reiteration of the
just need to break out.
Tesla actually did announce this last month at its shareholder meeting. The robo-taxi service did start in Austin in June, expected to be now expanded, rolled out further, Miami, Dallas, Phoenix, Las Vegas as well. It's also been seen, of course, the Cybercab testing in places like California on the roads. Now, Musk has said that the manufacturing approach is closer to a high-volume consumer electronics device than it is a car manufacturing line, which is interesting. Shareholders, though, just talking about the stock, have been on a wild ride this year, to say the least. I mean, we don't have to go through the numbers. I think, we've reported on that time and time again. But I think what's important in moving into 2026, look, that chart says it all, is that it's going to be less of a bumpy ride out there for this stock. That's according to a lot of the analysts that, at least I've spoken to. Everyone is looking at potential catalysts now moving into 2026. This has been a big
big part of it. I mean, you and I, Alex, were discussing yesterday some of the notes. I mean, as many of the brokerages, the houses are obviously looking at, how they're positioning around their outlooks for next year. We had, of course, Baird coming out with a research note, views this as a core holding, a $548 price target with an outperform rating there. We've had Wedbush's Dan Ives also, the colorfully dressed tech bull here on Wall Street. He says that it's going to be a monster year ahead for Tesla, particularly as the autonomous and robotics chapter begins. He thinks that we're at a crossroads with Tesla as the bulls and bears debate how quickly this era is actually going to take shape. And then you have Mizuho, interestingly, which came out with this note as well in recent weeks, which also seems more bullish on Tesla too. A price target 530 from 475, and that was as they have been talking about how it's going to be a more sort of challenging and bumpy year next year for EV sales. But this is based on improving investor sentiment on the robo-taxis as behind the boost here for Tesla's target too. So yes, I think this is really going to be the big focus moving into the new year, Alex.
Well, the market liked what you had to say while you were talking. We actually flipped green in Tesla. So, hey, it's very minor. It's up about 10 cents on the session, but green is a welcomed color even in small amounts. So let's talk Hyatt. Hyatt providing some guidance, a little bit on the negative side here, but this is due to that Hurricane Melissa that hit Jamaica. So we're getting some of the numbers out of the hotel giant on some of the impact financially from the hurricane. Sam, what do we find out?
What we've now found out, Alex, is that we know that Mother Nature unleashed her fury a couple of months ago, and this is taking a hit to the financials over at Hyatt Hotels as well. They've now come out with an announcement saying that because of Hurricane Melissa in October, 7 of their properties in Jamaica are now expected to remain closed until Q4 of 2026. Now, we did have some of the idea about that just a couple of weeks ago with respect to some of the closures as a result of that hurricane, but now they've said, as far as the financials are concerned, they're looking at adjusted EBITDA outlook for Playa as lowered by $10 million at the midpoint of the outlook range. Now, excluding that, because we have to keep in mind just how much of a percentage this actually makes up for across the entire space here for Hyatt. The adjusted EBITDA for Hyatt is expected to be at the low end of $1.09 billion to $1.11 billion as far as the outlook rate provided back in November. So even though Jamaica very much is a high-profile destination, very visible, very important obviously to the portfolio here as part of all of its resorts, it does look like the financial impact, if you take it as a total consideration of the corporate business, is fairly modest. And then obviously the Jamaican business making up for just a small percentage of the total operating profit here. But I mean, $10 million as far as a hit is concerned is obviously going to have ripple effects as well. I mean, we do need to think of that broadly speaking. I mean, particularly when you talk about reduced tourism capacity here. I mean, the impact on the workers. Obviously, they've had to also come up with cancellation fees, refunds, etc. on prepaid bookings too for those affected reservations. Obviously, travelers with plans to go there have obviously rerouted their plans, changed their plans now, and then you've obviously got the broader context of the recovery there as well. But I mean, just looking at this stock, I've been actually taking a look at this, compared to some of the other tourism and hotel operators, trading down 1.6% right now in trade off the back of this, of course, this announcement. It is down year to date, actually, but I'm looking across the analyst consensus here. You don't have anyone really in an underperform or sell camp right now. I mean, you've got 8 in a hold, 11 in the buy camp, all with a strong buy. So it doesn't look like things are too bad as far as the outlook. I mean, in particular when you
always clean as Jim.
Travel has looked pretty resilient this year, you could say, Alex.
No doubt about it, and if anything, we've learned the value of experiences as has not gone away from the U.S. consumer, so we'll see if that continues into 26.
Boom, baby!
And then, a send-off for the Oracle of Omaha, the last day of Warren Buffett's leadership at Berkshire Hathaway, as he's set to pass the torch to Greg Abel, company's vice chairman. And this has been...
Ladies and gentlemen, he pulls it off again. The SPX, the incredible sneaky snake trading strategy, just run up and hit the 200 EMA at $2.70. Give me a heck yeah. How's he do it? I mean, we were sitting here watching it, me and the old lady having some tea, and she said, she's about sending him up there to go get us some Cobb salad. I said, well, I'm kind of busy right now, but we just had a pullback to the previous resistance level and want to jump in this scalp. So I sat here and I grabbed me a couple contracts, 68.90s for $2.45. Well, it broke out a little bit and it pulled back and it dipped out under 2, and I said, oh, okay, we're still support level. So I added 4 more, $2. That gives me 6 of them now. And we just now hit the 200. So I should ching. What I should do. Not bad. I'll be right back.
So we'll see if maybe the investments change in their scope. The type
We're
of
at the
companies.
200 right now.
Recently, Apple's been the big winner for Buffett and team. So maybe it will look all that different going forward. But any final thoughts? Sam, it's been a wonderful year again for investors.
Great year. Great
classes, whether we're talking metals, whether we're talking fixed income, of course, stocks, as we mentioned. Anything that really stands out to you as we turn the page?
Well, I think obviously a lot of the guests have been talking about how the end of 2025 is likely to see a continuation into early 2026. As I said at the top of the show, there's going to be a lot of questions around what happens next with AI. We've already started to see the market sort of asking, show me proof of ROI, show me proof of all this spend. So I think, it's going to be a little bit more of a sort of picks and shovels type of story moving into next year. Obviously with the rates conversation, it's been interesting. You and I were talking to, who was it? Jay Hatfield yesterday, looking pretty bullish on the S&P 500, 8,000 by the end of the year with 3 rate cuts in the system. Mark Zandi just said a similar thing earlier today. I heard him on air too. So, it's going to be very fascinating. The market seems to be sort of a bit all over the place as to some of their expectations. But, I think it's largely going to be a continuation. I'm hearing a lot about the excitement around the international markets as outperformers as well, particularly with the performance in the greenback too. And then, of course, the bond market. Still looking at a continuation of what we saw this year with some good, decent returns. Probably not as much because we're starting at a lower point because we've got those 3 rate cuts in the system. Rates have come down, but I think, obviously those are all going to be sort of things that I'm going to be watching out for in the new year.
Well, me, like yourself, I'm excited for 2026, and I know we're going to have more to discuss later on Market on Close, so I'll look forward to that. But Happy New Year, Sam, and we'll talk soon. We're going to take a short break. When we get back, it's time for Chartmaster. Rick Ducat's going to join us one last time in 2025 as we look at one of the biggest winners, the biggest winner in the case of SanDisk, and then a stock that struggled in 2025, that being Decker's parent company of Hoka and UGG. We'll be right back.
To what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab. Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Well, back time for Chartmasters. We chart and trade one of the biggest winners and biggest losers of the S&P 500 in 2025. Rick Ducat's joining me here in studio, lead market technician for the Schwab Network. Now, let's start on the optimistic side, that being SanDisk. This stock, lapping the field in terms of its performance on a percentage basis. Absolutely incredible, hundreds and hundreds of percentage points. What do you make of it?
Yeah, the storage chip makers are the far outperformers of the group, kind of the strongest of the strong here. And when we do look at SanDisk, we can see that there's a couple different ways to look at this particular chart. One is you could say going across these lows that we established here kind of after our rally to the upside took a breather. You could say we connected these lows here. If you were to extrapolate that, put a duplicate line across the highs, more or less kind of matches up there. Not super well here. Probably, I think the more sensible pattern would be to go across the lows like this and then make an accompanying trend line going downward across the highs to give us more of this triangular shape here. So what that means is an increasingly compressing range in which the price is traveling here. You'd be looking for a breakout beyond either of those two boundary lines here. To the downside, our 187 level was a fairly consistent low point here. That stands out as potential support. We can also see that this level here, 238 roughly, that's about where price topped out. That's where we had the high before our gap. That's about where we are right now. So another potential inflection point to watch as we draw toward the conclusion of this year. So now, if we were to look at some of our moving averages, these are simple moving averages here because we don't have a full year of data. So if we were to look here, our Our 20 and 50-day simple moving averages fairly close here, about 227 and 220 respectively here. So those could be another area to watch for support. RSI also moving lower, still above the 50 midline, but downward sloping trend line in play. We did have some bearish divergence as well during this period where price was traveling upward, but the pace of the gains was slowing down. Finally, if we were to look at our volume profile study, we can see here SanDisk shows that the heaviest volume activity right here, kind of in the middle of where we've seen this range near around 215 or so. That would be the standout area for the volume activity, and then declining very notably once you get beyond those levels to the upside or the downside.
Yeah, it almost looks like a king cobra snake. I don't know if that's a chart pattern or not, but it certainly has that look with the really incredible performance in that kind of middle part of this year. A little bit more consolidation in that last quarter, but tremendous year for SanDisk. So we take a look at an example trade. We'll look at a neutral to bullish strategy in SanDisk, and it's a sell and put vertical below the market. Acknowledging the performance, but also acknowledging the recent performance where it has been a little bit more consolidating. And so, neutral bullish strategy, if you look at this one, it's a $230 short strike, a $225 long strike in that January monthly expiration. Looking to collect around a third the width of the strikes. In this case, that would be a $1.70 credit for this example. You have a max profit of $170 on $330 in max loss potential. Find that break even, you go to that 230 short strike, that's the anchor of this trade. You take away that credit receipt of $1.70 and you're left with $228.30. That's your break even, represented here on our risk profile. You can see everything above 230 max profit, below 225 is where that max loss levels off at $330 per each one of these example spreads. That said, we're going to look from SanDisk, the biggest winner in 2025 in the S&P 500, and we're going to go to the other side of the performance spectrum, bring back in Rick, we're going to talk Deckers. Now, Deckers wasn't the worst performing name in the S&P 500, but it was in that kind of worst three bunch. And of course, this is a parent company of popular brands. UGG, Hoka. Wasn't like they weren't selling shoes and other apparel items, but apparently not enough of them.
Yeah, a difficult chart to be sure here, but when we look more closely, most of the declines happened earlier in the year. For the past few quarters, it's been a gradual decline here, kind of trending, drifting lower, but establishing some important horizontal levels as well. We can see here that we had some points where we saw price bottoming out here.
We need this thing to break that.
Around 79 or so. You can see that we also had a gap here, this notable gap level. We can see that this point here from about 90 to 100. That's a standout level that we can see where the price activity.
Well, we can see, senor.
So if we were to advance to our next chart here, if we could pull up our charts in the control room, we would see that the moving averages that we follow show that things are kind of starting to solidify and move more sideways. If we were to advance here, we can see that when we do look for this type of situation where we see our moving averages clustering together and moving sideways, typically not what you would want to see if you were bullish in this name. Now, if we could change over our symbol here, we have our grid for an earlier show here. 1 second here as we adjust. So finally, we will try to pull up the chart here real quickly. Now, as I was saying, sideways moving averages show that we have a consolidative phase here. Either the activity is so choppy that it doesn't really find a direction, or things are languishing and just kind of drifting here, and we're not really able to make a clear push one way or the other. So if we do start to advance beyond some of these levels here, the 251-day exponential moving average right here near about 114, that stands out as a possible upside area to monitor here. You can also see here the lowest level, our quarterly 63-day EMA here in yellow, that comes in near about 97.50.
Yeah, a lot of good stuff. Deckers, not the year investors were hoping for. It was a really strong performer last year.
This could be the year.
On that success, but popular brands, we'll see if there's a bounce back year in store.
We're at resistance again.
All that being said, got an example trade, not necessarily going with the price action of earlier in the year, but more what the setup might be for 2026.
So we're at resistance again. we're at the orb and we're above the 200 EMA. So we're kind of just that close to saying, oh, okay, we're ready for the big breakout. Because this is the hardest resistance. Or we pull back here and say, okay, take your profit and leave. You're up quite a bit right now. You're up over $40 a contract, and you got 6 of them. You make a business decision. Going crazy. Now we're retesting the old resistance, which was the 200 EMA. Right there and right there. Boom. Pull back. Hold up the 9 and take off. That's what you want. For it to be very bullish. I mean, right now, it has to do it. And then you say, oh, okay, we're very bullish now. I'm going to add on. Here we go again, retesting. Dad, how come Grandpa doesn't sleep with us anymore? Well, honey, daughter, that's a complicated question. He's went on a long vacation. He left me in charge. Here's Mr. Green. He's up next.
Magnificent name for the best performing Magnificent 7 stock. Talk to me about Alphabet, though. It seemed like the narrative was very negative first quarter and suddenly very positive in the fourth quarter. What changed?
It's not no more.
It was the narrative around artificial intelligence. In the first and second quarter, the market was really kind of bearish on this name because they were not at that point in time talking about artificial intelligence and their implementation of artificial intelligence as aggressively as some of these other companies, and also the rollout of Gemini initially, or the BARD system, if you will, the BARD AI platform, just did not really sit well with a lot of traders and investors, and even the usability of that platform was not up to par with the street's expectations, and we did see a little bit of a pullback. In fact, we saw a lot of calls for a shakeup within the executive team, but now we have seen the company actually make a shift. They have now launched Gemini. They've had several different updates throughout the year that has really impressed the street, and you are starting to see them actually taking a little bit of market share from OpenAI, but you are also seeing the fact that they are actually able to maintain and retain their search capitalization in this market, which was a big concern to start off not only just last year, but also early on this year. So that was also a turnaround. And now you're also seeing some bright signs when it comes to the TPUs, which they've been leveraging TPUs for a very long time, but they have been able to leverage those TPUs a little bit more efficiently than GPUs that are provided by NVIDIA.
Okay, here we go, folks. Get ready to break.
More efficient, less water intensive. You can get to exactly what you need to do as much as you possibly can at a cheaper rate. And so you're starting to see an uptick there. So there's a lot of tailwinds for this company here in the near term. In fact, we are actually seeing Citizens actually raising their price target on the shares up to $385. That's up from $340, and they keep an outperform rating. Once
I think you can do it.
The same situation that we've been kind of mentioning here, search availability and their ability to capitalize on artificial intelligence with their AI platforms, also expanding cloud growth as well. So a lot of tailwinds for this name. Now, technically speaking, we might be seeing a little bit of a pullback, but overall, this one has been able to kind of wow the street, at least for now, and on a multiple basis, you can make the case that it's still relatively cheap given the growth rates that are being projected in 2026.
Talk to me quick, chart-wise. Technical still strong. I know there was some bearish divergence and sort of the latest highs that were made, but I mean, we're picking at it now. I mean, this has been a really nice performing stock.
Correct.
It has been. If you look at the 3-year weekly chart, it's still bullish in nature, but you do have to keep a couple of items in mind here. You can look at this bull flag pattern where the stock has been in a primary uptrend. We are seeing a consolidation, a little bit of a pullback. That consolidation is the flag, and then now you are looking for a breakout, a confirmed breakout above this $320 level, and being able to close at that level on the weekly chart here. Now, the reason why you get a little bit concerned that momentum is lacking here is that RSI is starting to hinge a little bit lower, not crossing below the overbought territory yet, but something to be mindful of. And that MACD is also starting to hinge a tad bit, where we could see a potential bearish cross with the 12 EMA crossing below the 26 EMA. But the primary trend is still to the upside. The fundamental thesis that a lot of analysts are excited about seems to still be intact. And we will get earnings announcements around January 28th. And if they are able to kind of show that they are still monetizing artificial intelligence, still seeing outsized growth when it comes to Google Cloud, this is a name that could actually outperform in the first half of next year.
Yep.
Good stuff. You got an example trade that's looking for just that. Talk us through it and what you're looking at.
Tough question.
Yeah, buying a little bit of time for this one. It's just an outright call purchase, looking at the February monthly 330 calls. Now, buying this for $9.85, a little bit of an outlay going outright here, but at the end of the day, you're giving yourself a little bit more time. What you would like to see is the stock obviously moving to the upside. This provides a break even of $300.
We just want to see if this wants to break here. Boom.
And that's loss potential of $985. And the hope is that obviously the stock continues to move to the upside. And if it does so over the next 2 weeks, 3 weeks, Alex, time value erosion won't be as aggressive. You still have some upside potential here, but also it's risk defying in the event that we do see any type of pullback in the market. So looking for a little bit more of a breakout to the upside. You can also look at those technicals once again, this kind of bull flag from high to low is around $20, $22 or so. You add that to the breakout level of $320, that gets you to around $340, which this would be a
long day. Days have been long.
So that's also kind of aligning with some of the technical structure on that weekly chart.
Yeah, walk us through sort of the general trade management of a trade like this, because I think this is one where if you're newer to options trading, you see, oh, I need this stock to go to 340 to break even. But that isn't necessarily true if it if the movement happens, you know, on a faster timeline. So walk us through generally. There's no one-size-fits-all answer.
Yes, there is.
How a trader goes about managing a trade like this.
Yeah, so if you are bullish and you do think that there's some upside potential here over the next couple of weeks, this trade gives you the opportunity to have some upside potential, but looking at time value, it's not going to erode as quickly because we still have around 60 days for this to actually mature in nature, around 45 to 60 days. What you would like to see, Alex, is the stock moving in the next 3 weeks, at least by the monthly expiration for January, even maybe a week after that or so, in order for this to move in the right direction. And if it does not do so, then you're looking at a stop loss type of scenario where you want to define that risk. And maybe that's going to be 50% of the premium. That's usually kind of the standard that a lot of traders look at for a potential pullback and maybe cutting those losses here. But this is not a trade that you're really trying to stay in until the February expiration. You're just looking for a directional move over the next 2 weeks, 3 weeks to capitalize on, but also try to protect yourself from time value erosion, which is going to accelerate as we get closer and closer to the expiration date of February 20th.
Always a pleasure, Kevin Green. Great insights and example trade. Look forward to another year. We'll see if Alphabet can build on the successes into 2026. It's going to do it for our FOMO segment. Coming up, we're going to look at the streaming space and an outlook into the new year. We'll be joined by Stephen Kent, the media director from Consumer Choice Center, right after this short break.
Let's go ahead and break out. Let's do it for Uncle Jimmy. 68, 82. Let's do it for Uncle Jimmy. Break it for me and you. There it goes. Ha! Woo! Woo! Uh-oh. Uh-oh. Get them grade pens out, please. Grade pens out. Oh my gosh. Oh. Me and my husband Fred were sitting back there by the Bernsteins.
Believe me, when it comes to investing, you'll love Carl's way.
This was Jim's way.
But there's a
Excuse me, Carl.
the best way.
I hate to be a snub, but this is my time. So I'm sitting here talking smack, drinking a cup of coffee that's been warmed up more times than it deserves. Practically for ever since, 5 o'clock. That's my time. Eastern time, that'd be right around 4. About to the bottom of it, right at the bottom of a good 2.5 gallon kettle, 2 gallon kettle. The bottom first part of the coffee pot's always the espresso part of it. So he's sitting here, he's watching the 68 90s, calling out this trade. We had a pullback right here, and I said, I want to jump in this trade. And I added on to the dip. I ended up getting an average of about 215. So I'm sitting here looking at my girlfriend, Nancy, sitting there in the kitchen with washing her hair in the sink. And I looked up at her and I said, Nancy, I just got I was talking about this breakout getting ready to happen just now. And people were laughing at me like they used to back when I was in grade school. And all of a sudden, we got this big old green candle come in the scene. It jumped up a whole buck. And I'm sitting on 6 of these things at $2.15. So I looked over here and I said, damn, I'm up at $3.45, man. Bam! Pulled that trigger. Called the pull back to the 200. Said, don't worry about it. Add on if you wanted to right here. I made that perfectly clear. We had 2 different channels we had to break after that last pullback, but boom! I'm very pleased. You say he's getting ready to happen, and all of a sudden you get this big old fat candle. Boom! Comes from nowhere, right when you're saying it. A+, please. A+. Nobody wants to give me an A+ anymore. I'll give it to myself. Well, I was going to say we might get 68.90 out of the deal. We'll just keep running. And these 68.90 also, that'll be the options that I'm in. And they could run all the way up to like $6-7 a piece times 6. Can you imagine that? Yeah. That's quite a bit of money right there. In a matter of minutes. Especially if it hits 68.90. Get ready. Here we come. They are now at $3.70. You could take a good, nice little sniff of that green money. Almost $1,000 in profit if you'd bought 6 contracts at $2.15. Whoa. Almost $1,000. I'll be right back. I'm going to leave it to you. We break out.
Generally want something that Netflix currently doesn't
Let me
have.
know.
So I know people think about Netflix right now as a total powerhouse.
Fake news?
But Netflix is doing this purchase of Warner Brothers out of a position of weakness, not strength. I know that they seem like this 1,000-pound gorilla in the room, but they're not, and things could actually shape up really differently by the end of the year if this doesn't.
We like we're going to move up.
Steven, are we heading towards, in your mind, a world where the Disneys, the Paramounts, the Comcasts, these major, whether it's studios or just general content makers, look more like Apple, Amazon, Alphabet? Of course, Netflix will probably still be in that mix in the next decade.
I'm not so sure about that. I think it's interesting that the tech companies, so like you said, Apple, Google, Amazon, that they've sort of created these studio environments for content creation. They're now making a lot of the content and bankrolling it, and then that content goes out to these streaming platforms. I just think that there's still so much room in the market for consolidation, and it's kind of hard to imagine what that might even look like in the future, but consumers talk all the time about their desire to bundle packages together because they have so many different streaming buckets. But I just tend to think that when consumers are actually demanding and crying out for a certain thing, at some point the market's going to provide the mechanism. So again, it doesn't currently exist right now, but I think in the future you might actually see that. A little bit of a consolidation between a lot of these competing platforms to deal with the real market driver of people's entertainment time, which again is simply just putting on YouTube videos. I'm a big believer in this. People ask me all the time, like, is there a market out there for books? Is there a market out there for this kind of movie or short film? Well, it's just about how people spend their time. And if I'm spending my time during the day watching how-to videos on YouTube, I'm not watching Paramount Plus. You can't do but so many things at once. And so at some point, they're going to have to start treating content creators as the actual competition when it comes to entertainment.
When I think of advertisements and trying to find where I want to put my advertisement if I'm a company, outside of like must-see things like sporting events that happen live and they lose their rewatchability, I don't know what else you want to be on other than something like YouTube where people are focused and doing it on demand. Steve and Ken, wish we had more time. Look forward to our next conversation. Look forward to what could be a very disruptive 2026 for streaming and content. To do it for this segment, though, coming up next, it's Under 30. George Tillis is going to join us, and we're going to talk Super Micro Computer, company that has had a roller coaster last couple of years. We'll get the latest and look ahead to next year with George right after this.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services.
Schwab Network, available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's time for Under 30. We look at SMCI as we welcome in George Tillis, Senior Markets Correspondent for the Schwab Network. And GT, SMCI has been extremely volatile, but it's been almost in a rhythmic-like price range. It's just that price range is massive, from about 25, 30 up to 65 or so.
Yeah, this one's kind of interesting. I mean, I sort of forgot about it, to be honest with you guys. But, looking at the price action, we're going to talk about that first. I did notice that it's coming down to the lower end of a trading range that has been published in the last year, around $28. So, again, that's something to keep in mind and consider. I think this name probably led the way in terms of the AI push with their liquid cooled servers, which, again, are compatible with NVIDIA's GPU chipsets, which are the backbones of artificial intelligence in this entire, data center craze. We have to consider Supermicro's technologies, which may be facing some commoditization issues. In other words, standardizations issues. Competition, I think, has eroded some of the value and prospects for the business. You have to think about software-defined networking businesses that also have server technologies like Dell. They also have to consider Hewlett-Packard, Cisco. So these are some bigger names that Supermicro is facing competition with. But I think the other component that Supermicro still has an overhang with is essentially the restatement issues they faced all the way back in 23, late 24, which is really carried over into this year. So that's been a relatively, I guess, trust overhang, let's call it, for the business. And I do think that the server commoditization component of their business has always been a challenge because gross margins for their business is still very low, around 10% of sales, even less than 5-year average is around 15% of sales. But the challenge here is I'm kind of baffled by the price action. To be honest with you, they do and they have been restating their earnings down. But if you just look at the earnings for Supermicro going forward into next year.
Ladies and gentlemen.
They did restate the earnings down from $3.45 to $3 a share. It's really trading around 10 times next year's earnings, with sales estimates in the next year, in 2027, for the fiscal year,
We have here
$44 billion. And that's
failure
meaningful, considering $22 billion in sales last year.
to
And
communicate.
market capitalization of the business right now at $17 billion. It's trading at less than 1 times trailing sales. So there's a value component to Supermicro.
$4.50. Are you kidding me?
The name is being offset because of the trust issues. Accounting irregularities, restatement of earnings. I think that's still a regulatory and legal overhang, not to mention the competitive overhang from major players like Hewlett-Packard and, of course, Dell.
Do you think that those two things are merged together, though, where if you're a customer of looking for these type of products, these cooling racks, whatever it may be, that you just have more faith that Dell's going to be able to deliver on that, given these overhangs of uncertainty?
Well, I think maybe what's happening here with Supermicro is, you look at the server markets, the hardware, the storage markets. Those two areas have actually been quite good. Storage markets have done very well lately as well. I think the network and software component, when you talk about the verticals from hardware to software, maybe Supermicro can't compete with the larger names I mentioned, Hewlett-Packard, Dell, even Cisco perhaps, because of their vertical integration of software-defined networking and of course, storage and servers together. So I think that is a problem for Supermicro. The other problem I see, Alex, is gross margins, very low, 10% of sales, net income margins, 4%. Again, these are low margin numbers. But at the same time, the valuation also might be pricing at it, because typically when you have no growth or low growth businesses, these businesses will trade in the mid to high single digits earnings multiples. And again, if you look at the earnings multiple for 2026 at 14 times, if you look at next year, 27's 10 times, it's trading at very low multiple already. So I think this is one worth watching. I can't say what will happen with this name, but like I said, it's trading at a discount to sales, perhaps a discount to earnings. Sales estimates, last year 22 billion, this year 26, 33 billion, next year 44 billion. Earnings growth is now being reset down, but all those numbers are moving higher going forward. So again, I can't say what will happen. It's a very special situation, let's just call it for this name, which was really a darling, has fallen by the wayside. Specifically in the last 6 months, it's fallen about 37%. And so that
Locked in, 480.
that we've seen in the space, especially for names or companies that have had some auditing issues or restatement issues, which Supermicro's have.
Good stuff. George Tillis, we'll leave it there. Appreciate it as always, and Happy New Year. That's going to do it for us here on Next Gen Investing. I wish everybody a wonderful 2026. We'll see you next year.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide.
Well, that's pretty hard little swift sell-off right there.
Security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving
Surprised they can't help the SPX.
Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
390.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest in a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
He did it again. He did it again.
New Year. This is the last trading day of 2025. Welcome to the watch list. I'm Nicole Petalides, and wishing you the very best on this last trading day as we're wrapping it up. We're seeing down arrows here at 2 p.m. Eastern time. That Santa Claus rally, no jingle bells. I mean, you still have the first 2 trading days of the year. I mean, they could be whoppers, I don't know. But in the meantime, for the 3rd year in a row, no Santa Claus rally to speak of at this moment. In the meantime, we have a big show for you today. We'll cover some of the stock ideas for 2026, AI winners, big tech comebacks, and what we could see as we start off the new year. Also, we'll talk about the outlook pertaining to volatility and some of the reality checks when it comes to AI. Is everything AI great? And what happened with the metals after this incredible year? What will 2026 bring? Our panel is standing by, and to break down those Fed minutes where obviously there's some concern about inflation, there's a little risk of inflation to the upside, but labor to the downside, so what will they do next? In the meantime, here's a look at the markets. After double-digit gains for the 3rd year in a row, the S&P 500 up 17%, so pretty fantastic run. The Nasdaq's up about 21% this year. The S&P right now is down 9.68.
They're now at $4.70. And Washboard, oh my gosh, they just jumped up to $5.30, $5.60.
That oil has turned lower. It's down 30 cents to 57. Gold sells off once again. Bounced back some yesterday, but it's at 43.35 a troy ounce after crossing.
We were all hanging out at the jewelry box down there at James' house.
That was on Monday. That was records highs that we
$5.60.
Serious pullback on Monday in metals. Bitcoin $88,000, $98.07. The 10-year bond yield 4.16.
How about giving me a little bit more?
Market here on Schwab Network, live at the CBOE, is with us. We're certainly taking a look at those jobless claims. You do think that maybe they could be skewed. You want to see more data, right?
Hello, Nicole. Yes, I mean, when you think about jobless claims this time of year, and you see a number like 199,000 first-time filers for unemployment insurance, the skeptic in all of us thinks maybe this is a holiday market. A lot of economists are coming out post that. Remember, we were talking about it live on the air, and post that, a lot of economists coming out and saying this might be a holiday skewed market. And you can say that for once the government shut down started until now, economic data has been a disaster and a mess all the way up until now. And now holiday market's coming in, so 199,000 is a really good number. I guess it's better than a weak, a really weak number, but people are skeptical that this is a real number. They're looking for next year where we expect the economic data to start being a little smooth, a little more consistent, Nicole.
All right, next up, NVIDIA. More good news, more chip offerings and orders and things.
NVIDIA up $1.20 on a down day for the market. Why? Well, if you remember their last conference call after their earnings, Jensen Huang said any China business would be extra and on top of their consensus views for next year. Now, we see orders for as many as 2 million chips coming out of China. ByteDance and other firms are looking at $27,000 per chip. That's $54 billion in revenue. In addition, remember, that's all extra. So NVIDIA, also Taiwan Semi is strong today on news that they're going to have to up production of these chips as well. So certainly good news for not only NVIDIA investors, but the U.S. government as well, as they get 25% of the revenue from those chips. So good news for everyone in terms of NVIDIA, more business selling H200 chips to China, Nicole.
All right, thank you, Kevin Hanks. Great to see you. All right, now it's time to take a look at the bigger picture. You can take a look at all the strategists on Wall Street and around the globe. But right here, from the New York Stock Exchange, I'm serious, Jay Woods, Chief Global Strategist at Freedom Capital Markets. Now, we've known him around town as the regular nice guy. But in the meantime, Jay Woods, a year ago, had the target at 6,900. On Friday, intraday, the S&P high was 69.45. We are right around 6,900, so congratulations, Jay Woods, for getting this so right.
Well, thanks, and we go by Price is Right rules, so we're just, I'm over, and then that will nullify the call. But yeah, we expected a good year. 3 years of double-digit returns was something that we thought could happen. Now the question is, what is next? Let's not come here and swipe the football. It was great. Sometimes you get a little lucky, and after Liberation Day, I was questioning my thesis, but we also learned that we backed down from some of those tariffs, and the economy was good, so we thought would happen and would be a strong second half of the year, and now we're kind of like stumbling into the next year as to what's going to happen. And as we enter January, there are a few things that have me concerned.
You were back to support, has to hold.
Next year is 3 to 5% higher, around 7,200. So an up year, bull run continues, but not at the stampede that we have seen this bull take off. We've only had more than 3 years of double-digit returns once, and that was .com. I don't think we're going to get a fourth year of double-digit returns next year.
Yeah, I mean, we're going back to, you're going back to the 90s when you're talking about those double-digit returns consecutive years. When you say 3 to 5% for next year, people got spoiled. They love seeing that the Nasdaq's at 21%, but with this 3 to 5%, does that mean down 5% or down 10% and then up? I mean, do you expect a lot of volatility?
I expect a lot of volatility. It's an election. It's an election year. Well, we get a 10% correction on average every 18 months. So yes, you go 18 months from April.
We used to.
We bottomed, and then we're due for another 10% correction. Not the end of the world, but when you live through it, it's hell. We have 3-5% corrections on average per year. So I anticipate a lot of volatility.
This guy doesn't know.
Some of the headwinds we're coming into right out of the gates. Supreme Court decision on tariffs. New Fed president. How will the new Fed chair get along with the rest of the troops? We expect someone that wants to cut rates, but if you look at the dot plot, we're only positioned for one cut over the coming year, and then we have 4 new Fed voters. Two
I'll
of
give
those
you
are
a
very hawkish. So
C+.
It's going to be interesting to see if the Fed will continue to be a tailwind and we cut rates, or we'll have that headwind. And then turnover in Washington is anticipated come November. A long way to go before we jump into those waters. But these are things that the market doesn't like, uncertainty.
You talk about 5%, 10% pullbacks. So 18 months, that would be from the Liberation Day. That would put us into 2026.
Yeah.
You talked about 5% sell-offs a year as an average. So you're going to have days like that or weeks like that. Are those screaming buy opportunities for you in 2026?
I think there are pockets of screaming buy opportunities right now. There are stocks breaking out that no one is talking about. No one is talking about ExxonMobil breaking out to 52-week highs and on the verge of a 5-year breakout. Why? Because it makes no sense. Oil is $58 a barrel, yet ExxonMobil is starting to make new highs. Something is going on, and then we see these inflationary fear trades with gold making new highs, copper, silver making new highs. Copper and silver scare me because those will come back and hurt some of these tech stocks. So I don't think technology is going to lead. And when you want to see big returns, you need to see it in the heavy hitters, those Mag 7 names. Those are pulling back, they're consolidating. I don't think the trade is over by any stretch.
Not any stretch.
The leadership we're going to need to take us much higher than, say, 5% over the coming 12 months.
There's been a lot of excitement around Tesla because people are looking at it not just as the EV maker, but Optimus and robo-taxis, especially the Cybercab, a lot of things, and SpaceX, and just all things Elon Musk, right?
Yeah.
It's 2026 Elon Musk's year. Tell me where you think Tesla could be headed. I mean, right now it's at 453, the high was 498.
Yeah, no, technically is how I look at Tesla. Tesla is a cold stock. It's about Elon Musk. Well, Elon Musk had a crazy 2025. He's out of Washington. He's put that behind him. He seems to come out unscathed. It is not about EV sales. If we're going to focus on EV sales, then Tesla is not for anyone in this audience. What is it about? It's about the future. It's about robotics. It's about what's next. It's about his pay package. This gentleman has delivered every single time he's had a pay package with incentives. Well, guess what? They will start to kick in starting next year. So I expect Tesla to do well under his leadership. And then you look at it technically as a CMT technician, this stock is breaking out to new highs. It's pulled back a little bit. If it breaks 420, then this trade that I think will lead us into next year, I pull back, I go on the sidelines, but I think it's poised to run not just the 500, but well into the 600s, a good 20% gain. It's just below the S&P 500 as we stumble across the finish line today. So I think Tesla is poised to have a great year, and it's not going to be about EVs and car sales. It's about what the future holds and what that pay package and those deliverables on autonomous driving and robotics lead for Tesla and lead for most.
Tell me about FedEx. Why FedEx?
FedEx, well, you look at the transports. The transports are breaking out, have already broken out. We've seen it in some of the trucking companies. Well,
Yep,
what's on
here
the
we go
sales?
again, another squeeze.
Stock has gone nowhere for 3 years. As a technician, you look at what's gone on. They've made some structural changes. Fundamentally, technically, if this breaks above 300, it's got a runway to go at least 20% higher. It's made a tremendous run. It's pulling back from that run in July lows. It's up, what, 5% for the year? I think that's one to watch for 2026. And then you ride the coattails. UPS is a beaten down stock. It's broken a long-term downtrend, has a lot to reverse.
Has to hold
These
here.
two stocks can be leaders
To stay
in the
bullish.
transport section next year.
All right, Jay Woods, the man who called market for
That's
a
me.
year ago. Thank you, and good luck for next year. I'm not sure people are going to love 3 to 5% gain, but they'll take it. It's better than down.
That's horrible.
Chief Global Strategist at Freedom Capital Markets. Thank you. Coming up, Options Corner.
There's nothing to brag about.
Usual options activity from the day and how investors are looking to trade on recent news of Netflix, Invesco, and Quest Diagnostics. Stay with us.
How dare you? 3%? You kidding me? Let's say I had 3 billion of it, and I get here 3 billion. You give me 3% a day. I can do that, boss. Dun-dun-dun. Spies above the VWAP. Trying to fight the 9. So 50-cent drop.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. It's time for our options corner, where we analyze unusual options trades that we are seeing throughout the day. Welcome in Rick Ducat, lead market technician, and taking a look at a few names here. Of course, so much news on Netflix with Stranger Things, NFL, and all things Warner Brothers. And you found an unusual to bullish trade. Tell us more.
Today for this options corner segment, the last trading day of the year has a lot of large closing trades. It's a lot of sifting to go through here. But as you said, Nicole, Netflix is dominated in terms of its news coverage by weighing the prospects of this potential deal here. So when we did look at this trade, there was one very large trade that very obviously stuck out in the tape today. So when we look at this one, minus 13,755. January 16th, 101 strike puts at a 755 credit here. So that equates to about a $10 million credit received for this trade. And these are all opening trades here. I do always try to find opening trades here for this segment. And this was an unusual trade. Why? Because they were selling puts that were already in the money here. So they have the possibility of immediate assignment risk here. So kind of an unusual setup here, but selling puts, as always, just single puts would be neutral to bullish here. Max profit, $10.3 million. Max loss, catastrophic, $128 million if the stock were to go to zero here. We can see, though, that if we were to look at the figures for this particular stock here, Netflix has been struggling lately in terms of getting some traction here, pushing to the upside. But we can see now that this particular trade, just kind of an unusual setup here for this one. We can see that it could be paired with some kind of other strategy here. We don't really know the full setup here, but this trade alone, 7.2% of the total options volume in this name today.
All right, well, you always grab the good ones, the ones that are busy, the ones that are heavily traded, and you talked about an opening trade. Thank you for that, and we'll continue to watch Netflix. I mean, they had incredible numbers with the end of 2 NFL games, the 1 o'clock and 4:30 game. Also, Stranger Things was the most watched thing around the globe and helped the AMC movie theaters and Cinemark. And it looks like Warner Brothers is still leaning towards Netflix over Paramount Sky, so we'll have to see. NASDAQ 100, neutral to bearish trades you found. Let's hear about this.
Tech has been the story of 2025. Obviously, the whole AI boom has been a very significant piece of news for this market here. But what we see lately in the Qs of the NASDAQ is a triangular trading shape here, where we have a series of lower highs, but also higher lows at the same time here, price kind of compressing in an increasingly narrowing range here. So when we think about the prospects going forward in this 2026 year, here, it seems like one trader at least was making a pretty big play based on the idea that we won't get too far above those all-time highs that we saw near about 637
Spike him to the
or so,
VWAP.
in the Qs. So the trading question, minus 15,500, April 17th, 645, calls at a 1425 credit. A $22 million credit received here, so quite a sizable trade. Neutral to bearish if this were indeed an opening play here, just standing on its own. It is an opening trade once again here. But this one, we can see that, this kind of trade probably is paired with an existing stock position here to generate a covered call. Naked short calls would be quite risky. Covered calls would be a much relatively lower risk type of play here. So max profit would be the $22 million credit received. Max loss would be unlimited because the stock could theoretically go up to infinity. 107 days till expiration. If we were to think about the expected move during that time horizon here, it's about 9.6% plus or minus here. So our break even would be 6.7% to the upside, roughly aligning with those old all-time highs. So within the realm of possibility here, but kind of near the upper edge of that probability expected move area here. In terms of the total volume, 15,500, only about half of 1% of the total volume in this very actively traded name today. But the sizzle shows elevated activity, 3 times the 5-day moving average.
Out of which one?
Today here, as this year draws to a close.
Okay, well, you're hitting it on the head because people love to look at this tech trade, but as you just heard Jay Wood say, it's not going to be just all up arrows next year. You better get ready for some volatility and maybe some pullback. And Quest Diagnostics, neutral to bullish.
Yeah, so this one, not really a ton of news about this name. This is more of a quieter name here, but we did see Zacks raised its rating to upgrade, upgraded it to buy yesterday. Didn't have a price target, but there was one trade that really stuck out. This trade was 80% of the total volume in this symbol today here, so that would give it a very high sizzle. The sizzle was over 15 when I checked. Anyway, the trade, minus 1,000 February 20th, 180 strike puts, and an 884 credit. So selling puts would be neutral to bullish. All of our trades are just going short opening trades here for single options. In this case, selling the puts would be bullish. Max profit, this is our smallest trade in terms of our dollar amounts we're talking today, about $884,000. Max loss, if it were to go to zero, would be about $17 million. The break even for this trade would be about 171.16, about 1.6% to the downside here. Expected move during our time horizon of 51 days would be about 7.1% or so. So as I said, this trade was, really only the notable trade in this name today. 80% of the total volume always stands out here. And the reason I like to focus on things like that, first of all, because it stands out, it shows a high amount of conviction. Someone has a really strong opinion about this name that doesn't see this much activity still. It also gives us a read on perhaps where you might find important price levels here. So in this case, someone really has their eye around that 170, 180 level when you account for the break even of the strikes roughly.
Rick Ducat, Happy New Year. Thank you always jumping in here for Options Corner. Always so great on the charts and giving us all the details that we need. Never missing a thing. Rick Ducat, thank you. Coming up, AI. Well, it certainly was what we talked about all of 2025. Is that going to dominate 2026? Of course, data center power, memory stocks, and the bets on a rate cuts. We'll have to see. More about the new year and your trade and your portfolio. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Penaleves. We're live on the floor of the New York Stock Exchange. I want to welcome in our next guest, Charles Moon, stock strategist, Prosper Trading Academy. Charles, it's great to see you. I haven't seen you in a while. We have a lot to talk about and catch up on. I mean, the nuclear energy story has been a big one, how to power these data centers, and they've come up with a lot of different ideas. What are you thinking here? Are we going to see more spending on this sort of road?
Yeah, 100%. I think this is where the biggest advancement in AI is really going to come into play. To be able to power, what's required so that these machines can actually learn and get into the segment of AI that's going to be actually extremely profitable. This is where we need to see, these companies make this leap in technology. And we've seen how fast technology has evolved over these years. It wouldn't surprise me that it happens sooner than later. The timeline is actually projected out towards 2028 or a little bit later in terms of advancements. But if somehow this could be accelerated, this is where the segment could be really sneaky in terms of very bullish upside plays for the AI segments. Names like OKLO, SMR, NNE will be on watch. They've fallen from the skies here because we've realized that the market's gotten a little ahead of themselves. But this is probably going to be one of the most important parts in terms of advancements and growth of AI and AI story.
All right. Well, look, I mean, we were talking earlier about memory stocks, too. Do you think this group is a go-to? Names like you're looking at Western Digital, Seagate, Micron. Some of these have been really great performers, too.
Yeah, 100%. And in fact, when we look at the entirety of the AI story, this is the segment that's actually held up the best for the entire year. Micron's still pushing and making new all-time highs just as far as yesterday. We've seen how demand has actually accelerated in Asia. We're not going to see any slowdown in the United States. This is probably the one segment to watch for, consistent growth with lesser volatility in 2026. And it looks like right now Wall Street's betting that Micron, MU, is going to be the leader of this segment. We've seen STX trading at these levels is shocking when you look at what the price points were last year, and they're knocking on the door of $300. It's almost as if they came up really sneaky all year long. They've been trending really strong and still maintaining trend. But it really does seem like they're really set up really well for 2026 to not only sustain their momentum, to also be one of the leaders, if not the leader, of the AI segments.
I mean, yeah, you have to have this in your portfolio. I mean, what percentage of a portfolio is what parts of AI or the memory part or the energy part? I mean, how much of a portfolio are you going to put to work in this group?
Well, for me, in terms of how people want to invest into this sector, it's all about risk tolerance. This is going to be the most volatile segment, right? Anything related to AI. We've seen explosive growth. We've seen really tremendous pullbacks in a lot of different names. And so, for me, I like bottom picking on great value and looking at it for the longer term. You're going to want to, focus and concentrate more on the standouts to, I guess, lessen the volatility. But, obviously, if you're looking for hard acceleration in your portfolio, you sometimes just have to take the leap into some of these names. People thought that NVIDIA was a little bit top heavy and a little overvalued in 2024. We've seen that NVIDIA is still marching along. We need to try and find, I guess, better opportunities on these pullbacks. Trying to invest in Micron at these peak levels is going to be tough to digest for the investor. But that being said, performance is still performance, trend is still trend. I'm a big believer in AI. I believe that this is not a bubble. Maybe certain segments like the quantum sector could be a little bit too early, but ultimately this is the actual transition. This is where technology is veering. Otherwise, companies like Google and Meta and Amazon wouldn't have the CapEx just on this calendar year alone investing into this sector.
Yeah, I mean, what do you think about what's going on with the Fed? I mean, are you counting on a rate cut? Do you need a rate cut? And obviously the Fed chair is going to be changing too, but right now we have one price in. Whoever comes in is going to do one. So there's your one. How important is who runs the Fed or getting rate cuts to you?
This is where it gets tricky because it's more important about what Wall Street thinks, right? It depends on what Wall Street thinks in relation to where we are with inflation. The Fed policy stance has been long stated that they're looking for
He's like he wants to break down here.
Inflation average average rate, right? And there's concerns that if the Fed stance is too aggressive in cutting rates, that this could really stabilize inflation and not allow it to come down to that 2% average. And
this is where you got to watch it the closest.
Which Fed head is going to be elected. There's a chance that
right
they
now
can
it's
really
130,
make that push. They make that
230.
Jump towards trying to do more than two, maybe even pushing.
Still got a half hour to kind
And if they're knocking on the door,
Well, could we drop a little more?
Doubt, especially if it's someone that's handpicked by Trump and more in line with Trump's policies, it would make a lot of sense that that individual is going to be looking to initiate half basis point cuts instead of quarter basis point cuts on their first initial rate cuts. So, we've already seen an individual like Fred Mirren looking and pushing for a 50 basis point cut. I don't know if that's going to be the case. And again, I don't know how the markets are going to react to this. I think that's going to be really telling. If the market does find this very positive, well, then certainly we know that the rate cut is equate to a bullish market reaction. Maybe that's tried and true, but if there's some concerns, it may just cause a lot of volatility and uncertainty. And generally with volatility and uncertainty, the markets never go up, they usually go down.
And I also think about, I know that there's a lot of geopolitics that are happening. They're trying to smooth a lot of this out. We had a few meetings in Florida, government shutdowns. We had one. I hope there's no more in the new year. But, are the pullbacks buying opportunities?
Oh, now it's really looking good.
Buying opportunity because it has been year after year after year after year. I mean, at what point do you not buy a pullback?
Well, I guess it depends.
Prepare ye in the name of the Lord.
If we're talking about higher quality names, like three names that I absolutely love for the upside in 2026 would be Oracle, Meta,
got a new chair
and
and
Netflix. All three of these stocks are under the 200-day moving average, which is somewhat unfathomable for names like Meta and Netflix. We're talking about the king of communication services. We're talking about the king of media right now. And what's really underrated about Oracle, in my opinion, is
get a coffee and come back.
Got ahead of themselves because of that earnings report.
I'd love to stay here and do this buy.
It caught Wall Street by surprise. They immediately corrected themselves. Oracle's well off of those levels, off of earnings, but they had that recent news. They're now part owners of TikTok. And this is a segment that could be, in terms of short-term and long-term growth, very bullish for a name like Oracle. And of course, if they could figure out, their data center issues and actually have the capabilities of potentially achieving those, really frothy booking numbers, Oracle's severely undervalued for the long term. And, Meta being the powerhouse that they are, I think they're being overly punished for their CapEx. These three names just make a lot of sense, for investors to be looking at these pullbacks. It's almost as if it's a short-term gift. Historically, these stocks have been strong performers. They have maintained a lot of time and depth way above the 200-day moving average. So I think these are names that I would be looking at to buy the dip.
All right, Charles Moon, Stock Strategist, Prosper Trading Academy. Great to see you. Great picks there. Because
Okay.
those are the ones people love to talk about, too. Thanks for
I got
joining
something
us.
to talk
I
about.
wish you the happiest, healthiest new.
Check out the SPX, baby. Yeah. That's what I'm talking about. Oh, yeah. Oh, gosh. Randy, prepare ye in the name of the Lord. There it is. Oh! Here it is. Okay. So we're kind of a little far out of the money right now, and I want to be a little bit closer. So we're going to move them to the 68.80s. And it's going to go a little bit like this. Okay. There it is. $68.80s at $3.10. I hope nobody has a problem with that. If you do, you're sitting in the wrong place. Because I ain't fucking around on this one. Boom. They're now $3.20. They were at $3.50. Another $3.40 again. The crowd's going wild here at the sports arena. They're now at $3.60. So rookies should be selling. $3.70. $3.70. Oh. Oh yeah. Beautiful. Magnificent. $3. No. Oh, God. How dare you? Oh. There's a bunch of sheets. They are now at $3.60. So this is a resistance level that needs to break or it pulls back again. This is the fourth time it's up here. They are now at $3.40. Boom, boom, boom. The average is 293. It's still bullish because it looks ascending. I think everything had a pretty good pullback, including some of the chips. Right now I'm at $3. Stay. I think it would be the best thing for you. If you had any kind of sense. And have a boom. Like $1. $2. I'll take that. Okay.
Apple earnings 2025, they were the dog of the Mag 7, right?
Yep.
Especially with
No, weren't you saying this the other day?
Tim Cook did an incredible job, one, getting a dozen 747s to fly a bunch of iPhones here right the night before tariffs hit, but also just to manage the tariff impact, to manage the administration, relationships across borders, did an incredible job. And when you look at, even smaller opportunities in the small to mid-cap space, that's really something you want to focus in on is good leadership team. How are they managing the balance sheet, the CapEx? How are they managing, if at all, stock buybacks and the importance of those to drive returns? That's a big factor that we look at, but it's not everything.
Understood. It's great to see you, Jeff. Thank you so much. Jeff McLean, CEO of Solidarity Capital, Solidarity Wealth. Enjoy your happy new year. May it be a good one. Coming up, we're getting ready to break it down and look at the Fed because the Fed can drive this market. While some say we're too Fed fascinated, others think the rate cuts are imperative. We'll be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks in...
Goodbye. Now we're resharing the double bottom here. So the major support level. And we got 14 minutes per hour. Oh. Just gotta hold here or Jimmy gets out. I'm about even. I'm even, Steven. Just break it and make it. Yeah, this is pretty close.
and they just want to wait and see what happens.
There's plenty of people who think that the tariff story really has stabilized, that tariffs will not equal inflation. There was talk at one point that tariffs were going to blow inflation crazy. That didn't necessarily happen, and sort of we're seeing a stabilization. Jeff, do you think that if inflation sort of stays where it is, but there is concern about labor, is that the picture? Because it seems like the Federal Open Market Committee members seem to mostly agree that a cut could work. It's just when. It's the timing of when they want to do the cut.
And look, well, having groupthink on any committee is not a good thing. So you wouldn't have the Austin Goolsbys and the Stephen Myrons going in opposite directions. I hope they're sitting around and arguing with each other. That's the way a good committee should function. And, Kevin brings up a very good point. The data right now, because the government shutdown, is making any heads or tails out of that CPI print. There's been a lot of skepticism with regard to that. What were we collecting in data in the autumn? How do we even know? You could say that some things are a little bit easing now, to use that term. We printed one handle on year-over-year case Schiller the other day. Wisdom Tree Research continues to find negative year-over-years in rents. Those are two big line items in the household purse. So we probably have something relatively stable. But that PCE continuing to be stubbornly above 2%, they're in a little bit of a pickle in the near term until we can get a little bit of smoothing out and more solidity in these figures.
Obviously, so many clients, and what's on the agenda? What are you telling the clients? I'm sure they're calling and asking a lot of questions, and you're serving your client first for the most part and growing Wisdom Tree. Just, what is the outlook when you tell them about 2026, Jeff?
Well, I mean, the last fellow that you had on there was pretty bullish on the Mag 7. We've been concerned about the group. We have a big, massive analyst team. I'm thinking about my colleague Brian Manby putting together some of these exhibits with how many firms, what percentage of the firms are trading for north of 10 times sales. And I mean, a lot of stuff showing up 1999, 2000. And you can put the finger directly on Silicon Valley. So we have a lot of trepidation with regard to that area. We've been steadfastly constructive in EFA-style mandates. It was a very good 2025. We figured there's some years to be made up on that end. So we think that we could probably get some alpha in 2026 in developed equities. A lot of the themes and theses that we're on haven't really changed in my view.
Yeah.
These equities, for example, with the NISA expansion, the corporate governance reforms, and so on. So that's pretty much where we are. And with that big red flag, I guess you could say, with the Broadcoms, Teslas, and Silicon Valleys of the world.
Yeah, and Kevin, I'm not asking you to make predictions, but maybe some surprises or some things that you're waiting, secretly waiting for, or maybe you have a base case or a bull case. What are you watching?
Well, when we think about our base case going into 26, we think that, S&P will be up 8 to 12%. We think international is going to be flat to up 10%. And we think GDP growth is going to be 3%. And you're going to get inflation at 2.6. So at the end of the day, where I think the surprise is going to come is actually on the fixed income side. I think that you have a dovish Fed here, and at the end of the day, I think that the long end is actually going to steepen. And so we think that the 10-year Treasury is going to finish next year somewhere in that 4.25 area.
That's
so not even if the Fed does lower rates further, we think that we've seen pretty much everything that's going to happen as far as the 10-year going down further as far as yields are concerned.
Yeah, I mean, when you think about the different sectors, just quickly, Kevin, I mean, is there go-to ones for you or the avoid sectors in your mind?
Yes, and this is where Jeff and I disagree. We continue to like technology. We believe that the Mag 7 is still the place to be for all intents and purposes, because a lot of these companies can weather the storm. They have a lot of free cash flow available to them, and they are able to see their way through rough times, which is unlike a lot of other companies. We do think that we will see some broadening out as far as the sectors are concerned. We also like financials as well.
All right, and Jeff, you know, as I think about some of the final thoughts here, because this is the wrapping it up and no Santa Claus rally, still have 2 more days to complete what is technically a Santa Claus rally parameter of the 5 last trading days and the 2 first trading days. Do we see it? Does it matter? You have 3 great years.
Oh, individual sessions, I haven't the foggiest idea. Who knows what will end up happening in the first trading sessions of the new year. But look, it is a raging bull market. And let's figure out the line items here. Broad U.S. equities, gold, silver, basically the metals complex in general. We have a 4 handle on headline unemployment in this country. We have inflation that had a 9 on it and is now 2-point question mark. We call it 2.7 for now, but we'll put a question mark on the back end of that with the October data. And you have a Federal Reserve that may give us a cut or 2 in the face of that. I'm not sure why they're doing it. Doesn't make much sense to me. But that is the type of thing that can sustain risk assets heading higher. Again, the question is whether or not the top sectors in this group can continue to maintain. But that's where we stand heading into the year. I'm not sure what would upset the apple cart just yet.
Yeah, and look, ETF strategy, there's been so much interest. Inflows in ETFs have been incredible. That's where people definitely like to have some hedging. They're not in one position, you know. The ETFs have become extremely popular, and most of the folks I speak to still think that's the case for the next year. Kevin, you get the final word.
Well, I think that, you know, a lot of people are saying that this is equivalent to 1929 or 1999, and we think it's more like the 1950s and 1960s, where we can sustain growth for a longer period of time, and that's where we think we are right now. That's the cycle.
Wonderful to see you both. Jeff Weniger, Head of Equity Strategy at Wisdom Tree. Kevin Nicholson, Global Fixed Income CIO, Riverfront Investment Group. Great to see you both. And friends, thanks for being with me here on Schwab Network in 2025. This is the Watch List. I see you every day at 9 a.m. and 2 p.m. So I'll see you next year, right? I wish you a happy, blessed, healthy
Back
new
down to
year.
support again.
And keep it here on Schwab Network every single weekday, because we do have you covered all day long. I'm Nicole Petalides, live at the New York Stock Exchange. Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Good afternoon. Only 1 hour until the final closing bell of 2025. This is Market on Close, and Alex Coffey filling in for Marley Caden, coming to you live from our Chicago headquarters.
We're nearly there, Alex. Just one bell to go. I'm Sam Butters, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show, the final one.
One bell.
2025. We'll dive into the economic outlook for 2026.
No, it's not power hour. Oh, God. Look at that.
AI. Later, we'll look at the housing market and if affordability will continue to be the biggest concern in the new year. And in Options Corner, we'll take a look at options activity around Alphabet after a bullish note from Citizens. So for now, Alex, take us through what's been on your radar today.
Yeah, take a look at the markets. There is red on the screen, Sam, and in some cases it has actually gotten a little bit worse as we've gotten closer to the end of the day. Notably, the Russell 2000 is down about 0.6%. Earlier today, all of these different indexes were trading almost in lockstep, all down around 40 basis points or so. That's where we find the S&P and the Dow, the NASDAQ down about 0.5%. But the story all day long has been very weak market breadth, but not a lot of movement. So right now, in real time, less than 10% of the S&P 500 components and the NASDAQ components are actually higher on this session, but the moves are relatively contained. And what does that mean? Well, that's the recipe for what we see on the screen right there. Let's take a look at some of the other products that we got on our radar. In the futures world, you see the 10-year yield actually starting to climb a little bit into the closing bell here, up 4 basis points. Is a, I would say, pretty significant move, all things considered. Dollar index is a little changed. Gold,
5 cents.
I don't want to say this is plunging just because we have seen some pretty dramatic moves in recent days in the metals market. We don't have silver on the screen, but silver is actually below 70, so if you're looking for volatility, the metals is where the volatility has been. I'm sure we'll talk about that throughout the show. Crude oil, pretty much been hanging out around 58 the last couple sessions. It's back below 57.5 now in the February futures. And Bitcoin, certainly an area that has garnered a lot of attention over recent years. Pretty quiet, though, all things considered. Sam, what else are you watching?
Yeah, well, pretty much on the lines that you were just talking about. It really just feels like wait-and-see mode right now, particularly with a lot of the stories that we've been looking at over the last couple of days. Obviously, Alex, we've been listening to a lot of final calls for 2025 and 2026 outlooks as well, many of which we'll be discussing throughout the course of the program here over the next 90 minutes or so. A big story we've obviously been tracking in the market, and we have seen some reaction as far as NVIDIA, TSMC's stock today, is this China story, reports around, these companies obviously wanting to get their hands on this stuff, NVIDIA looking to TSMC to ramp up some of that production. I know Kevin Hinks is going to go through the details of that story, but I think back to my original point about wait-and-see mode, we just still have to wait and see if Beijing is going to green light all of this, and maybe that speaks to some of the reaction in the market, that they're just not buying into this story just yet. We do need to just wait until we get some sort of confirmation. But then we also got on the macro front these initial jobless claims. Obviously a very quiet week as far as the economic calendar is concerned, not a lot to chew on. This came in with an
encouraging headline number at 199,000, one of the lowest we've seen all year. But just remember, things look a bit funky around this time of the year, given that there is some seasonal factors to consider with Christmas. But all in all, these are just little bits of information that we're working with. We do need to, get a cleaner picture of all of this when we move into the new year. And I think that's sort of where the markets are at right now. But Alex, I'll send things over to you with Kevin Higgs for some of those top movers on the day.
Yeah, thank you, Sam. As she mentioned, I'm now joined by Kevin Higgs live from the CBOE. Kevin, good to talk to you as always. I can think of no one better to kind of put a bow on the year that's been in 2025. So let's start there. Whether it's a big picture thought on the day, the week, the year, I'll leave it open-ended, Mr. Higgs. So what do you got for our viewers?
Yeah, hey Alex, hey Sam, good to see you guys. As I look to the end of the year, what really stands out to me is that April sell-off, right? And then the slow recovery since mid-April, when this market has rallied to where it is now, frankly. But let's face it, that April sell-off was harsh. And it went further than a lot of traders thought it would. And volatility's got to some pretty lofty levels. But then, just like we've seen before, that dip, bigger than most, turned out to be a big dip for buying, Alex. And the market just made its way back. The tariff, the uncertainty around tariffs, the fear around tariffs, frankly, some of it, fueled by Jerome Powell, never really materialized into any real inflation scare this year. So tariffs were on everyone's tongue as we went through the spring and summer, and they just didn't materialize.
Not mine.
It didn't hurt inflation. So looking at that, all the climbing the wall of worry, which we did since mid-April till now, Alex, it's going to turn out to be a pretty solid year for a lot of these indices and a lot of the sectors in general.
Kevin, it's funny you mentioned, kind of that volatility and the recovery, because I think that this year has made the best argument both for just being passively invested and doing nothing, but you also, at the same time, it had so many incredible opportunities for the active investor as well. And so in some ways, it's provided a tremendous amount of, reasons why both approaches can work if done properly. But I want to get some of the stories because, weirdly, it's been kind of a quiet day, but there's been kind of a lot of news. Let's start with this Nike filing. Now, for those who are big on insider activity, some big-time insider buying here in Nike.
Yeah, Elliot Hill, the CEO of Nike, who is a Nike lifer, coming back to the company to take the mantle of CEO, bought about $1 million worth of shares, 16,388 shares at an average price of about $61.10. Comes out to just around $1 million, Alex. So, people talk a good game, as you know, and talk is awfully cheap. Elliot Hill putting some money on the line here with Nike. Remember, this stock has been beat up. You saw Tim Cook, a Nike board member, earlier in the month do something similar. So in these filings, some pretty high-profile names taking stakes in Nike, Alex.
Yeah, you're starting to see the stock, work its way off its lows too, Kev. Traded down around 57 just about last week, trading closer to 64 a share now in real time. But this is a big headline, this NVIDIA story. It's kind of gotten lost in the shuffle as we wrap up the year, look ahead to next year. But H200s, apparently there's some demand for these chips. That was the big question when these headlines started to break about a month ago. What was the latest?
Yeah, remember, this all started back on the NVIDIA conference call when Jensen Huang said anything from China is extra, right? It's not in our numbers. It's not in our forecast. So the fact that as many as 2 million chips are demanded from companies like ByteDance and others, 2 million chips times $27,000 per chip, that's $54 billion in revenue. And what can confirm that? Remember, because there's some pushback from the Chinese government, whether they're going to let them do it. What can confirm? the fact that Taiwan Semi is upping production of those chips. So that's action. That's not theory. That's not talking. That's Taiwan Semi acknowledging that they have more demand for these chips. So when you get this all together, it's good for NVIDIA, good for Taiwan Semi, good for the U.S. government. That's going to get 25% of some of that. And so, you know, even though it's a lesser powerful chip, the H200, it's still pretty significant for NVIDIA. A stock that is, what, $25, $27 off its recent highs? So pretty significant turn of events here. That's why NVIDIA bucking the trend here has been positive all day.
Yeah, and this story citing the sources, the reports says that there's like 700,000 of these H200s in stock for NVIDIA. So there wouldn't be rumblings of TSMC ramping production up unless this was thought to be not even necessarily a done deal, but pretty close to it. So I think there's definitely legs to this story, and the move you see in TSM shares today suggests the same. Kev, I know another stock that you watch closely is Tesla. You know, Michael Burry was trying to stir things as he does on social media. But also there was some news from Elon and team around this Cybercab, which I know is just totally fueling the hype cycle.
Alex, if you looked at people, you know, Tesla's a polarizing stock. But if you look at people that love Tesla, they say the future's here, right? By the end of 2026, you're going to have probably Optimus robots, you're probably going to have Cybercabs, you're going to have a lot of things that are going to change the profile of Tesla as a company. So the fact that CEO said Cybercab production ramp to start in April. So, I mean, that's a quarter away when these are going to start. So, like I said, the reasons why this stock has climbed late in the year to as much as I think $498 was the high was because people are thinking these Optimus robots, the full self-driving, robo-taxis, robo-cabs, these are, or cybercabs, sorry. These are all concepts.
We're still
that
safe.
Are closer on the horizon than they've ever been, and people are starting
Look
to
at the
get
weekly.
excited.
Yeah, Kev, one thing I've learned from you over the years, the importance of the story and the narrative, and Tesla never short of that.
In the daily, we're
Kev,
close to a
great
pivot
new
point.
year. We can wipe the slate clean, do it all again here soon. Sam, with that, I'll send it back to you.
Thanks so much for that. Kevin and Alex, well, coming up, we'll look ahead to 2026 and discuss the impact that AI will have on the labour market. Stick around, we'll be right back here on Market and Phones.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on
Yeah, it's
Schwab
real close
for
on the
market insights, live support,
daily.
powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange.
Nicole!
This is the Watch List.
Come here, sister.
Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and
That's right.
insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
God, look at that.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast
good.
that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
What to do?
Welcome back to Market on Close. I'm Sam Butters here on the floor of the New York Stock Exchange alongside Alex Coffey in our Chicago headquarters. So let's welcome in our next guest, Sandra Swirsky, founder CEO of Integer. Thank you so much for joining us, Sandra. I hope I said that right. Look, we know sort of where the economy is at based on the numbers. We are waiting for a bit more of a cleaner picture from the January prints because, of course, we've got all
January.
this backlog that we've been dealing with.
There she goes.
Obviously, things have been a bit
January.
distorted around Thanksgiving and also Christmas. But we want to talk about AI and, the impact because we've heard a lot of Fed speakers talking about that, how they're still sort of wondering and trying to gauge what kind of impact this is having on the labor market. So what are you seeing out there?
January or February?
This is very much coming from Washington, from a policymaker's perspective. And I think what we're seeing in Washington is while reports from entities like Goldman Sachs tout a storming economy, rather a great economy for 2026. At the same time, they're not saying that we're going to have a great labor market in 2026. So the growing economy is not commensurate with the stagnating labor market. And I think what a lot of policymakers are wondering is whether AI and all of the money that companies are putting into AI is tamping down the labor market. And the labor market is where their voters are.
Yeah, so Sandra, if we are seeing a stifling of hiring, particularly on sort of the fresh out of college, entry-level employment that's so critical to getting your start and getting your foot in the door at some of these different companies, because maybe some of those mundane tasks are some of the early places that AI is adding efficiencies. We know there was a tremendous amount of hoarding of workers post the pandemic. What's the kind of answer to that? What's the numbers that we're watching? Are we watching that the job openings number to get an idea? Are we gonna see some of this fresh college graduates go back to their summer jobs for the time being? Like what is the answer to this? We're probably not gonna have mass unemployment, I would imagine, but how do you see this playing out?
Sure. I think in the short run, we're going to see a lot of angst, and that
Oh,
angst
yeah?
is going to bubble up to their parents, to their communities, and that angst is going to be directed at members of Congress.
We got yanked once here.
And whether we see some new incentives out of Washington for hiring, or new incentives
No,
for retention,
we don't want that.
That remains to be seen, but we're going to start hearing about that in 2026. The labor market for last year's rise was awful, and if we see that again in 2026, I suspect that we're going to hear a lot more from Washington about what we can do, what Washington can do to reverse that, or at least to ease it. Because a growing economy is fantastic for most, but not if you're looking for a job and it's not showing up in the labor numbers.
Yeah, I mean, it's a very interesting point you make. I mean, people vote because of based on how they feel. So as far as, having your ear on the ground there down in Washington, what are the politicians saying? What are they doing about this?
Yeah, so looking ahead to November, we have an all-important midterm election. Republicans right now control all of government, and the Democrats are trying to make an inroad with notions like lack of affordability, and jobs and the job report plays into that for sure. And I think what we're going to start hearing a lot more about in the lead up to this election are Democrats talking about not just an affordability issue, but a jobs issue, that AI, which is being touted by the administration as a cure-all, and is really tamping down jobs numbers, not just for people coming out of college, but for everyone who's unemployed. I'm not sure that's fair, but it is going to be their message.
Sandra, one of the big themes within financial markets and the economy has been this K-shaped element, as it's described, where if you're invested in assets, you've largely kept up with things and you've been able to profit from these increases in productivity and investment in AI. Where if you're on the lower end of the wage scale, you're a new graduate, you're struggling to get employed, it's been tough. I imagine as we go into midterms, and you kind of allude to this, sort of more populism will be the rhetoric, regardless of allegiances, right wing, left wing, etc. Do you think that's safe to say is some of those topics and disgruntled natures of that bottom half of the K start to be more of the political conversation?
I think you're absolutely right. And it is not just Democrats or Republicans, but it is the members who are close to the ground of their constituents. I think we're going to see a little bit of that with our new New York mayor, and we'll see how he plays that either successfully or not. I think we're going to hear that from former members like Marjorie Taylor Greene on the Republican side of the aisle, who is as concerned with the lack of affordability and jobs numbers being where they are. We are very much in a K-shaped recovery, meaning that if you're at the top of the K, you're doing very well. The surging job market, or rather the surging stock market, has done very well for you. But if you're towards the bottom, you are hurting, and the affordability issue is a real issue for you.
Sandra, while you have a great perspective, certainly from a policy point of view, I'm just wondering, with
Not really.
corporates, what you're hearing and seeing, I mean, if you're a young person thinking about your career, obviously we've seen these big corporates that have been laying off workers, very high-profile companies as well. I was having a really fascinating conversation, actually, with somebody in the software space earlier today, saying that they're actually seeing job postings across some of those companies. And I asked them where they were, and interestingly, they've been mostly around sort of sales and marketing type jobs. But I'm just wondering if you're looking to grow with AI, where you're seeing some of the opportunities right now.
I think for the younger set, those at the bottom of the K, if you are not thinking about how your job and your skills can be accelerated, can be enhanced by AI, you're going to be behind everybody.
Uh-oh.
A lot of money.
Technical difficulties.
Some of it is working, some of it is landing on landing in the garbage bin. If you're a underemployed or new to be employed individual, figuring out how to accelerate and enhance your skills is going to put you at the top of the heap.
Sandra, more of a kind of philosophical question now as we watch this changing technology impact so much. Where does the burden fall to get the next generation into the labor force or being productive? School, I just remember going back when I was in school, it doesn't seem to be that quick to adapt. Curriculum can be stale. You mentioned Washington. Is the burden on professors and colleges to adapt and prepare students? Is it on the individual? Is it all of the above? How do you see that?
I think part of it is on the schools, and that starts in high school. It may even start in middle school. It is adapting AI to the curriculum and making our students more comfortable using AI, not just for their exams and not just to write essays, but to be able to enhance their learning, enhance the scope of what they're learning. And so it very much is an educator's issue, but you hit the nail on the head. Education, whether it's at the college level or at the high school level, moves very, very slowly. Academia moves very slowly. And I do think it is incumbent on policymakers to put the foot on the gas, to make sure that these educators understand that part of winning the AI race has to be with our students, has to be with those who are just coming out of school.
And I'm just seeing here that actually you are the founder of your firm, a women-owned government relations firm. Sandra,
Yeah, that makes sense.
As far as women in the labour force right now, what changes,
Socialist.
what trends you're seeing? As you know, obviously that's been a big part of the conversation in recent years.
It sure has. From where I sit, I think women are hitting a home run. They
Oh,
certainly
they
hit a
are?
home run at my firm. And around Washington, I think women have been stepping up and have been rewarded. When you look at policymakers and you look at who they're hiring, a lot of the top slots are women. When you look at the administration, a lot of the top slots, the influencers are women. So in Washington, I don't see any backsliding for women at all.
Great conversation. Thank you so much for your time today, Sandra. Happy New Year to you. We'll
Help
talk
us.
to you again in 2026. So Sandra Swirsky there. Coming up next,
That's a woman.
And dive into the housing market and see if we could see any changes to affordability on the home front in 2026. Marco Post will be right back.
Almost forgot what they look like. The Dow Jones is down 245 points, and the NASDAQ is down 176. Top trade stocks by the S&P by volume. We have the Nvidia and future products. U.S. dollar 98. Crude oil. Mega cap tech are down today also, including Apple, Amazon, Google, Microsoft, Meta, and energy futures are not looking too bright today. They're also down pretty bad in all categories. And we have metals futures not looking too bright in the gold and silver sector, copper and platinum. Ladies, please don't go home too early tonight. Make sure that your freezers are full for at least 2 weeks.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and
Schwab.
a wide variety of futures markets. All with 24-hour support.
Looks to me like I could have me a nice little end of the day run, maybe.
No matter the
Okie dokie. We have, oh gosh, we still have 33 minutes.
Alex Coffey over in Chicago. Joining me now here on the floor of the New York Stock Exchange, that is Jenna Stauffer, who's the broker and global real estate advisor for Sotheby's International Realty. Thank you so much. Happy holidays. Happy holidays. And dressed for the occasion for New Year's Eve. I love it. I love it. Look, you're here to talk about the housing outlook. Obviously, this time of the year, we're looking ahead to 2026. You and I only spoke a few weeks ago, in fact. And, obviously the housing market hasn't sort of picked up at the pace that many had anticipated, particularly with 3 rate cuts in the system already. Where are things at now?
It's been a frustrating housing market for sure. There's a lot of buyers that just feel like they've been completely priced out of the housing market. You have sellers that feel like they're just stuck in place. You have Gen Z that feels like they're never going to own a house. Affordability is going to be the defining factor in 2026. I would say that there's some glimmers of hope though. I do expect affordability to ease slightly. And my big idea with 2026, what I believe will happen wages and prices. You'll really see strong wage growth, and these wages will outpace price growth. And this is how the affordability gap really starts to close. So we just got the latest Case-Shiller read. So Case-Shiller showed 1.4% price appreciation, and it lags a bit. So this was for October, but when you take it back to January and where we were at 4.1%.
Right.
So there's really been deceleration. The market's so bifurcated. I know that here in the Northeast, prices are definitely higher. You have less inventory, so there's more pressure on prices. In the Sunbelt states, I'm based in Florida, you're definitely seeing that deceleration happening, but overall, you're not seeing that rapid, that unsustainable pace of appreciation. So 2026 should really bring us some much needed pressure relief.
Interesting. I mean, what are we talking? Q1, Q2? I mean, what's going to change between now and then to actually see a meaningful change? Because as you say, little green shoots here and there, positive, encouraging sort of baby steps, as you say. We're taking a look at that data yesterday, and yet you're right, we are seeing a deceleration. But then there's also like pockets of the country. I mean, this is such a big country as well. I mean, so you have such diverging sort of trends happening in different places. But yes, what is going to change between now and whenever that's going to happen?
There's not one single factor that will change things. It's going to take time. It took us a very long time to get to this point, right? Affordability is such a mess because of numerous things that have happened over the years. We've had massive underbuilding, we had massive government spending, we had ultra-low mortgage rates, we had parabolic price growth. Just a number of factors got us here. So this isn't an overnight fix. It's going to take time. But when you really see prices, you see incomes, you see rates really align, that's when you start to see affordability start to ease. So it's a reset in 2026. Real estate's very cyclical, and this is a tough housing market, and it's going to take us time to get out of it. But if we can see improvement, specifically with wages, prices, mortgage rates too, you know, they're around the 6% level, lower 6% level. We started this year around 7%. We hit 8% in 2023. So this is an improvement. This does give buyers some purchasing power, specifically those on the margin buyers in 2026.
Not to mention, we just had a very sort of sobering conversation with our previous guest, which was talking about the fact that, you know, obviously the job market is changing because of what artificial intelligence is now doing. So obviously people are worried about that. So you've got the affordability, you've got the rates. I'm just wondering, you know, looking at the housing market in 2026, obviously there's been a big conversation around the home builders as well, the incentives that they've had to come out with to try to get people off the sidelines. Are you seeing anything as far as easing margin pressure for some of those companies, you know, particularly that are dealing with, you know, a market that just hasn't recovered the pace that we hoped?
There's going to still be a lot of initiatives, I believe, with builders in 2026. Right. Builders really overbuilt in 2025, and they didn't have the demand. We had this demand that was just going crazy, obviously, when mortgage rates were low, and that demand has just really slowed down. So builders have to get through their inventory, and in order to do that, they're going to have to incentivize people. Affordability is such an issue because it's not just also the purchase price, it's all these things that come with it too. It's the rising taxes, rising insurance, the rising maintenance costs. It's what I call this lethal combination of factors, and that's what's making it so challenging for people to get into the housing market. They're not incentivized either, because you have about 54% of mortgage holders, they're holding a mortgage rate under 4%, so no one wants to give that up.
I'm interested in some of your notes as well.
There's some rebound.
About how people are going sort of non-traditional method or route about home buying and, you know, home ownership now. I mean, you say that the path looks very different now compared to how it has in the past, and you sort of the reasons why people go out and purchase homes. Can you sort of talk us through some of the trends you're seeing and why?
So the median age of the first-time buyer, it's jumped to 40 years of age.
Right, yeah.
So this is just a totally different environment. And you hear from Gen Z how frustrated they are.
68, 65s.
They have an expensive education, they have a good job, yet they
We
can't
did very
get
well.
ahead, they feel like. They can't get into the housing market. So you're
I watched them,
seeing
but I didn't
Gen
trade
Z
them.
and just young people in general that, okay, if they want to get into the housing market, it's not the truth.
68, 65s. They had a nice little bounce on them 3 candles.
Right after this.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
The 68, 65s are now at $4. They're now running into the 200. Or is it the 63? That's a 63. That's a 63, and what is this? That's the 200, yeah. Thunder.
The Mag 7 up almost 18%. And what we saw today was Citizens raising the firm's price target on Google to $385 from $340. They kept their outperform rating. Basically, they just reevaluated the valuation framework for this name here, strength in the company's search business, the idea that they can further accelerate the revenue from this whole search space here, and also just Gemini, Cloud, Waymo, etc. As I said, so many things it's hard to nail down, but a more positive look.
Yeah, as we look at Alphabet, we zoom in on its technicals specifically. I'm sure it's been a nice looking chart, but has the weakness of the last couple weeks done anything to derail this uptrend?
There was a couple sessions that were looking a bit more perilous here. So what we had was a rising wedge type shape here for the past few months here. We ultimately topped out 328.83 right here. That's our high water mark. But we also could look here right around 306. That was the high point that we had before our gap up. That's not actually where the gap began, but pretty close here. That was around where we hung on in terms of closing prices. We did have one pretty large intraday dip, but now that could give us this channel type shape to watch. It looks like we could even be perhaps breaking out to the upside from this short-term pattern. If we were to look at our moving averages here, our weekly and monthly exponential moving averages here, blue and teal, 5 and 21-day EMAs respectively, pretty close together, right around 309 to 313 or so, confluence to the downside there. Also our old resistance line coming together right in that same area could be a supportive point to watch. RSI also had a bit of a breakout here. We pushed beyond that downward sloping trend line, but no big surge to the upside quite yet. Finally, when we look at our volume profile study, the nodes of interest, the heavy trading areas, the spikes on our blue histogram here, come in here and here and here, so roughly around 320, 300, and 270, 280 or so. Those are the heavy trading areas. Those are the points to watch. Is this just a bull flag, bull pennant type of activity here, or are we starting to really lose some steam?
Yeah, and at the very least, starting to consolidate at these upper price levels, some acceptance perhaps of the market for the new, I guess financial story that is all things Alphabet. But this is Options Corner after all, so as promised, I'll look at some of the key options and activity and levels that stood out to you.
Yeah, so if we were to look at January 16th, that's our most important options expiration date here. It represents about almost a third of the total open interest, about 1 million contracts of open interest here. It was also the second most active in terms of volume today here, about 15%. Notice that our orange box here, plus or minus 4.4% move during these 16 days or so, it lines up pretty closely with our recent relative low point and those all-time highs. So that seems like that's kind of the thinking behind that expected move framework here. In terms of the most important open interest strikes, the 350 calls and the 300 puts are the most activity. That's near the current prices here, but overall a lighter day as we draw down this year. A sizzle 0.9, so about 90% of typical volume for the past 5 days.
Yeah, what stands out to me too is you of course have these boxes representing for that one standard deviation of volatility. Basically, since it's not unreasonable for us to kind of retest that upper end of the range if things just kind of went a little bit more positive in just that first couple weeks of the year. So Certainly a nice year for Alphabet in 2025, but perhaps even better one in store in 26. But any big trades stand out?
There were some big trades. The most interesting one that I thought was a strangle, not the most common type of trade you see, but plus 1,300 March 20th, 280, 325. So buying both the calls and buying the puts here. 280, 325 strangle for a $2.9 million debit, almost $2.9 million. So they seem to be both opening trades. They were done as a spread. The calls were opening for sure. The puts not 100% sure, but basically the lower end of that range, the break-even point 260, number one open interest strike, as I said here, and the number 3 strike for the January 16th put. So that 260 level really stands out from many perspectives here.
Yeah, and one of the names that I think could be rightly called a liquidity sponge, given its market cap and depth of market as well. So fascinating stuff, Rick Ducat. Appreciate all your help in 2025. We wish you a happy new year and look forward to doing it again in 2026. And with that, we'll send it back to New York and Sam Bottas.
Coming up, it's time for Overlook Stocks. George Sillers has his eye on Ondas heading into the close. He'll break down the news about that and what you need to know about it. Coming up next on Market on Close.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going?
First day, so
sometimes,
Next. Try again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way you're going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Bottas, live from the floor of the New York Stock Exchange. It's time now for Overlook Stocks. I'm joined by George Sillers, Senior Markets Correspondent. We're watching OMBS Ondas, which is rallying today after receiving some orders for its autonomous systems. Tell us about this one, George. This is obviously a beneficiary of all the defense spending. Talk us through it.
Yeah, that's right. I think there's a lot of defense spending that's been a catalyst for Ondas, but also sort of a domestic national security issue associated with things like border patrol, and also a lot of money that's being spent on software-defined networks for autonomous vehicles and drone technologies that help secure installations in the United States, like electric utilities. You have to think about rail and transportation systems, oil and gas pipelines, border security, defense, and of course airport security. And these are just basically a handful of industries that Autonomous actually supports with their technologies, both their drone infrastructure technology and their, of course, radio software-defined network technologies. The catalyst for the company really has been the spending, both domestically, internationally, and defense. Some of the defense contracts they actually compete with include Northrop Grumman, General Dynamics, BAS systems out of Europe. So these are some of the majors, but Autonomous is certainly a smaller company in the space with a market cap of around $3.4 billion. But overall, when they reported earnings last, they did talk about their backlog, which is around $22 million. It's continued to increase, and today they also secured another $10 million deal to of course, sell their AI autonomous technologies.
Here we go, a day low again.
Growth rates for the business have actually been quite robust, up over 100% year over year in terms of top line sales. In context, this $10 million increase is quite substantive considering top line sales for the business in the last 4 quarters has only been $24 million. So this is increasing it substantially, but if you look at the estimates for earnings, in terms of revenues going forward, they're only expecting $38 million next year, but that number's jumping over 200% to $140 million next year.
You and I have spoken about this name a couple of times on this particular segment, and I think it was back in October. It had jumped, considerably since the start of the year. I don't know, but over the last couple of months and since then, there's been sort of sideways-ish type action. I'm just wondering if you read into that at all. What happened? Why did we stop there? Why did we pull back a little bit? Was there some sort of catalyst? Because this has had a pretty good run. I mean, it's still up over 250% year to date.
Okay, so you have to consider what's going on. I think sentiment, at least for the small cap names, have been relatively weak, but it's really been specific to the company because last time we talked about the business, they didn't have much cash. They only had about $68 million. When I looked at it last, that number has actually jumped to over $460 million. So they're basically issuing secondary shares. And this is essentially what public companies do. They're raising capital. They're shoring up their cash position to help support the top line sales growth. So they need cash to, of course, fund their operations, R&D. The business itself, based on the last 4 quarters, is losing money at $42 million. But if you look at the top line sales trajectory, it's very positive. Earnings per share estimates are still negative next year at 16 cents of a loss. Significant improvement considering this year's loss of 26 cents. So they're getting closer to break even as they move into 2026. Perhaps they get that level at some point in time under assumptions that they increase their contract and backlog. Nonetheless, there has been weakness because of secondary offers. And again, like I said, it was over $400 million in new shares that were placed in the market since when we last talked about the same. Not a bad thing, but again, what it's doing is it's creating a dilutive effect. And that's giving, of course, some of the short sellers an opportunity to exit their positions because they're short in anticipation of more dilution of shares. But again, like I said, with top line sales growing the way they are, new contracts and earnings getting close to break even, this stock may end up being in a situation where the shorts continue to cover over time based on the lesser dilution needs going forward because they again did raise a lot of cash in the last 3 months.
Okay, so that's that stock. I mean, obviously, as we say, a beneficiary of defense spending, but, just taking a step back, when we look back at 2025, George, I mean, these companies that have had sort of, government contracts, obviously some sort of exposure to defense, have had a pretty good run this year. I mean, you and I have talked about, stocks that have, made the cut here on overall stocks for that exact reason. I mean, these huge moves to the upside. I mean, even if you look across it globally, with every conflict that's going on right now, I mean, I was looking at Germany's defense names as well. I mean, they've been really outperformers. That's driven the DAX up to, over 20% for the year. I mean, it's really been an outperformer. I mean, we have seen very much much a lot of the defence budgets being upped as well. What are you seeing as far as the trend? I mean, does this continue into 2026, do you suspect?
Well, it could. I do think this is an important theme that's been going on last year, especially the last 6 months. If you look at what's going on with the space stocks, space is not about going to Mars and back. It's really about imaging technologies, and that seems to be a theme that fits in with companies like Ondas. Counter-drone security, also, if you will, infrastructure security. These are other themes that have been embedded, at least I know in the United States, which have made manifested into international markets as well. So that theme has been present, and that's why a lot of these space stocks have done well. And Ondas, again, from an imaging technology, communications, infrastructure AI company, has done extremely well performance-wise. So will that theme carry forward? Maybe it does. I think that artificial intelligence is providing value-added service to the imaging and defense industries. I think the Trump administration has been very proactive in defense, and I think that's manifested in what we're seeing here in Ondas, but also maybe it's causing other international competitors or nations across the globe to increase their defense budgets to match those of the United States.
Yeah, and we're going to be speaking to Gareth Smith later in the program just about that U.S. defense and policy and also some of the opportunities out there, the outlook for 2026. But George, thanks for your help in 2025. Really appreciate it. We'll go let you enjoy your evening. George, still there. I'll send things back over to Alex in Chicago.
Well, Sam, we got about 6 minutes until the final closing bell of 2025. Take a short break. We're going to bring in Kevin Green. He'll give us his takeaways for the day, some S&P 500 levels he is watching, and more. We'll be right back.
Real-time access, data-driven analysis, from U.S. equities to global macro matters, Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
We're back here on Market on Close. I'm Sam Barnes here on the floor of the New York Stock Exchange alongside Alex Coffey in Chicago. So we've just got one bell left for the year. So let's welcome in Kevin Green, Senior Markets Correspondent, to help march towards it. Kevin, what levels are you looking at on the S&P 500 right now?
Well, Sam, we finally got a little bit of excitement when it comes to the market over the last couple of weeks. It's been a little bit boring, but we are seeing a development kind of taking place in real time here. We started off the week kind of consolidating in this kind of bearish pennant pattern. You can see that on that 15-minute chart. And then we did see a breakdown, an official breakdown yesterday, and then we are seeing a little bit of a continuation. You highlighted this morning the 68.40 level to the downside could be an area where the market does try to trend to. We did see some early options positioning on the put front that was put buying activity that took place earlier this morning. It seems like that's where we are attracted to, at least for now. Now, we are sitting at the 68.50 level. There's always going to be some pen risk at these round areas when you're looking at strikes for the S&P 500, but if we do continue to move to the downside, I'm looking at 68.40. Once again, a little bit of volatility. We're at the end of the year, end of the quarter officially, and you started seeing actually a lot of that sell-off taking place at around 2 p.m. Eastern time, 12 p.m. my time here, and that's usually when we actually do get the print for this readjustment for the JP Morgan collar. Now, I'm not saying that that's the reason why the market is sold off, but when you do see a little bit of an uptick in options volume, especially in big blocks, you're about 13,000 block orders there, that does kind of wake up the market. You also have tax loss harvesting taking place, repositioning happening as well, and so we are seeing a little bit of a direction. Right now, the direction's to the downside. We are also testing the 20-day moving average for the S&P 500, kind of coinciding with the breakdown in the CCI indicator, the commodity channel index. That breakdown that did occur on Monday seems like it is coming to fruition. When we come back, test the 20, hopefully hold the 50-day moving average, and then see a bounce over the next week and a half.
Kevin, you got your eyes on volatility of volatility, the VVIX. Is this increasing just simply because when volatility gets so compressed, there's really only one way for it to go?
Yeah, that's correct. I mean, if you're looking at vol, we did see it actually crushed to the downside, actually at a very extreme level, at around that 81, 80-ish area, and that's the lowest that we have seen pretty much all year, except for back in March of this year. We did see that kind of move to the downside, and that also then coincides with the tariff tantrum, if you will. Now, I will say, don't compare the same type of reaction to the upside compared to what we saw in March. Obviously, that was a very unique event. We have started to see vol kind of inching to the upside. Actually, ever since around the 22nd or so, we started seeing vol actually moving a little bit higher. That's just because volatility has been compressed, trading at very low levels. And it's easy to re-rate volatility higher than it is lower, Alex. So let's see how far this will actually go to the upside here when it comes to this particular metric. And I think that actually provides an opportunity for traders in this market.
All right, KD, we've just got less than a minute to go, so we're seconds away from the final bell of the year, and obviously, as you just pointed out, we have seen a bit of a pullback today. We didn't get the sort of Santa Claus rally as many had hoped in the market. We were looking at 4 days of declines here, but the S&P 500 falling by about 0.7%. We have actually seen a bit of a sell-off across most of the sectors as well, pretty much all the 11 in the red. We've got about 20 seconds to go, but obviously, we are closing out the year on a strong note. So when you look at year to date, obviously the S&P 500 up around 17% or so. The Nasdaq also higher. So unless you've been living under a rock, you probably made some money in this market, as we've been saying for most of the day. Here you go. So we ended with red arrows across the board, but the major averages still with the double-digit percentage gains. Now, for our third year, so the S&P 500 trailing by 0.7%. We closed out the year at 68.45 there. The Nasdaq down 0.8 at 25,249. The Dow shedding 0.6% on the day at 48,63, and the Russell 2000 down 0.8%, 24.81 there. So, as we mentioned, all the sectors in the red today, but it has been a solid performance this year, particularly for some of the technology names. Obviously, in the last couple of weeks, we have seen this rotation out of some of the high flyers into other corners of the market. We have, of course, got that sector down at 1% on the day as we continue to see this pullback. But as I mentioned, it has been a good year for technology, particularly when you look across some of the Mag 7 names to the communication services sector, down 0.5%, discretionary down 0.8, staples down 0.4, financials down 0.7%. And if we flip the boards and take a look at some of the other sectors on the day, and of course for the year, really we have seen that utilities catching a bit, some industrials and materials, but we are all down on the day. Energy has been a bright spot for most of the week. We did see a pullback today, down 0.6%. But all in all, as we mentioned, we did see a degree of rotation at the back end of the year, and many have been saying to us that this is likely to continue as we move into 2026, as perhaps the other 493 start to catch a bit more of a bid. away from that Mag 7. And if we take a look at mega cap tech, just to see where we ended the day, obviously NVIDIA has been a big story for us in the market off the back of what we got with respect to the report regarding TSMC, China making those H200 chips. We actually ended the day lower there, so we pulled back. Apple down about 0.5%, and the rest did this. Red arrows across the board. Not anything too deep or alarming, but obviously we have seen a sea of red across the markets today as we wrapped up 2025. Alex, KG, just wondering what your thoughts were, Kevin, on the session, and any of your sort of major takeaways for the year.
Yeah, the session wasn't great, but it's nice to actually see some direction in this market, either one way or another. And if you're an options trader, there's definitely ways that you can kind of profit off of these markets here. I think it does get a little bit more concerning. This has been a theme over the last 2 weeks, where we actually have positive news within the artificial intelligence front, but these stocks are not able to hold gains after the good news. NVIDIA is one example today where we did see some distribution taking place. And even TSM, if you're looking at Taiwan Semiconductor, it did close up 1.4%. But if you look at a candle, it's actually in a shooting star pattern, basically potentially a reversal candle. And it does look like we are trading near some key areas of resistance. So over the next week, 2 weeks, what you do not want to see is a further breakdown in that semiconductor trade or even the technology trade as a whole, for that matter. It just makes it difficult for the S&P 500 to try to advance. And maybe we start to see volatility getting back to that 16.5 or even 17 level. I think that's actually a little bit more conducive for equities moving higher than trying to trade in an environment that has a 14 handle on the VIX. So today is just what's getting a little bit more mechanical in nature. Let's see what the follow through is going to be on Friday, as well as then next week. And then for 2025, just looking back, I think the big bright spot, or two big bright spots in my opinion here, one actually is the industrial complex. The industrial sector did a phenomenal job, and it wasn't just the latter half of this year. It's actually been leading, I think, 3 out of the 4 quarters for the most part on a beta-weighted basis to the upside. And I think there's still a lot of opportunity to grow within that sector as you start seeing money being put into the economy in order to build out these data centers, those picks and shovels type of plays. I think we'll probably still see some positive inflows as far as from a fundamental standpoint, as well as maybe from an investor sentiment standpoint.
Kevin, we just had running on the bottom of the screen while you were talking that the NASDAQ 100 closed the year up over 20% in 2025. I glance over and I see one component on the final trading day of the year in the NASDAQ 100 actually higher on today's session. Just wondering if you could take a second and kind of put into context the year that was, and all things considered, today aside, just how incredible it was for bulls.
Yeah, I mean, the year that was, what actually did occur? We had a lot of enthusiasm in November of 2024 after the election. We did see a lot of stocks moving to the upside because of deregulation policies, as well as some other adjustments when it comes to the economy. And I think the market actually did kind of get a little bit more of a fake out when it came to the tariff policies. Initially, we started seeing that move to the downside here. But, the market is usually hard to fade a market when you start seeing a VIX at 45 or even a 50 VIX, right? I mean, at the end of the day, how much vol can actually stay elevated for a considerable amount of time, and you started seeing buyers, getting into this market, especially retail traders. You got to tip your hat to them. They were pretty much on the mark for the most part all year. So I think that's exactly what happened. And so the fear that we had in this market created an environment where individuals started trying to buy into that weakness, which is why we started to move a little bit higher here. And then the latter half of this year, let's say month and a half, 2 months, we started seeing a little bit more of a rotation trade, looking at stocks that have not been able to participate, trading at a cheaper valuation, buyers trying to step in. Dividend-paying stocks also saw a pretty decent bid. Lower beta stocks also started seeing a pretty decent bid. And I think that's a healthy rotation where we're not so concentrated, but we start seeing a little bit of a broadening out. And that's not going to be conducive for having maybe 20% gains next year if you're looking at the NASDAQ or even the S&P 500, but it does allow you to sustain maybe some of the pullbacks of a couple of these industries that might face some headwinds maybe at the latter half of next year.
Yeah, I've been hearing a couple of those conversations today.
I'm here.
Was on earlier today on Nicole's show as well, talking about 3 to 5% upside next year. I mean, it's sort of the numbers that people seem to be penciling in. But you mentioned
it's like the market didn't want to come back up.
Subsectors, and you and I were talking about solar earlier in the day, which has had a pretty good run as far as TAN.
Not a bad day, but I mean, it still had one bad trade, and they got out of it soon. Me sitting in these trades here lately ain't working. It ain't working, don't stick with it. Well, let's see, what is tomorrow? Yeah, tomorrow. Yabba dabba doo. What time is it? We could do one thing. I think today's Wednesday, ain't it? Yay?